All right, 9 o'clock here in New York City on this Monday, March the 1st, 2021. Welcome to Yahoo Finance Live. I'm Miles Upton, joined as always by Brian Sazi and Julie Hyman. Let's take a look at futures this morning. We're starting off the final trading month of the first quarter with a rally on our hands. All three majors pointing to opens in excess of 1%. Certainly saw all that choppy trading last week, and we'll talk about that in a bit. Real action happening, of course, over in the bond market, which I know we'll discuss throughout today's 2 hours. Now, on Friday afternoon, after the market closed, Johnson & Johnson winning approval from the FDA for its single-dose COVID-19 vaccine. We've got 4 million doses set to roll out across the country this week, 20 million expected by the end of this month. But the big story today, Saturday morning, Warren Buffett releasing his 2020 letter to shareholders. We'll break down some of the highlights, including why the Oracle thinks bond investors are facing a bleak future. We'll discuss that coming up here in just a couple of minutes. But let's begin the story this morning, talking a bit broadly about what's happening in the markets here, and really thinking back to last week's bond rout. And Julie, I was struck this morning by a headline from the JP Morgan derivatives desks. They used a shrug emoji as the title of their note, trying to make sense of sort of what happened in the bond market. And there's a number of different factors. And I think when you look at the kind of backup we saw in rates, it probably stretches credulity to say, oh, this is just such a big upgrade of what the economic outlook could be. There are clearly unwinds of very popular trades happening, particularly, and we can even see it on that 2-month chart, the spike just at the beginning of last week. And I'll be interested to see sort of how this market levels itself out. Weird to talk about 140 basis points on the 10-year as a high level of yields, but that is the world that we are in, and I think a lot of questions remain around how the market is going to try to digest some of this action we've seen.
Yes, most definitely. And, there were still a lot of explanations around it that had to do with technical factors, both sort of technical levels in the market, unwinds like you were talking about, and also some anticipation of a changing bank regulation at the end of March that might trigger some banks offloading some treasuries from their balance sheets. I haven't seen that much space given to that particular explanation. But whatever the cause, is it because investors think inflation is coming? Some do, certainly, but it doesn't seem like that would be the overwhelming sentiment that then would be a reason for the rest of the market to sell off like we saw happen. Because, of course, part of the story is what happened in the bond market, but the other part of the story is what happened everywhere else as a result of, or at least sort of triggered by, even if it was an excuse, by what was going on in the bond market. So, for example, you saw the NASDAQ, its drop on the week, I believe, was nearly 5%, 4.9%. That's the worst percentage loss since the end of October. And as we know, a lot of other sort of risk-related assets, Bitcoin had a negative week as well. So there was sort of this ripple effect coming out from the bond market. Now, whether that will last, it remains to be seen. This morning, it's certainly not lasting, right? As we see a rebound, a pretty strong one in the futures here this morning. And you see there, looks like Bitcoin is rising this morning as well. So will it be back? We'll see. I believe that Jay Powell is speaking later this week. So expect probably some more reassurance that rates are going to remain low. And we'll see if the market remains convinced of that. Sazi, what stands out to you in the recent action here?
Well, I think you got it all there, but I would just add to the volatility we have seen in the markets is unlikely over. And a large part of why that is, the volatility is likely here with us is because we've seen a rotation, and we continue to see it, a rotation out of tech, out of growth stocks, into cyclicals, and into value. And a good note out of Seven's report research founder Tom Essay this morning, noting because of this rotation out of tech and into these other areas while 10-year yields rise, you can see a structural headwind to the S&P 500. Let's keep in mind, 30% of the S&P 500 is tied to tech stocks. So if that trade is not working any longer, and it has not worked over the past 2 weeks, if that tech trade is dead in the weeds here, you could see the market continue to be under pressure, and you could probably see more upward bias to the likes of value and cyclicals. And then I will also add, if you're reporting earnings this week, this is not your week. I've been watching Zoom shares all morning long. It started off as our 5th top trending ticker on the site. It's now up to number 4. A lot of interest. The company will report earnings after the bell. It was already a very volatile tech stock. But if this company does not deliver in really against very high expectations in this volatile market, really Zoom shares can get absolutely creamed tomorrow morning.
Zoom's an interesting name because it's really the first pandemic winner that we saw, but the stock topped out at about $570 per share back in mid-October, and now it's $200 off that high. And I think that probably fits the theme of, what's bad for Zoom is probably good for America and the rest of us. So we'll see kind of how those results bear out. Just quickly, Sally, on volatility, to mention that as well. I mean, I wrote up that note from Marko Kolanovic over at JP Morgan last week. He still thinks the VIX is pointing to volatility that is just not in this market. The VIX is implied vol, and his note was saying that realized vol in the market does not in any way justify a VIX trading at 24. Now, we saw it come down 4 points on Friday, but that's a significant backup that we saw last week with the VIX, encroaching basically back on that 30 level. I think in his view, something like the high teens, certainly under 20 for the VIX, would seem to be the likely path for the volatility index as we kind of go forward here. It'll be interesting to see if that does indeed bear out. Probably a positive signal for the broader markets. And I think how those trades play out, that rotation, how much it continues, could be a big part of that equation. All right, let's turn our attention now to the news we got over the weekend. Warren Buffett out with his latest annual letter to Berkshire Hathaway shareholders. Joining us now to discuss is Whitney Tilson. He is the Empire Financial founder and CEO. Julia LaRoche also joins us as well from warm and sunny Miami. Whitney, let's start with something you highlighted in your notes over to us, which is the buybacks. We saw $25 billion, just under $25 billion of Berkshire cash spent on repurchasing shares. How are you thinking about the likely path of buybacks going forward? I mean, are you thinking about it as a percentage of free cash flow? Like how does that factor in? Because you do see it as a significant driver of returns for Berkshire going forward.
Yeah, it's been from 2019, Buffett bought back less than $5 billion worth of stock, and this past year ramped it up fivefold, up to almost $25 billion, retiring 5% of Berkshire shares outstanding. And this is, keep in mind, this is the fifth or sixth largest market cap company in the U.S. stock market. So buying back 5% of your stock in a year is substantial. And Buffett dedicated an entire page of his annual letter singing the praises of buybacks, something that I've been calling for the better part of a decade, in fact. So I'm delighted as a longtime Berkshire follower to see him finally taking advantage of Berkshire's depressed share price, enormous cash hoard, and tremendous cash flows. So as that chart you just showed pointed out, it's been ramping up even during the year. It was $9 billion per quarter the last 2 quarters, and he indicated in his letter that he continues to buy aggressively already this year. So I expect this to continue at the level of the last 2 quarters, and it should be a major driver of Berkshire's increasing intrinsic value per share over time.
Hey, Whitney, it's Julia LaRoche, and I do want to talk about your own price target for Berkshire Hathaway shares, for the A share specifically, and a bit more on how we get to that price target, a price target of 439,000.
Yeah, correct. We've been valuing Berkshire the same way for 20 years. We think it's the way Buffett and Munger value Berkshire, and it's really, there's no mystery to it. It's the way you would value any company, which is Berkshire has enormous piles of cash, bonds, and liquid publicly traded stocks, which are easily able to value. And that comes out to about $290,000 per A share. And then you have Berkshire's wholly owned operating companies, nearly 100 different businesses, the largest being Burlington Northern Railroad, and the utilities businesses. We actually keep the insurance businesses separate because they have so much float. That's sort of picked up in the investments per share. So long story short, you get about $13,500 per A share of pre-tax earnings. That's actually down about $1,000 from $14,500 year over year because of the pandemic. Berkshire does own a number of economically sensitive businesses. They took a big write down on Precision Castparts, for example. You can imagine what the earnings of that company were last year. It makes components for aircraft engines and aircraft. during the pandemic. So we put an 11 multiple on the 13.5, add it to the 290,000 per A share of it cash and investments per share, and you get to 439,000. And this methodology that we've been using for 20 years has actually been quite a good predictor of Berkshire share price over time.
Whitney, should Berkshire investors, should they be hearing more from Warren Buffett on some of the really important issues of our time right now? He mentioned COVID, I believe, once in reference because his furniture stores had to close down for some period of time because of COVID. Didn't mention any of the trading activity frenzy. Didn't mention anything about stimulus plans or the frenzied just activity in the markets overall. Should Berkshire be hearing more from him on these topics?
Yeah, I mean, look, I think if there were one fair critique about an absence of commentary in his letter, it would have been that, it was only, I think, 2 years ago, maybe 3 in his annual letters, Buffett said, we're not finding a lot to do, but someday it will rain gold and we will be out there not with thimbles, but with buckets to scoop up that gold. And a year ago, almost 11 months ago, when the market dropped 35% in a matter of weeks, and Berkshire Hathaway stock dropped to a intraday low of $240,000 per A share, I was pounding the table myself to anyone who would listen that it was the best time to buy stocks since the global financial crisis. And I was certainly hoping that, Warren Buffett would be taking advantage of that, picking up all sorts of depressed stocks or Berkshire Hathaway stock itself. And he really didn't. And it's sort of okay. He's a very conservative person. And particularly any company, a financial company like Berkshire, when markets were on the verge of freezing up. So he played it conservatively. I think he left a lot of money on the table. I think maybe a 10 years younger Warren Buffett would have been able to put a few tens of billions of dollars of capital to work. But it's okay. Berkshire Hathaway is not a get-rich stock. It's a stay-rich stock. And so it's shareholders should know, this is not a stock to make you rich, but it's a great retirement stock for the foundation for your retirement portfolio. But, I would have expected Buffett in his annual letter to have a little bit of a mea culpa and say, what, in hindsight, I should have been more aggressive when the markets gave us, it was really only a month or so where there was an incredible window of opportunity.
Hey, Whitney, I was going to ask you about deal activity, but I'll do a different topic here about the future of Berkshire Hathaway and the leadership. We just saw Charlie Munger speak at the Daily Journal, clearly sharp as a tack at age 97. And now we're hearing from Buffett in the annual letter. What are your kind of thought process for this kind of long-term play and the future management of the company?
Yeah. By the way, a very nice interview you did with Charlie. He's a treat, isn't he? And I encourage viewers to just go to YouTube, where the 2-hour session there is posted from last week at the Daily Journal annual meeting. Look, we're clearly coming to an end of a half-century run of 2 of the greatest investment minds in the world. I do think Buffett has another few years at Berkshire. Munger is 7 years older. And Buffett is still sharp as a tack, and while Munger is really aging physically at age 97, Buffett's still spry. He seems to be in good shape, and he's trying to eat more healthily and is exercising more because he just loves what he does. They've already identified the 2 people who will run the investment portfolio, and they seem to be doing a good job over the last few years. What the CEO's job, managing the operating businesses, they haven't yet revealed that person. It may be, 2 people. It could be a Greg Abel on the operating side, and then Ajit Jain running the insurance operations. But Berkshire will be in very good hands. And there's certainly no Buffett Munger premium built into the stock right now. With the stock at 364, I'm pegging intrinsic value at 439. That means it's trading at a 17% discount to its intrinsic value. Over the past 20 years, at points in the global financial crisis, for example, is trading at a 50% discount to its intrinsic value. But look, we're in a very fully valued market. And as you guys commented earlier in the show, with the rotation away from the nosebleed valuation stocks and tech into into the banks have been doing very well. And I think Berkshire will be a beneficiary of that rotation combined with substantial share repurchases. Berkshire should be, I think, is quite likely to outperform a passive index fund, the S&P 500, for example, over the next 5 years. But you need to have realistic expectations.
Whit, it's Julie here. Of course, in that Q&A, Charlie Munger also talked about Robinhood, right? And he made some not very approving comments of that platform, said it was sort of dirty money. Although ironically, the thing that sort of sparked the latest meme stock craze was a deep value play. I'll leave out one of the words that was the tag of the person who advocated for that. But it was GameStop, right? Was the advocacy for GameStop. Do you think, we were talking about these guys' age and wisdom. Do you think that they're sort of missing the zeitgeist a little bit, though, when it comes to the popularity of Robinhood and its reputation as a sort of platform of the people?
No, I don't. I actually happen to agree with them. I think when we as a country, and this has happened so many times before, my initial introduction to investing was growing up in the internet bubble, a little more than 20 years ago. And when we allow our stock markets to be turned into casinos, and it draws in the most naive investors and inexperienced investors who don't have any sense of history. And then you combine that with sort of social media today. It's a real toxic brew. And I tried to warn my readers about it. Literally the day GameStop, I call it Game Stink, peaked. I called the peak to the hour almost. And I said, this thing's going down huge and fast, and in fact declined by 90% in 2 weeks. And that was something like $20 billion was lost by investors. And I promise you, it wasn't sophisticated institutional investors who were buying Stink at $483, its peak. So I hope the SEC, I don't think anything illegal occurred. Going back to the Dutch tulip bulbs, human beings tend to speculate. And but I don't think it's healthy at all for income inequality or our economy or our stocks, our stock markets. And so I think a very simple, penny a share transaction tax or something like that discourages very short-term thinking. And this hypermanic behavior in the markets, fueled by the bots, the computer systems that are out there trading like maniacs on top of human behavior, would be a good idea. We need to, and Robinhood, of course, gamifies investing. I actually signed up for an account, and it uses all the tools of Facebook and Snapchat, et cetera, to make it highly addictive. But in this point, you're not just talking about wasting people's time. You're talking about people incinerating their savings. And these are generally people who cannot afford to lose the money that they're losing.
All right, Whitney Tilson with Empire Financial Research. Whitney, really interesting stuff as always. Thanks so much for joining the program. Julia LaRoche, thanks for joining as well. We'll talk to both of you quite soon, I know.
My pleasure.
All right, off for a short break here. Again, futures higher this morning on this Monday morning, first day of March here in 2021. We're back with more right after this.
Shares of Johnson & Johnson are up a couple percent this morning, and that's as we have a new vaccine that's available in the United States made by that company. Our Anjali Kamlani has the details on the approval of this vaccine and what that means for the distribution plan, Anjali.
That's right, Julie. So we know that on Friday last week, that's when the Vaccine Advisory Committee to the FDA recommended the authorization for emergency use. That went through in a unanimous vote. And then the following day, we saw the FDA authorize the vaccine. Now, another step after that is that the CDC has an advisory panel that recommends approval of the authorization. And then following that, the CDC itself approves it. So we've got all the boxes checked for this vaccine to roll out by J&J's Janssen pharma unit. And then following that, we're going to find out likely today from senior White House officials what the plan to roll out the vaccine is. We know that there are about 4 million doses standing by, and we know that that's a single shot vaccine. So all 4 million are going to be used just once to provide that protection. And then that rollout is going to happen this week, but then after that, there may be a little bit of a gap because that's all that Johnson & Johnson had on stock. So following that, there might be a little bit of a break, and then we'll see more vaccines rolled out. They're planning for 20 million to be available by the end of the month. Now, another thing I also want to just bring up real quick is that while we're focusing on the vaccines, therapeutics have also been an issue. We know that there hasn't been as much news about that, and we did hear today that an NIH-funded study on convalescent plasma, if we recall, that was one of the really hopeful treatments, it has halted because it's proving to be not really beneficial. So that takes one option off the table now. We're still using just some generics and Gilead's drug. So within the treatment space, it's still rolling a little slow. Good thing we have those vaccines coming out. Julie?
Yes, most definitely. That is disappointing news on the convalescent plasma front. Thank you so much, Anjali. Appreciate it. Our Anjali Kamlani, who covers all things COVID related for us. All right, we're going to take a quick break. When we come back, we'll be talking about the continued interplay between the bond and the stock market as we approach the opening bell. Stay with us.
All right, welcome back to Yahoo Finance Live on this Monday morning. We're about 3 minutes away from the opening bell to begin the month of March. As we think back to what March 2020 was like, let's hope 2021 doesn't have the same kind of surprises and changes in store for us here. But it's certainly been an eventful year so far in markets. And joining us now to talk more about the big rotation trade, how far it can go, is Michael Aroney. He is the State Street Global Advisors Chief Investment Strategist for the U.S. SPDR business. Michael, thanks so much for joining the show. Let's start with what we've seen in the last couple of weeks. You know that the change in the 10-year is within the top 1% of all 2-week changes that we've seen through history. Certainly to be expected that we're not going to continue going up in a straight line with yields. But you don't really think, it seems from my read of your notes, that this is the end for the move higher in yields. Where do you expect this kind of trade to go over the next, let's call it a couple of quarters?
So Miles, I think you just hit it perfectly in that, it is in the top 1% of 2-week moves in terms of the 10-year Treasury over the last decade. So the fact that we're pausing here early this week and investors are breathing a sigh of relief in combination with the J&J vaccine news and progress being made on the stimulus isn't a surprise. But what's interesting is that the US 10-year Treasury yield is kind of the lone holdout and remains well below its pre-pandemic figure. That number was a little more than 1.9%. We know this morning we're in the low 140s, and the market really started to struggle when we hit around 1.6%. So I don't think it's about kind of interest rates generally. I think it's about real interest rates. And so what's happened in the last couple of weeks is that once you start hitting that 1.5, 1.6% level on US 10-year Treasuries, now you have a real interest rate. You're above the CPI level, excluding food and energy, of around 1.4%. And this starts to have some negative impacts in financial tightening conditions in markets. And we saw that in some of the volatility last week.
So is that going to continue then to matter? I mean, it looks like stimulus, to your point, is going to get passed, right? Do you think that we'll continue to see yields then have a resurgence? And can yields be high while stocks continue to go up? Or I guess the flip side of that, is this going to continue to be an impediment for stocks if we see yields continue to climb?
I don't think it'll be an impediment for stocks to move forward as long as we see a move that's commensurate on the economy. So if the economy continues to accelerate, rebound, earnings figures continue to come in solidly, I think that will allow us to tolerate higher interest rates. I think the real concern is that if the economy begins to slow down or the recovery isn't as robust as expected, I think that'll be the real challenge. And I do think, Julie, it's really about those real interest rates. They can't accelerate too much given the debt dynamics, both in the public framework and in the private.
There you have the opening bell on Wall Street. EV play ChargePoint ringing that opening bell. Michael, I want to go look at tech stocks. Tech stocks have underperformed the past 2 weeks with that rise in yields. Is it now time for investors to start dipping their toe back in the water there?
What we've been kind of suggesting all year long is that it's not really about kind of cyclical value or secular growth. It really is about cyclical value and secular growth. So we think you need to either barbell these two items or balance them, whatever terminology you want to use. So we do anticipate that cyclical value stocks will maintain leadership in the near term as the economy recovers, rates pick up, inflation picks up. However, beyond the next kind of year or so, debt, deficits, demographics, and the disinflationary forces of technology will limit how high economic growth can get, how high rates and inflation can get. And in that environment, you want secular growth companies. High organic growth rates, compound cash flow, sustainable competitive advantage, and those that can disrupt different industries from that standpoint. Now, from our perspective, the regulatory spotlight will shine more brightly on FANG, and they're likely to have greater challenges. So we have been suggesting folks access technology down the market cap spectrum and really think about those exponential growth stories within kind of, cloud computing, storage, and those areas, kind of the next Apples, the next Facebooks from that standpoint.
Michael, how are you guys also thinking about some of the, let's call them alternative opportunities that are out there in the markets and that investors are quite excited about, whether it's a SPAC, whether it's cryptocurrency? You guys are mostly focused on the plain vanilla U.S. equities and how those, can kind of get rejiggered within a portfolio. But certainly that is a part of the conversation now. How are you guys at least thinking about that or taking note of that, even if it is, kind of off to the side of your core focus?
Well, I think it's an example of some of the speculative excess that's in the markets in terms of all the liquidity that's out there. So to me, we're not in a bubble environment, but there's certainly some red flags to suggest that, some of these things. So Bitcoin, you think about this kind of new brazen investor class that's really benefited from the intersection of technology, zero commissions, and fractional trade sharing. Being able to trade in fractional shares. So I think that from my perspective, all the money raised in special purpose acquisition companies, this just signals to me an element of market toppiness from a concern. So I'm watching it more as a risk component than a return component from that standpoint. When people invest in Bitcoin, it is on the greater fool theory. It's not a store of value. They're not seeking to hedge their portfolio against risks. They're seeking to speculate and maximize return. It's a very different dynamic than some of the things that we have on offer, like gold.
All right, Michael Aroney is the Chief Investment Strategist for State Street Global Advisors, U.S. Spider Business. Michael, I appreciate the time this morning. I know we'll talk soon.
Thanks.
All right, let's take a look at the markets this morning. We are seeing a rally to begin the month of March. Jared Blickery joins us now. Jared, for some of the highlights as we get this month underway.
Yeah, and it's worth noting that we are entering the second most seasonally bullish 2 weeks of the year. So let's take a look at what we got on the screen here. NASDAQ is up 1.5%, but so is the S&P and the Dow here. Russell 2000 really outperforming. That's up over 2%. And then just taking a look inside the NASDAQ 100, second day of a lot of green on the screen. Even Tesla's up 2% here. And just let's take a look at the winners and losers. Zoom. So a lot of these names that have been sold off, particularly in the last week, are rallying today. So that'd be Zoom, Baidu, Pinduoduo, Mercado Libre, after earnings, Okta, PayPal. Those are all in the forefront here. And it looks like some of the fears over China's tightening schedule are abating just a bit. Let's take a look at the Dow here, because we got Johnson & Johnson fueling a lot of this rally through optimism over the vaccines. That's up 1.4% right now. You can also see Verizon, our parent company, is up 0.6%. Intel's up 2%. Notably, also Boeing up 4% after United Airlines firming some orders for 737 MAXs. Nice to see that coming down the pipeline here. And let's take a look at the travel sector in general. American Airlines, that's up 5%. So is Norwegian Cruise Lines. So the reopening trade really in focus today. And here's the sector action. Energy, materials, and industrials and financials all up about 2% or more. And then to the downside, the staples and communication services, those are the laggards, but they're still up over 1%, guys.
And, Jared, we keep talking about this sort of risk on, risk off, switching around bonds and the interplay between it and stocks. How's all of this affecting crypto today in terms of, as we frequently talk about, there's not a direct correlation between it and anything necessarily, but it does seem to rally sometimes with risk assets.
Yeah, you got to love the Bitcoin trade because correlations come and go with crypto, but it does seem to be the case that there might be some part of the hedging story that's kind of been borrowed from gold. So here's Bitcoin. It's up 8%. Now, we did hit a multi-week low just yesterday. So this is a Sunday price action. We hit about 43,000 there. So we took out last Friday's lows. Typically with Bitcoin, when we see it kind of consolidate, it does need to consolidate for some time. The moves that it's recently had. So maybe 43, 45,000 is support. But for right now, just not breaking out. But guess what? We got a whole week ahead of us, don't we?
We do indeed. All right, Yahoo Finance's Jared Blickery with a look at how things are trading as we get today's session underway. Jared, we'll check it with you throughout the day here on Yahoo Finance Live. All right, coming up on the other side, we'll take a look at what's happening over in European markets. As we head to break, take a look at U.S. stocks up about 1% on this Monday morning.
It is almost 10 minutes after the opening bell here in the U.S., and we've got U.S. stocks trading higher, rebounding after some declines last week, particularly for the tech-heavy NASDAQ, which is up about 1.4% right now. We're also seeing a rally underway in European stocks, and our Latoya Harding is with us now with a look at what is going on overseas. Latoya, what are you seeing?
Yeah, stocks for us are also in the green today. There's a real upbeat mood as last week's government bond sell-off eases. Also, of course, the approval of Johnson & Johnson's COVID-19 vaccine is lifting shares for us over here too. So the DAX, the FTSE, the CAC, they're all solidly higher. The FTSE climbing back over 6,500 points after suffering its biggest plunge since October on Friday. So we've got travel stocks as well. They're continuing to advance. British Airways owner IAG is amongst the winners, as well as cruise operator Carnival. So they're both up around 6% again. Also house builders leading gains in London, and there's traders anticipating positive news for house buyers on Wednesday. That's when we hear the Chancellor's spring budget in the UK. Also lifting shares, we've had decent manufacturing data in Europe this morning. So manufacturing activity in the UK climbed faster than expected last month, although output growth did decline a little bit. It actually fell to the slowest rate since May. And that was just due to Brexit complications, a few supply issues, as well, of course, as the pandemic. But in the Eurozone, manufacturers posted the fastest rise in growth in 3 years, and also a jump in input costs. So Germany, the Netherlands, Austria, Italy, France, they all reported really strong growth. And a surge in demand helped the measure to hit one of the highest levels in history. So all of this has helped to boost sentiment in Europe today, and it's given us a really strong start to the month.
Here as well. All right. Thanks so much, Latoya. I appreciate it. When we come back, we will be talking to the incoming new CEO of Philip Morris International about that company's transition away from cigarettes. We'll be right back.
Philip Morris International has a lot on its plate in 2021 as it works toward its goal of a future that doesn't include cigarettes. And leading that full plate will be incoming CEO Jacek Olczak. He joins Yahoo Finance now. Jacek, good to speak with you again here this morning. So Philip Morris International, its business, really a global business, it has not been immune to the COVID-19 pandemic. What are you seeing in the business right now, and how is the pandemic continuing to influence your business?
Yeah, we're not immune, and we're going through, I guess, the same challenges as many other businesses. We ended last year with a bit of softer revenues than the year before, but thanks to a number of initiatives which we have launched during the year, we managed to nicely expand our operating profit margins by 240 basis points. On a bottom line, on EPS, on organic basis, we still deliver 7% growth. We also feel very confident how the 2021 will look for us. And, the most important in all our transformations to the smoke-free future is that we have not lost an eye from the smoke-free portfolio. So the revenues coming from these new alternatives last year accounted to almost 24%. So if you consider that we are 5 years in this transformation, I reckon is a pretty spectacular result.
Have you seen any demand recovery in your duty-free business? Certainly that business remains dependent on global travel.
Not yet, and I guess the duty-free business will have the longest path to recovery. As we know, this crisis on the one hand is obviously a health-driven crisis, but it impacted our lives by the fact that we lost the ability to be mobile as we used to be before. And obviously the air traffic, the air travel is one of the sectors which is very heavily hit. And I don't think in the very, very near future you will have a recovery to the terms from before the COVID.
Jacek, this is Julie here. I want to ask about IQOS and the growth of that product, which is a higher margin product for you. So I guess that explains part of the expansion of margins you were talking about. How do you convince users that it's safe, and not only existing cigarette smokers who might be switching, but in particular people who might be adapting or starting on these products for the first time?
Well, actually, in our marketing efforts, we very much focus on smokers, on adult smokers. And that product is safer than the combustible cigarettes. Obviously, if you are not a smoker, our advice is you shouldn't start any of the nicotine products. So we have to be very clear, where which target audience is, which audience are we targeting. But I am pleased that, by the year end last year, we already have more than 17 million users worldwide who essentially has left the combustible smoking behind them. Otherwise, they would continue smoking, and this is exactly product for them. We launched IQOS in 64 markets. We enlarged our geographical footprint despite the COVID challenges. And as we had the Investors Day about 2 weeks ago, we have announced that by 2025, 50% of our revenue should come from a non-combustible nicotine products, and we should be in the 100 markets. So there's really transformations in Philip Morris International at the global scale, and with the very, very high speed.
And so that kind of conversion that you're talking about for existing smokers to transition over to IQOS, if you're saying to potential new smokers, don't take it up at all, no matter what product you're talking about, I mean, doesn't that, we're not talking about in the short term, but eventually, doesn't that mean basically a collapse in the business?
No, it's not really the collapse in the business. It's a very cautious decisions which we have made, some years ago when we started developing the safer alternatives. I mean, the products today exist. Very importantly, the science exists, so we can make the verifications whether these products are truly significantly materially safer. And we have invested enormous amount of money and effort to scientifically substantiate these products. We very much welcome the scrutiny coming from a third parties outside PMI, who also confirms this product. Technology exists today, so you can really scale up this product and make them accessible accessible essentially in every corner of the world. So we were very happy and we're very focused that we hit the right buttons. Now, if you obviously have the product which is vastly better than the other products, like combustible cigarettes, I believe it makes a lot of business sense, and also obviously the sense from other stakeholders' perspective to just go and cannibalize your existing business. I think it is not about the additional choice left to the smokers. I mean, the smokers should be very well and very clearly advised. If you don't smoke, you shouldn't start. If you smoke, you should quit. If you don't quit, I think it's a high time you go and seriously consider alternatives. And products like IQOS, even with the recent, especially with the recent authorization from FDA in the US, I mean, that's the product smokers should consider to adopt.
Jacek, in our lifetime, do you think Philip Morris will simply stop making cigarettes?
Absolutely, absolutely. I mean, as you know, I'm stepping into the role of the CEO of PMI. I've been at the beginning with crafting the strategies for how we will go smoke-free. I think in many countries, within a decade, you can leave the combustible cigarettes well behind us and solve the problem of smoking once and forever. I would welcome that there is more collaborations with some regulatory bodies, governments in different countries. But I am very optimistic that every quarter we work hard and we're proving that this is not just a shop window dressing type of an activities. What we mean these transformations, and we want to deliver on leaving combustible cigarettes behind, that more people will be on our side, and jointly we can achieve these efforts. We have markets today on the international, then the 1/3 of smokers already converted to the better alternatives. This is enormous benefits for them and for the public health, on the total public health in these places.
All right, well, we look forward to following your CEO journey. Jacek Olczak, incoming CEO of Philip Morris International. Good to see you. Stay safe. All right, do stick around. Much more ahead on Yahoo Finance Live.
This is Yahoo Finance Live. We just got a measure of manufacturing in the U.S. for the month of February coming from IHS Markit. Purchasing Managers Index coming in at 58.6. That's versus the flash sort of initial first blush reading of 59.1. So a little bit worse than estimated. Still, if you look at 50 as the dividing line between expansion and contraction, manufacturing remains one of the stronger areas in the U.S. economy. That's expected to transition back to services as we see more reopening and hopefully a recovery from the coronavirus pandemic. But that remains to be seen. Delivery times, though, are lengthening, which is interesting given some of the supply chain bottlenecks that we have discussed on the show. All right, we're going to get Brian Sozzi's take right now as we are amidst this big minimum wage debate on a national level. There is one retailer that you watch closely, Brian Sozzi, that's raising its minimum wages and raising it even above the sort of $15 threshold that had been talked about in some of that latest legislation.
Yeah, this is probably Miles' new suburbia fave, Costco raising its minimum starting wage this week to $16 an hour. And the company last raised its starting wage in 2019 to $15 an hour. Quick note here, too, and this was brought to light by CEO Craig Jelinek, Costco CEO Craig Jelinek, last week in some testimony to the U.S. To a U.S. committee, noting that more than half of Costco's workers, hourly workers, are now paid $25 an hour. That is just crazy more than the federal minimum wage of $7.25, and a lot more than a lot of workers are getting in retail, specifically in those dollar stores, which in large part are still getting paid our hourly wages. So I have a bigger piece on Yahoo Finance now about this, looking at why Costco has historically paid well more than the minimum wage. And it goes back to co-founder Jim Sinegal, for years championed the just paying its hourly workers more under the thesis that happy workers give better customer service, leads to better sales, leads to better profits, and over time leads to a better stock price. And also, too, paying your workers more, chances are if Costco has paid those workers more, they're back in the Costco stores and spending more money inside of Costco, which again just creates a whole feedback loop. And in the story right now on Yahoo Finance, I go back, look about 11 years. Over the past 11 years, Costco has added more than $90 billion in sales, $90 billion in sales, and they have added over $3 billion in net profits. The stock price going back to August 29th, 2010, up 502% compared to about 155% gain for Walmart. So clearly, guys, this approach to paying workers more has worked well for Costco. Now, Walmart and Target, they have started to raise their wages. You know, Target last summer raised its starting minimum wage to $15 an hour. But again, both of them remain well behind Costco.
But I think as we get the minimum wage debate kind of fired up here over the next couple of years, because it does seem that we are going to see the minimum wage go higher in the U.S. How high is really the question. At this point, I think these stories are worth reminding folks that the businesses that pay minimum wage are by and large small businesses. And so that is sort of how you see that driving alliance between small business owners and the GOP, which both oppose minimum wage hikes. It's because they are the businesses that pay the minimum wage. Big businesses, Home Depot, Target, Costco, Walmart, et cetera, they are paying more than the minimum wage, partly because they can afford to, and also because if they pay more, it makes those small businesses that they are competing against and hoping to subsume less competitive from a wage perspective against them. But, you know, Sozzi, to your point about Costco's long-standing view on paying workers more, we've seen this with the stimulus checks that were sent out and the enhanced unemployment benefits. If you give people more money, they will then spend more money. And so there is also this belief that paying workers more would be a negative for growth, and yet paying workers more puts more money into the hands of consumers. And when the vast majority of growth is based on consumer consumption or just on consumption, then of course it sort of follows, right, that people getting paid more would eventually work its way back into the economy. But there's a lot of hardening that has happened here along political lines, along economic ideological lines that is going to be very difficult, perhaps impossible, to ever sort of, kind of cross that chasm. But, I think all of these things are likely to take a more prominent role in the economic conversation going forward, because it does seem that wages are the place that these conversations are going to play out. We asked, how would sending stimulus checks, reverberate through the system? I think the answer is how much more are we going to pay people? How much more are we going to mandate that people be paid? Seems to be the conclusion, rather, the follow-on conversation from what we learned about the checks.
And Julie, I'll quickly mention here, I am concerned how the longer-term business models of a dollar stores, even of fast food restaurants, how they play out in a $15 an hour minimum wage, where this certainly appears to where it's going. I don't know about you, but I'm not paying $20 for a Big Mac. I'm just not. I'm not doing it.
Well, I'm not buying a Big Mac anyway, so I'm not in the, I can't speak to that. But I will say, just to piggyback on what Miles was saying, when so much of the conversation over the past year has centered around equity among workers, equity among Americans, you can't have that conversation without having the minimum wage conversation. It really is very closely tied what people get paid and how we sort of raise the stakes for everyone. You can't really do that without paying people more. So it seems like, to your point, this is a conversation that is definitely not going away. We're not going away either. We're going to be right back in just a couple of minutes, continuing this conversation and others. We're going to focus once again on Warren Buffett and the comments in the Berkshire annual letter. And we're also going to speak to the CEO of one of the hot electric vehicle makers that we have been watching so closely. We'll be right back. It is just after 10 a.m. on Monday, March 1st. This is Yahoo Finance Live. I'm Julie Hyman, along with Miles Udland and Brian Sozzi with me here. Let's take a look at what stocks are doing about a half hour into the trading session. We are seeing a rally bounce back from last week's losses, and it's actually gaining steam here. The Dow is now up by nearly 2%, 605 points at the moment, higher, and about 31,537. The S&P and the Nasdaq also up by approaching 2% right now. What makes Warren Buffett so special? Our editor-in-chief, Andy Serwer, was reflecting on that question around the release of Berkshire Hathaway's annual shareholder letter this weekend, and he's going to join us in a few to discuss. Electric vehicle stocks have been revving up this year, but shares of one electric truck maker have yet to pick up speed. The CEO of Hyliion will join us to discuss the company's ambitious battery and powertrain plans. And Citigroup gets a new CEO today. That is Jane Fraser. Bank analyst Mike Mayo is going to tell us why that is a catalyst for him to raise his price target on those Citi shares. But first, let's talk about Warren Buffett and talk about that Berkshire letter out over the weekend. Our editor-in-chief, Andy Serwer, is joining us now. Longtime Buffett head, I guess we could say, or Buffett watcher, most certainly. And you sort of try to distill, what is it? Why are we so interested in Warren Buffett? What has given him this track record that he has, which is not unblemished, right? It's not without mistakes. But if you look at the ensemble of it, it is quite remarkable. What did you kind of come up with, Andy?
Well, it came down to one word, Julie, and that is wisdom. And I was sort of trying to unpack that or dissect what the word wisdom is all about. And I kind of came to the realization that it's being really smart, but also being right. In other words, we know a lot of people who are smart and they do stupid things. We know people who are right, but maybe they're just lucky. But if you do those two things, have those two things combined, smart and you're right, you make the right choices, the right decisions, and especially over time, that's the third element, experience, then you sort of get to be in a pretty select group of people, people who have true wisdom. And I think you could argue and make the case that Warren Buffett is one of those people.
It's so interesting to me when you talked about wisdom in your piece, right? And that as a nation, perhaps we don't revere that as much as some others. And it also stands in sharp contrast to, you know, what's going on in the broader market right now, right? And the sort of gamification and meme stocks popularity, et cetera, that Charlie Munger spoke to last week when he was quite critical of Robinhood. What do you make of that sort of dichotomy? And it is seemingly at odds, right, with the more general zeitgeist.
Oh, no doubt. And, you know, and you mentioned earlier, Julie, that, of course, Buffett's track record recently, especially, has not been particularly good. This happens during bull markets. I mean, basically, and Miles can talk to you about this, you know, it's a beta thing, right? That, you know, of course, you know, you'd expect him to underperform in a roaring bull market, and you hope outperform in a terrible bear market. So of course, when you've got crazy things like this going on, Buffett's going to underperform. And I think, you know, a lot of people are forgetting, you know, what's going on when it comes to SPACs and crypto, and of course the meme stocks, is that they're bull market experts. And, you know, it's easy to have a great track record when the market's going up. And, you know, the market's been a little all over the place this year, but basically we're still very much in a bull market. And so it makes it easy to look wise. It's harder to look wise over time, and especially during a downturn. And, you know, but it's not really the American way, as you sort of say there, Julie, that, you know, we kind of like the rogues and the renegades and the outrageousness. And that's fine too. But, you know, over time, that's going to not probably serve you well as an investor.
You know, Andy, you wrote a little bit about this in your weekend newsletter on Buffett. This annual meeting that's coming up will look a little different.
Yeah, I mean, first of all, Brian, it's going to be in LA, and that's all about, you know, making sure that Charlie Munger is safe. He's based in LA, and so the thinking is that it's easier for a 90-year-old guy, aka Warren Buffett, to travel than a 97-year-old guy, aka Charlie Munger, who's in LA. So they're going to move the core Berkshire executives from Omaha to LA. Now, it remains to be seen whether Ajit Jain is going to come from the New York City area and whether Greg Abel is going to come from Des Moines. Probably some of those guys, if not all of them, will go. So that's number one. Number two, it is going to be virtual again. And of course, Brian, you know, the only place you can see it is on Yahoo Finance. We're delighted to be live streaming it again as well. Yeah.
Yeah, psyched for that one, Andy.
That's right. Andy, we were talking to Whitney earlier, Whitney Tilson, and he mentioned the buybacks, which I know he's been advocating for a long time. And I do kind of wonder, you know, we've spoken so many times over the years, what would Buffett do with the cash? And we played this fun fantasy football game of what business he should buy and how much money they had and all these certain things. But it's interesting that, he not only did he start repurchasing a lot of stock with that cash, but he specifically called out the error he made in the Precision Castparts investment, or that purchase, which was the last real major purchase that we saw from Berkshire. And I do wonder, as you see it, and I've been thinking about this myself, will there be no more major Berkshire purchases so far as the company exists?
I mean, that's a great question, Miles. And it sort of speaks to, well, Warren Buffett's just the same as he's ever been, and he can just continue doing this, the fact that he's 90 years old notwithstanding. Leaving aside the age issue, the tyranny of large numbers is a real change for Berkshire Hathaway and for Berkshire shareholders. In other words, it gets harder and harder to do as well, specifically when it comes to acquisitions. I mean, there's just not so many things out there that are big enough that fit the bill, that have a willing seller, not asking too much, with a management that's going to stay in place, et cetera, for Berkshire to buy. And so the buybacks become a good alternative, particularly when he sees the valuation that's there. But I think you're right. I mean, there is a possibility that we're not going to see a big thing. I mean, what is he going to buy? Costco, Apple? I mean, these things sort of stretch your brain. I guess they're always possible. But also remember that he talked about Munger saying it's really important. We've learned over time that having a stake in these businesses rather than just owning the whole thing actually is kind of a smarter way to go. So it could well be, Miles, that you're right. The era, the age of the giant, swallowing one giant company like that is over for Berkshire.
Andy, you followed Buffett for a very long time. Are you a little surprised that he didn't say much more about COVID or the trading activity frenzy or stimulus in the letter?
Yeah, I'm really surprised. I mean, in my mind, had all kinds of things that he was going to talk about. Succession, you didn't even mention that, Brian. That's, of course, always there. I went back and looked, by the way. I wrote an article about him 19 years ago when he was 70-ish and pressed him really hard on succession. Can you imagine? I mean, so he's been facing these questions for a long time. Munger made a note, I think it was in 2018, that he thinks that Buffett's good for another 7 or 8 years. So that would probably put it to 2025 for that particular issue. No doubt Buffett is going to be asked a lot of questions at the annual meeting about the meme stocks, about crypto, about SPACs, about Black Lives Matter, about Trump, about the economy and the pandemic and the recovery. But, it was a little surprising that he didn't even say, I'm not going to talk about all these myriad issues facing the markets and society. No doubt you'll be asking me those questions at the annual meeting. I'm not going to take up ink here because I could just go on forever. I mean, instead, he did sort of a nice tour of America, looking at it through the eyes, if you will, of the Berkshire portfolio companies, which was great. I mean, quite honestly, I thought there was less news in this letter than there were in many, many years. Previous letters that were much more newsworthy, I should say, than this one, quite honestly.
Andy Serwer, thank you so much. Really appreciate it. Interesting chat there and dig into Warren Buffett. Appreciate it. Just want to bring you some news here. We just talked a few moments ago about the market index of manufacturing. Well, the Institute for Supply Management's numbers have now come out, and very interesting numbers here for February, 60.8 for U.S. manufacturing in the month, which is higher than estimated. The number that really stands out there, and there were improvements in new orders and employment, the number that really stands out, prices paid, that index at 86. The estimate there was for 80, and the previous reading a month earlier was 82.1. So prices there for manufacturing, for goods, really ticking up here. And that's going to be something that we are likely to hear about perhaps from Jay Powell later in the week. He is set to speak at a Wall Street Journal event. So going to be watching that closely, and we'll be watching bond yields closely as well. We'll be right back.
All right. Animation says it all. Market rally on this Monday morning. The Dow is up more than 2%, up 620 points or so. S&P and the Nasdaq also rising, both up better than 1.7% as we get the month of March underway. We came off, or we are coming off, the worst week for the markets since the end of October. Now, a couple percentage point decline in the major averages, nothing really to write home about. But in this kind of environment, right? I mean, I guess that was a 3-day bear market. Everyone got all excited. Everyone got all worried. And a big cause of concern. I think there's still some questions about the broader ARK universe out there in the markets, but there was some concern about Cathie Wood's ETF suite over at ARK Invest. ARK K is the main innovation ETF. People have been watching movements, flows into and out of that fund quite closely. We see this morning ARK K is up about 3%. We saw a 2-day decline of about 9% in the ETF at the beginning of last week. Again, just the kind of thing that people are paying attention to now in this market. We were talking earlier in the program with Michael Aroney of State Street about, is there a bubble? And his view is, well, there are pockets, right? And I think that's a very straightforward consensus view at this point. People are looking at what's happening in crypto and SPACs, and now in certain specific ETFs, which have, of course, a variety of holdings, all of which have their own individual name dynamics. And so we're really at that phase of trying to figure out where the market is at, where we're looking to ever smaller areas of the market for any signs of stress, concern, so on and so forth. But the cyclical rally really does seem to be underway today. We've got bank stocks higher, tech stocks higher, everybody having a good time to get marched off on the right foot. All right, a lot more coming up here on the other side of this break. Stick with us here on Yahoo Finance Live.
The electrification race is red hot when it comes to vehicle makers in the United States and abroad for that matter. And we've seen a lot of investment pour into many of these companies. Let's talk about the truck side of electrification. We're joined now by Thomas Healy. He is the CEO of Hyliion, which is a company attempting to make batteries, powertrains, et cetera, for electric trucks. Thomas, thanks for being here. You guys did deliver some of these systems last year, and you're looking at a bigger expansion this year and then really ramping up going into the couple of years following that. Where are you in terms of development of your products, and what's the goal from a technological perspective of where you want to end 2021?
Yeah, I appreciate you having me on. And you're correct. We've already started delivering some of our electrified powertrains into the trucking space. Our focus is to bring electrified solutions to Class 8 commercial vehicles. So the large semi trucks that you see going down the highway, our goal is to electrify them, make them cleaner, make them more economical. And as you mentioned, our hybrid solution, we've already started delivering that to fleets today. And then we're in the development phase right now of our Hypertruck ERX, which is a fully electric long-haul vehicle, but it actually doesn't use the grid to recharge. It actually produces the electricity locally on the vehicle to recharge the battery pack.
Thomas, when does that Hypertruck come to market? How much does it cost? And in the battery technology in that truck, how long does it take to charge?
Yeah, so the Hypertruck is going to be coming to market next year. Later this year, we're going to start delivering demo trucks to fleets, and then next year starting commercialization. I appreciate you bringing up the battery. This is one of the things that we just recently announced, that we've developed our own battery modules. We're bringing those to market with unbelievable charge rates. We can do a full battery pack recharge in about 8 minutes, and we're expecting about 5 times the life of the battery pack compared to a normal EV battery. So a lot of great advancements there. We're integrating Toshiba cells, and then we're doing all the packaging, the cooling, and the battery management system around the batteries.
Thomas, I'm curious about the decision you guys made, obviously years ago, to target the commercial market first, and what dynamics you're seeing there, because we've seen a lot of electrification, obviously, with Tesla on the consumer side. I think individuals, you hear a lot more in common conversation. And I'm curious what you guys are hearing on the commercial side and what the challenges are there, and why you guys chose that opportunity.
So commercial vehicles is all about payback, right? When fleets look at developing or adopting a new powertrain, they look at how long is it going to take for this solution to save me more money than it costs. And that's very different than the passenger car space, which is much more driven off of emotions of if you want to drive an electric vehicle. And so when we looked at this Class 8 space, these trucks are driving 100,000 miles a year, right? And so if we can come in and reduce the amount of fuel they consume, ultimately reduce the amount of emissions these vehicles are producing, that's going to have a very positive impact on the environment. And one of the things that we announced on our earnings call just a couple of days ago is that we've really laid out our roadmap for this Class 8 long-haul solution. So today, we're starting with using renewable natural gas, and then we're evolving over time into using hydrogen as the fuel we use to actually be able to recharge the vehicles. Now, one of the things that we see as a key differentiator for what we're doing is we're actually adding a middle step there of a fuel agnostic vehicle that can run on both renewable natural gas and on hydrogen, which really offers up fleets the ultimate flexibility of what fuel do they want to use to actually drive their vehicles. They can now base their decisions off of fuel price, station location, what's going to make the most sense for them.
Thomas, I'm just seeing a tweet right now from Bill Gates, an investor in the sector. He has backed QuantumScape, a battery player. He's noting at CERAWeek that green hydrogen would be a, quote, huge deal in helping the energy transition. In your view, how tough is it to get cheap green hydrogen right now?
So it's feasible, but we got a long way to go. In order to make green hydrogen that's cost effective, you really need free electricity or very, very cheap electricity. And that's not available today. So that's where when we looked at this roadmap into the future of trucking, we couldn't sit here and be reliant on hydrogen coming to market in the very near term, right? I think we're going to see some hydrogen stations come up and be available, but it's going to take a long time to get them built out across the country. And so that's where we saw this area here where we can actually start with renewable natural gas and evolve into hydrogen over time, and even have a solution that can run on both to really give fleets that flexibility makes the most sense. And hydrogen is very expensive today. It's about 10x the cost of natural gas. So there's a lot of decrease in costs and decrease in the emissions that it comes from actually producing hydrogen that needs to take place here.
Thomas, finally, I know you guys are focused on powering the vehicles, but when I think of, the future of trucking, I also think about automation and the efficiency that we could see, efficiency gains, I guess, if we don't have individuals driving the trucks. How do you guys think about that, if at all? I mean, that's, again, another part of where people are working, but certainly I'm sure you guys have some thoughts as it fits into, the future of trucking here in the U.S.
So autonomous vehicles, I think, are coming, and the Class 8 space is a perfect place to actually adopt those types of solutions first. What was very unique about our business model, though, is we're focused on the powertrain, right? We kind of looked at this as there's not a need for one company to come in and revolutionize everything, right? The trucking industry is already set up where you have OEMs that make trucks, you have players that make powertrains, you also have players that are doing autonomous solutions. So we saw that our focus here, our sweet spot, was really in the powertrain, and then being able to leverage already existing chassis. One of the other announcements we made on our earnings call was that our first rollout of Hypertrucks are going to be on Peterbilt trucks. And so, we saw this as a more easy way to get to market, a faster way, use the trucks that fleets already know and love, as opposed to us trying to go revolutionize a brand new chassis. Let's just have us stay focused on the powertrain, have other players staying focused on the autonomous vehicle side of things, and then you can have a lot of players coming to market to really make a huge step forward here.
Thomas, thanks so much for being here. Thomas Healy is the CEO of Hyliion. Appreciate your time. All right, when we come back, we'll be taking a look at the new Citigroup under new CEO, Jane Fraser. We'll be right back.
All right, welcome back to Yahoo Finance Live on this Monday morning. We begin the month of March. Markets are rallying. Also, first day at work for new Citi CEO Jane Fraser, leading the bank through what one analyst is calling restructuring 7.0 over at Citigroup. Analyst behind that call is Mike Mayo. He's senior equity analyst at Wells Fargo Securities. Mike, always great to talk with you. So let's start with how you highlight in a note to clients this morning. Story from the Journal out yesterday about Fraser's ambitions here for Citigroup. How do you think about some of the things you saw in that story, and how does it maybe fit into or surprise for a framework that you were looking at as Fraser takes this top job at Citi?
Well, I think the surprise is the degree that the new CEO of Citigroup, Jane Fraser, is hitting the ground running. The story in the Wall Street Journal says that there is a, quote, significant restructuring that might be on its way. And this is a complete about face. As you guys know, I attend annual meetings. I've attended more annual meetings at Citigroup than for any other bank. And when I say that, I go to the investor days for people on Wall Street, but these annual meetings are for more retail investors. It's my chance to quiz the board of directors that oversee the managers. And for the last 4 years, Citigroup's management, including the board of directors, has been adamant saying their restructuring is done. They don't need to restructure. Basically a polite way of saying, Mike Mayo, go away. And now with this Wall Street Journal article, that is an about face from what they've said for the last 4 years, repeatedly said for the last 4 years, that yes, we will go ahead and have a big restructuring. And in fact, that is exactly what's needed at Citigroup, as I've been repeatedly saying for a while. And if so, then they can unlock some of the trapped capital and unleashed value at the firm. We estimate, this is the big number here. Here you go. The stock price started today at $66. We estimate the sum of the parts are $111. So simply by selling off some assets and realizing some of that value, that could certainly be good for shareholders. Now, this is the seventh CEO. We call this restructuring 7.0 because the other 6 CEOs have had some form of restructuring. But now it's needed more than ever before because this 2-decade experiment known as Citigroup has failed when it's come to strategy, execution, financial metrics, and certainly stock price performance.
Mike, Jane Fraser, she's been there for a good bit of time. Why should investors believe that she will be a breath of fresh air and, in fact, announce this big restructuring? And then, follow up on that, what assets are for sale at Citi?
Well, I mean, she has been there a little less than 2 decades. She's been the number 2 person for the last year. So what's good is she really knows Citigroup. And what's a little surprising or needed is the degree of the restructuring that's likely to come. Now, the article mentioned a sale of the Asian consumer business. It specifically mentions a sale of South Korea, which Citigroup bought in 2004, the Coram acquisition, for $2.4 billion, the sale of maybe Vietnam. By the way, we're talking consumer businesses. And if they sold all of the Asia consumer, that would be about 1/10 of the firm. We've also called for sales of the Mexican consumer business, which would be another 6%. So, there's certainly assets which, if they sold, might even result in gains. So that would be good. So my 3-point checklist for Citigroup: number 1, sell all international consumer. Number 2, reorganize around their payments businesses, which comprise about 37% of revenues. And point 3 is go ahead and take the charge to retire the old clunky computer systems. And that would be good for investors. It would be good for them resolving the issues with regulators. And it could finally see this underperforming stock price perform better ahead.
Mike, it's Julie here. A lot of the changes you've been talking about are concrete changes, right, in terms of restructuring, selling off assets. I'm also curious about the intangibles, because even though, as we've been talking about, Fraser has been there for a while, she wasn't in charge. So culturally, and this is where I'm getting into the intangibles, what can she change and what do you expect her to change at Citi?
Well, I mean, what Citi needs is better accountability from the top down to the bottom. And so she can certainly increase the intensity. She can improve the accountability. She can improve the transparency. And, I think this is like management 101. So while she may have been a team player, sometimes when you're a team player and you get that number one spot, that's your chance to go ahead and make changes. On the other hand, from the 10,000 foot level, she is a strategic thinker. She's ex-McKinsey going way back. She's had several different positions within Citigroup. We'd like to see her do what James Gorman did at Morgan Stanley, but do that at Citigroup. And sometimes it's the simple decisions that are the most powerful. A reorganization of businesses and new business lines, so restructuring it so that you can better manage it, so that you can better measure it. And so I think those are probably her core strengths. And if she can just implement a few simple, powerful changes like that, then Citigroup could finally realize more of the value, realize more of its potential, because it has the ingredients. I mean, you're half the company, the wholesale business. You're in 98 countries around the world. You're moving cash for corporations. You're one of the largest capital markets firms in the world. So that half of the company is pretty easy to understand, and that competitive advantage has only increased, especially against the European players, which have pulled back, the likes of UBS and Credit Suisse and HSBC and Barclays and Deutsche Bank. So that half is fine. Then the other half, it's a lot of credit cards. They're the number one credit card firm in the world, but they need to better leverage that into other consumer products. And when they can't do that, and especially outside the U.S., they should probably discard that.
And, Mike, you've given us certainly an outline of where Citi is today through this conversation, but you just said something interesting in an earlier answer. You talked about the 2-decade experiment known as Citigroup. And I guess as you think about that as an analyst, how do you kind of plot that course from, when does that begin? Is that the decision to spin out Travelers and then go, how are you thinking about that history of Citi and sort of how this era might be remembered?
Well, I mean, it started with Sandy Weill and John Reed, late 1998, when they merged Citicorp with Travelers. And, we dubbed that merger Noah's Ark because they brought two of everybody along. If not many would remember that, but they had two CEOs, two heads of consumer, two heads of wholesale. It was a mishmash of cultures. It didn't work. And then eventually you had Enron and WorldCom a couple decades ago now, and there were changes a couple years after that. And then you had Chuck Prince, who was a former lawyer. I don't think he was ready to take that role. Then you had Vikram Pandit, and that didn't work out very well. By the way, through all of this, I was at different times, I was shut out from the company. I wasn't allowed to ask questions. I wasn't allowed to have meetings. I was raising the alarm. And I just found a very shareholder unfriendly attitude. Then eventually you got to Mike Corbett for the last 7 or so years. And I think he did a good job in making Citigroup much more conservative, resilient, less chance of bankruptcy. Citi has effectively gone bankrupt, 5 times in the last century. Again, implicitly gone bankrupt. So that the risk of that happening certainly has gone down, but Citigroup's played it too strategically safe over the last 7 or 8 years. And so now we tee it up to Jane Fraser. She inherits a strong balance sheet, much better liquidity and capital. They're not likely to go bankrupt. The bond spreads for Citigroup's debt, reflects that. But it's one thing to have a solid foundation. It's another thing to go ahead and do something with it. And that's Jane Fraser's challenge and opportunity.
Mike, is part of the problem with Citi, and this will be an ongoing problem, I suspect, they have a 16-person board of directors, and they've been there for some time. How do you get a big restructuring through with a 16-person board?
They have to do it. They must absolutely do this. And, to the extent that Value Act is still an activist investor, and they've been vocal, speaking at a conference late last year, the head of Value Act. It'd be nice to see them join the board, but they've had these special agreements with Citigroup. So it'd be nice to see, Jane Fraser working with others who can, cause a change on that board because it has not worked. The board has not held Citigroup management accountable enough. And this goes back over 1 year, 5 years, 10 years, or since that late 90s merger of equals. And so the best example of that is, the CEOs have gotten paid over $400 million over the past couple decades, and the stock price is down, down like 80 or 90%. That's not capitalism. And that doesn't work when, that's why I go to annual meetings because, if capitalism is not working, then it's up to the shareholders, the owners of the companies, and those who represent them like me to go ahead and speak up. And if that doesn't happen, then you see what happens. Then Washington, D.C. regulators jump in there. So it's time to hold, Citigroup and their managers more accountable. And one way to do that is to go ahead and make some changes to that board. I hope Jane Fraser has some flexibility to do so.
All right, Mike Mayo, Senior Equity Analyst at Wells Fargo. Mike, always great to get your thoughts. Thanks so much for jumping on this morning. I know we'll stay in touch as the Citigroup saga unfolds over the years ahead. Thanks for having me on. All right, we head off to break here on this Monday morning. Stocks in rally mode. All three majors up better than 2%. We're back here with a lot more on Yahoo Finance Live right after this.
This is Yahoo Finance Live. One of the many, many consequences of the pandemic has been the unprecedented disruption to schools around the country. It set students up for a year of highly unusual learning, to say the least, and pit adults against one another on how to fix that. It me, in a phrase. Yahoo Finance's Arthi Swaminathan, as well as our Reggie Wade, took a look at how some districts have dealt with those disruptions, while some have managed to find that very elusive common ground.
Chicago public school teacher Quentin Washington has been teaching remotely since the pandemic began in early 2020.
But what I love is I love to see the kids interact with each other in this virtual space.
But earlier this month, the music teacher and Chicago native received some good news. He was finally going back to his classroom for in-person learning. Thanks to the Chicago Teachers Union, which Washington is a part of, and the city government, K-12 educators were finally getting their vaccine shots, allowing the school district to reopen schools that had been closed for months.
And my appointment was this afternoon, so I actually just came home from having the first vaccine. But I'm glad to get it. It gives me a certain sense of security, and I think that every teacher deserves to have that before they're forced back into a building.
But not all teachers across the country have been this fortunate. While Chicago's teachers had their unions fight for them and successfully reach a common ground with other stakeholders, which includes parents and city officials, others haven't had the same success. Since the pandemic first started spreading in the US, many school districts across the country have halted in-person learning, instead offering a fully virtual or a hybrid classroom to millions of K-12 students. The lack of in-person learning has been a major pain point for parents who feel overwhelmed with balancing work and childcare responsibilities. But reopening isn't a simple process. Many teachers and their unions have stressed the need for their safety and well-being. According to Education Week's estimates, as of February 24th, 833 active and retired K-12 educators and personnel have died of COVID-19. It makes sense when 85% of educators in an American Federation of Teachers survey said that they'd go back to school if they were given priority for COVID-19 vaccines. But as of February 22nd, teachers in 18 states were still not eligible to receive the COVID-19 vaccine. This acrimonious dispute over reopenings has pitted many officials, parents, teachers, unions, and workers in K-12 education in many different states against one another. One of those states is Texas. Jimmy Lee has been in education for 33 years and is the president of the Association of Texas Professional Educators.
And we have been asking the state to push the educators in the state up into the grouping so that they can get the vaccine, those who are willing to take that. And I think the majority of them are, because they want to continue to do what is needed in the classroom.
On the other side of the country, the pandemic and the debate over reopening has also laid bare the fundamental problems that exist within school systems. In Rochester City School District, middle school math teacher Tom Rossiter said the lack of financial resources has just been frustrating to deal with.
So my district in particular, in Rochester City Schools, realized last year that we were in a dramatic budget shortfall and laid off hundreds of teachers during the year last year. And then we got hit with a pandemic in March 13th was our last day. And then, we didn't have the finances to do a lot of the things that many other schools were able to do.
The school district is considered to be chronically underfunded and faces possibly more cuts to the system. This will complicate teaching and learning even further, says Roster.
Our technology issues are so significant for all of our students, not having access to internet at home and having to do MiFi's and personal hotspots that have data limits, so the kids can't share videos and can't be as actively participating in lessons as many other students would be able to.
Mark Luxembourg, who's also in Rochester, said it felt genuinely frightening to go back to school amid COVID-19 due to his personal illness.
I suffer from 3 chronic autoimmune diseases. I didn't return to teaching until October 1st because I tried to make an accommodation with my school under the American Disabilities Act to teach fully remote from home, and I was denied that option. And I was scared to death to go back in September, and I took the majority of my sick days before I agreed to come back October 1st.
Teachers in Chicago were able to avoid this specific scenario.
That our children will be returning to in-person learning this week. At long last, CPS has finally reached a tentative agreement with the Chicago Teachers Union that opens up the school doors for safe in-person learning for our pre-K, cluster, and K through 8 students.
But finding that common ground was a hard-won battle, and it took a lot of commitment on both sides to compromise.
I know here in Chicago, one of the reasons that we've had such a hard time is because our school district feel like they don't have to have those conversations with us. They're the boss. They can tell us what they want us to do, and we're just supposed to do it. So how do we find common ground? It starts with a conversation. It starts with an honest, candid conversation about where we are, where we would like to see ourselves, and what are some of the best ideas of getting us back there to that place.
Well, I've definitely been living this in my suburban school district in New Jersey, Arthi, as so many other school districts have. And part of the conversation, too, when you hear about these school districts that are chronically underfunded, it has to do with physical plant as well in many cases. There was just a report in the New York Times about how opening a window, for example, helps. And obviously heading out of the winter season will help with that issue. But when you look at funding for school buildings across the nation, it seems to me that's part of the problem as well.
Right. And there's a fight going down in DC over how much we can give these schools. A lot of these schools have been drawing on these funds so critically needed, but they're also saying like it's not sustainable, right? Some of these schools have to invest a lot more in technology, have to, basically lay the groundwork. Affluent suburbs have different issues. But I just wanted to flag that mental health is going to become a big issue for these schools to address. The city of San Francisco recently sued its own school district because there were, rising hospitalizations and even suicides due to mental health concerns. So just thinking of all the different implications that are coming down the pike. Hope that DC can get some funding approved pretty soon.
Yeah, when the kids finally do go back in person, there's going to be more issues than ever for these schools to deal with, unfortunately. Arthi Swaminathan, thank you so much for bringing us those important voices from those teachers around the country. All right, we're going to take a quick break. When we come back, we'll be getting the latest on the markets. Look at that. Stocks trading at the highs of the session. Pretty sizable rally now going on in U.S. stocks. We'll be right back.
All right, welcome back to Yahoo Finance Live on this Monday morning. Stocks in rally mode to start the week and start off the month of March. we see all three majors here up more than 2%. Let's bring in Jared Blickery, though, to talk a bit, Jared, about what's happening over with the VIX and volatility. I mentioned it earlier in the program. I know you saw Marko Kolanovic's note from last week, calling it a bubble in vol. I think he was using the term just because it's more fun to use bubble than say vol is too high. But we see the VIX coming down, and that's certainly a dynamic that is going to help the markets at least level out a bit here as we get into the month.
Yeah, volatility is largely misunderstood, but we can put it in pretty simple terms here. So we got a spike over 30 last week. And I have to say, the entire options market has been skewed by the rise of retail traders, all the call options that have been bought over the last year. That's really changed the dynamics here. And so, you take a look at the VIX historically. Let's take a 5-year view. We used to be in a range around 10 to 12, and that persisted for a long period of time. This is definitely a new normal that we're in. Also, it's worth repeating that last Thursday was a big deal in the bond market. We're going to go to a 2-month chart. Excuse me here. We can see we're down 4 basis points today, but this spike up caused a lot of pain in the rate space. And we're also seeing bond market volatility elevated as well. That's reflected in the MOVE index. And that's kind of strange because the Fed balance sheet is hitting all-time highs, and that's usually not the case. So when the Fed is in the market buying bonds, we tend to see bond volatility decrease, not what we're seeing here. So I think we've seen the worst that we probably have seen in the rates market for the short term. But going into the week here, I think it's going to be interesting to see what happens with volatility and the general market. You can see here's the S&P 500. We only had about a 4.5% decline, similar to what we saw in late January. And this is kind of setting up for the most bullish period we have, or second most bullish 2 weeks we have in the market, which thank you for tweeting that earlier, Miles. I did retweet that.
Yeah, Jared, I love my JV technical analyst hat, and I see in that chart a couple of higher lows. Tends to be constructive for the market. So we'll see how that plays out as we get through the second most positive seasonally adjusted 2-week period of the year over the first couple weeks of March. All right, that's going to do it for myself, Brian, and Julie on this Monday morning. We'll see you back here 9 o'clock Eastern tomorrow. Zach Guzman and Kiko Fujita have you for the next couple of hours. Keep it here on Yahoo Finance Live.
Welcome in to Yahoo Finance Live. I'm Zach Guzman alongside Akiko Fujita, and we have stocks here in rally mode to kick off the month of March. Right now, the Dow up nearly 700 points. The S&P 500, as you can see there, up more than call it 2.25% right now, on track for its biggest advance in almost 4 months' time. And of course, we've been watching the yield here on the 10-year falling back down to earth, now at about 1.42%. We're going to spotlight what the Oracle of Omaha is saying about the path ahead and why he's warning bond investors about repeating mistakes of the past. Plus, SPACs hitting space as a private rocket company, Rocket Lab, announces a deal to be valued north of $4 billion with SPAC Vector Acquisition. Shares today popping off that news. We'll dig into that with the CEO and founder of Rocket Lab later on in the show. And the U.S. materials company catching a big pandemic boost. Lidl shares up more than 170% over the last year. We're going to be chatting with that company's CEO to break down how filtration materials are making a big jump from N95 masks now to indoor air filtration systems as sales take a boost on that side of the business. But first, I want to kick things off today with Warren Buffett's annual letter, Akiko, because we learned a bit more about his thinking for the year, not only how he's feeling about past mistakes, highlighting in his words overpaying for precision cast parts, but also his new warning about bonds not being the place to be for investors and the potential risks that investors on that side of the trade might be chasing, with yields still extremely low.
Yeah, the bond yield story is certainly relevant given just how quickly we saw the yields rise last week. And on that front, no surprise, Warren Buffett saying bonds are not the place to be these days. And let's specifically look at what he said in that annual letter, because a lot of investors looking at this to sort of potentially reposition their portfolios. Warren Buffett saying fixed income investors worldwide face a bleak future. Some insurers, as well as other bond investors, may try to juice the pathetic returns now available by shifting their purchases to obligations backed by shaky borrowers. Risky loans, however, are not the answer to inadequate interest rates. An interesting take there. And when you look at where things are trading today, we have seen the 10-year yield pull back in a significant way after really getting close to that 1.5% level last week. We're looking at 1.43 right now. Another thing that stood out to me was also kind of what he talked about in terms of Berkshire's buybacks. We saw Berkshire buying back a record amount of company shares. Fourth quarter, the company brought back $9 billion of its shares, bringing the total repurchasing of 2020 to $24.7 billion. And Zach, on that front, we've heard Warren Buffett say before that he doesn't necessarily believe in buybacks, but it is something that he sees the need to inject himself, especially when he believes that the intrinsic value of a company is dropping. So maybe some indication of where he sees Berkshire share trading in relation to the broader market right now.
Yeah, and you can see how that historically stacks up compared to quarters of the past there in terms of their share buybacks. But I mean, Akiko, we talk so much about the recent performance of Berkshire and how it stacks up against the market. But when you really zoom back, I mean, it's tough to knock Warren Buffett for his past performance relative to since the 60s, outperforming the S&P 500 by a 2-to-1 margin when you back up and track it all the way back then. But as of late, I mean, some people have been highlighting some of his misses. Of course, there was the airlines move right before kind of that became a very popular retail trade in betting on the reopening of not just travel, but the broader cyclical kind of stocks that we've been talking about here on this show. So people are focusing in on that, maybe focusing in on the way that Apple is now a very sizable piece of his portfolio, the largest stock holding in terms of common stock. But what do you make of that when you really do zoom back and try and piece together how his maybe investment thesis has changed in some of the companies he's now betting on?
Yeah, interesting context here. I would sort of point our viewers to the morning brief from our editor, Sam Rowe, because he had a pretty good chart here that shows the performance of Berkshire shares in relation to the S&P 500. And when you look at 2019 and 2020 overall, it's certainly underperforming the S&P 500 by a wide margin. Berkshire shares overall, though, looking at a performance since 1965, We have seen Berkshire shares see an average annual return of 20% compared to the S&P 500's 10%. So that's not necessarily to say, to call out Warren Buffett on his investing. He certainly knows way more than I do about investing in the market, but it does point to the fact that if you are sort of long-term in investing here, you are going to have some years where things don't go well. And the point that you pointed out here, Precision Caspart, so he has talked specifically about the mistake on that front, the $11 billion write down there. He says, I paid too much for the company. No one misled me in any way. I was simply too optimistic about PCC's normalized profit potential. So we all know Warren Buffett to be somebody who, when he knows there's a mistake there, he's the first one to own up to it. And at least on that front, it sounds like he feels like things were going to be much more rosier than they turned out to be.
Yeah, and on those more recent bets there, maybe just worth highlighting because a lot of people have Apple in their portfolio, so maybe not a surprise to really see how that's been a standout in his holdings. But when you think about where it's at, it was $120 billion in terms of the size of that Apple holding at the end of 2020. And a notable uptick in terms of where he got into that position. So kind of joining in on what a lot of people have already been seeing in tech, but that's the big question in terms of where we go from here, as we saw that kind of a mini panic, I guess you could call it, around where the 10-year was trading last week. And for more on that, I want to bring on our first market guest today, Chris Brightman, research affiliate CIO, joins us right now. And Chris, you just heard us talking about the Oracle of Omaha, and far be it from us to really come at him. I mean, if you come at the king, you best not miss here. So what do you make of what you heard from Warren Buffett in that shareholder letter and kind of where we're at in this stage of the recovery?
Well, reading the letter, what caught my eye was, as you've already noted, the importance of Apple to the performance of Berkshire. And also, notably, he's been selling more recently. Also, the defense of buybacks, that kind of financial engineering works well to the benefit of investors in the company when you're buying the stock cheaply, as I'd argue Buffett was buying Berkshire stock cheaply during much of 2020. Buying overpriced stock doesn't work out so well for investors. And then what really reinforces my concerns is his reminder that, in his words, bonds are not the place to be. Just briefly, I'd observe that the rise in interest rates that we've seen from the low near 50 basis points a year ago to closer to 150 basis points, almost a tripling in the 10-year Treasury note yield, has really been fabulous for the stock market because it was almost all, well, actually more than all, rising inflation expectations. Inflation expectations, as measured by the 10-year break-even inflation rate, went from almost 50 basis points, again, a year ago, to 2.2% today. And that's terrific for the stock market when the Fed is having trouble getting to its inflation target. Now that the market thinks it's at the inflation target, again, BEI at 2.2 is right about the Fed's target. We're at this difficult inflection point where an overshoot of inflation, not so good for markets, unlike a recovery from missing on the downside. So that's why we see the choppiness in the markets with concern from rising inflation. Some days, other days, we have a very strong reflationary trade where values outperforming growth, small outperforming large, international outperforming domestic, et cetera.
Chris, what do you think is contributing to the softening, at least in the 10-year yield today? Is it a sign that potentially investors got their initial jitters out of the way in terms of inflation concerns? Or to your point, is this kind of the risk that continues to reemerge in the market?
Yeah, bouncing around between 1.4 and 2.5 is just kind of noise, I think, in the context of a tripling of 10-year yields from 50 basis points to 150 basis points. Also of note, I think, is recently there has been a considerable increase in real yields. If you break the 10-year down into inflation expectation plus its real yield, what you find is that we were pretty stable at about a 1% negative real yield throughout the second half of 2020 all the way into February. Now we're seeing that real yield lower, about negative 75 basis points, still notably negative. But as all of this fiscal stimulus comes in, and then after the 1.9 trillion of stimulus, there's another $2 billion of Buy Back Better infrastructure bill. This is going to return real interest rates to a normal level. Whereas normal in the United States, I don't know, I would maybe pick somewhere between 0 and 1%. It's going to be positive, not the 2% kind of level we saw over the past few decades. But with interest rates rising, that really knocks out a support for very, very expensive equities. You know, many people rightly say, if you look at where real bond yields are, it supports much higher equity prices. Well, that's all well and good so long as you have those low bond yields. But as bond yields rise and normalize, it's going to be difficult for equities.
I'd be curious to get your take too, though, because we talk about this, and this is something that Warren stressed in his letter. You know, you can look at it and say, oh, 1.4%, we got there pretty quickly. But still, as he points out, a pretty steep fall from where we were back in the 80s, 15.8%, that high point, now down 94% to see kind of where we're at now. When you look at the update, though, we got in terms of ISM showing manufacturing expanding at the fastest pace in 3 years, how much does that maybe signal? I'll just give the number, 60.8 from 58.7 a month earlier. Expectations were 58.9. But when you look at that, how much does that maybe move forward the pace at which this recovery is really starting to accelerate now and maybe put pressure on the Fed to reel in some of those accommodative measures that they put in place?
Well, I don't think the Fed's going to act. Jay Powell's been very, very, very clear that he's not going to react until we've eliminated all the slack in the market. Now, that's difficult to measure. We know that the unemployment rate as calculated is not accurate. We're probably down 10 million jobs. There's a lot of people that are absent from the labor force participation. So until the output gap is eliminated, the Fed is not going to be raising interest rates anytime soon. And therein is, a concern about inflation. And, some days the market gets very upset and concerned about the risk of rising inflation. Again, inflation rising from below the Fed's target to the Fed's target is unambiguously good for the market. Inflation rising above Fed target, that's more difficult for the market to absorb. And then rises in real interest rates, while entirely a great signal for the economy. If the economy returns to normal, we're going to see real interest rates rise. But again, that takes a prop out from the stock market. If you want to know where to position inside the stock market, I think the reflationary trade is the right response. But if you're worried about the market's valuation overall, I think you keep an eye on inflation expectations.
Some good takeaways there. Chris, it's good to have you on this Monday. Chris Brightman, Research Affiliates CIO, joining us there. We're taking a quick break here, but coming up, a third COVID-19 vaccine enters the market. Johnson & Johnson's one-shot jab expected to speed up the process of vaccinations, but it faces some skeptics worried about its efficacy. We'll discuss that after the break. Welcome back to Yahoo Finance Live. Johnson & Johnson's COVID-19 vaccine adding a new weapon to this fight against COVID-19, against the coronavirus. Its FDA approval over the weekend, paving the way for 4 million doses to be shipped out immediately, with the first vaccinations delivered as early as tomorrow. Let's bring in Dr. Amish Adalja. He is senior scholar of Johns Hopkins Center for Health Security. Doctor, this is certainly good news when you consider how many people need the vaccine right now. But some of that good news potentially overshadowed by these concerns about the efficacy of the vaccine. What's the messaging to those who are looking to get this vaccine, who are saying, maybe I should hold out for Pfizer or Moderna? Walk us through how you see these three vaccines now that they've come to market.
The way that I judge these vaccines is on what matters: their ability to prevent serious disease, hospitalization, and death. All three of these vaccines, Pfizer, Moderna, Johnson & Johnson, do that tremendously well. So I have no qualms about the efficacy, because they are the path to ending this pandemic and stopping the damage that this virus is doing. So I would not hesitate to get the Johnson & Johnson vaccine if it's available to you. And you have to remember also that when you look at these efficacy numbers, they weren't done in a head-to-head trial. These trials were against placebo. So it's very hard to make apples-to-apples comparisons among the vaccines. So that might not be fully valid when you look at those efficacy numbers. But again, I would focus on what we want these vaccines to do, and that's prevent serious illness. And all of them are off the scales good when it comes to that.
Yeah, when you think about the numbers of these coming out now, 3.9 million shots this week, but then none the week after, and you look into how much was promised. Johnson & Johnson said that they would be able to get 100 million by the end of June, but the numbers are coming in a little bit less, below what that original contract had kind of predicted they would be able to deliver. When you look at it, though, from the national scale, how much we're going to have for Americans here, it doesn't seem like that's the issue right now. So what are you looking at in terms of how many vaccines we have, since it seems like we're pacing to have more than enough?
Eventually, we will have more than enough vaccines to vaccinate the adult population. The key is how quickly can we do it? And I'm somebody that thinks that there should be no speed limit. We should be doing this 24/7. There should be no vaccine left on the shelves. And there are some states that do have vaccines left on the shelves. We will get immediate benefits the more people we vaccinate. We're already seeing that in Israel. We're already seeing that with nursing home populations. So I think that the goal now is just to make this kind of an all-out effort where no holds are barred and people are just getting vaccine into their arms in an assembly line process. And I think the Johnson & Johnson vaccine will make that easier, because it doesn't have cold storage. It's one and done. And you also just have to wait until, but the issue is you have to wait until we get enough doses to be able to do that. So just 3.9 million is really a drop in the bucket, but eventually we will get more Johnson & Johnson vaccine, and I think move at a much accelerated speed.
And Doctor, I want to get back to that first answer you had there on the efficacy here, because to your point, every healthcare official has said you need to get the vaccine that you can first get access to. But I wonder what more needs to be done on the education side of this in terms of the messaging, especially as we try to reach more and more of the more vulnerable communities, these essential workers who, have questions potentially about why some were able to get the Pfizer Moderna vaccine first and the Johnson & Johnson vaccine is being pushed in some of these communities. What more needs to be done to educate people, you think, about just the safety of this vaccine particularly and its efficacy?
I think what we need to do is really go back to first principles. Why did COVID-19 even rise to our attention? It rose to our attention not because it was causing mild illness, but because it was causing serious illness, hospitalizations, and death. That's why a whole vaccine program was embarked upon, to be able to stop the virus from doing that, to basically tame it or defang it with the vaccine, to make it more like our ordinary respiratory viruses or like the other coronaviruses that cause 25% of our common colds. All of these vaccines do that. So whatever path you get to, whether that's the Moderna vaccine, the Pfizer vaccine, Johnson & Johnson, AstraZeneca, Novavax, it doesn't matter, because our goal in the end is to make this a tame virus, one that is no longer a public health emergency, one that will never threaten hospital capacity. That's our overarching societal goal. And the path through that is going to be getting a vaccine. And these vaccines all do that really well. They're all very safe. And the Johnson & Johnson vaccine has the added benefit of being one and done, that you can have one dose of the vaccine and you're likely done and you have that protection against serious illness. That's what we want to do. And I think that's what we have to go back to, is telling people, we're not going to COVID zero. We're not getting rid of this or eradicating this virus. We're basically making it a much more manageable problem than it has been throughout this pandemic.
Yeah, and I mean, just anecdotally, myself included, you hear once people's parents start to get their vaccines and get through that. People do take a sigh of relief once you know that those odds are improved in terms of outcomes. But lastly, I mean, when we think about this return to normal, we keep hearing Dr. Fauci talking about wearing masks for longer. So how do you square maybe that, jumping the hurdle of maybe reducing deaths and serious illness, and kind of how much longer Americans should be bracing for having to wear masks into the future, and when we can finally say, all right, this is back to life before the pandemic?
Once we get our vulnerable populations vaccinated, right now I think about 40% of those age 65 and above have been vaccinated, then you're going to be less worried about spread because everybody that could get hospitalized is protected through the vaccine. That's when I think you'll see some of those mask mandates lift. I think some people may wear masks longer because they've gotten accustomed to them, maybe on public transit or in crowded places. But the masks are going to be there until our hospital capacity is never going to be a concern, meaning we've gotten everybody that has the threat of being hospitalized, at least the majority of those individuals vaccinated. So I think that's likely to be in the summer. But I think, remember that just wearing a mask is not that big of a deal compared to all the other activities that'll start to open up as we get our vulnerable populations vaccinated. And we're already starting to see that. So I think there's lots of reasons to be optimistic about this vaccine. It is the path forward to ending this pandemic and to getting our lives back.
All right, Dr. Amish Adalja, a senior scholar at Johns Hopkins Center for Health Security. Appreciate you coming back on. As always, be well. Also, a reminder, we're going to be showing you live here the latest in terms of Johnson & Johnson with the CEO, Alex Gorski, joining us at 1 p.m. Eastern Time right here on Yahoo Finance. You will not want to miss that interview. The latest from Johnson & Johnson on the rollout of their vaccine. Again, 1 p.m. Eastern Time right here on Yahoo Finance. We're going to take a quick break, and when we return, digging into the SPAC boom now hitting space. The rocket company seeing a deal come through that values it at north of $4 billion. We'll chat with the CEO of Rocket Lab on the other side of the break. Stay with us. Well, SPACs once again are hitting the space industry with Rocket Lab, rocket company Rocket Lab announcing a deal here and merging with Vector Acquisition, a SPAC focused on that endeavor in a deal that values Rocket Lab at $4.1 billion in terms of an enterprise valuation and gives total cash balance now of $750 million once that deal goes through. Importantly, the company has been expanding in both launches on behalf of the government as well as national security payloads. And for more on where this company goes from here as the space race continually heats up, getting very intense right now, joining us is the CEO and founder of Rocket Lab, Peter Beck. Peter, thanks again for taking the time to chat here. I mean, we've seen a lot of different companies now start to really raise some serious cash when it comes to building out efforts in space. But how does maybe Rocket Lab look at this differently in terms of what you guys are focusing in on?
Yeah, absolutely. I mean, I guess, we're super excited to bring a really high quality asset to the public markets and also, partner with Vector Acquisition Corporation, through the SPAC merger to do so. But I think, what's a little bit unique about Rocket Lab, within this industry, there's certainly a lot of ambition and, a lot of, grand events, but a little bit shy in execution. And Rocket Lab has continued to execute over and over again. With the small launch vehicle we developed, Electron, we're the second most frequently launched US vehicle, and actually the fourth most frequently launched rocket in the world. And part of Rocket Lab's and DNA and history is just that solid execution. But not just execution across launch, but also execution across spacecraft. So the really exciting thing about this deal is this really enables us to accelerate that, not just on the launch side, but also on the spacecraft side, and ultimately allow us to create a complete end-to-end platform where customers and service providers can come to us, where we can do complete end-to-end pure play within the space sector.
Let's talk about how you plan to use the capital raised here to use. Of course, many of our viewers familiar with Rocket Lab as a small launch provider, but you've talked about using some of this capital to fund the development of medium lift launch vehicles. What's the growth you see on that front, and is that kind of the direction that Rocket Lab is going in?
Yeah, look, I mean, we've always been good at picking the market niches, and we picked it with small launch and kind of owned that category. And one of the wonderful things about launching such a variety, and we've delivered 97 satellites to orbit for such a variety of customers, is we know their businesses and we know where everybody's going. And if you look at what's actually happening within the industry, over 80% of all the satellites that are going to be launched here in the next decade or so are these mega constellations. But the one thing that's missing in the industry is a launch vehicle to successfully deliver all of those constellations to orbit. Hence the reason why there's a real need in the marketplace for a medium lift launch vehicle to service that.
It's pretty insane to think about kind of the path to profitability here when we're talking about streaming companies still not being able to turn a profit. But you guys have a projection that you'll be EBITDA positive by 2023 after adjustments. Is that more due to maybe the costs falling in terms of your rocket technology and what you guys are able to do, or is it more due to the backlog and maybe pricing power that space companies have here as customers try to tap you guys and others to really get their goals accomplished?
Yeah, I mean, firstly, we have multiple years of revenue. So when we're looking out here, these are backlog customers, and we have a very clear understanding of both the backlog, but also when we model this, we model in not only the back end, but also tops down, and triangulate those together to give us some good confidence in those projections. And like I say, one of the wonderful things about actually launching and doing it so frequently is it can give us strong confidence in those numbers.
And Peter, you talked about what differentiates Rocket Lab from the competition, but when you look overall in the space, there are more than 100 small rocket ventures. I have to wonder if this area is ripe for consolidation. How many of these companies do you think ultimately survive?
Yeah, well, I mean, my personal view here is that there'll be a small group of companies that will survive in small launch and a small group of companies that will survive in the medium to large. And ultimately, I think companies, will consolidate down to being satellite and launch companies. If you take Rocket Lab, for example, we're well known for our small launch vehicle, But we started our space systems division in 2019, and by the end of last year, we got one mission going to the moon this year, 2 missions to Mars, a propellant depot on orbit for NASA. So having both the launch element and also the spacecraft element is hugely important. And as we think about how we grow more in the future, combining those two elements enables us to push into the space applications market. And when I say space applications, that's all the services and data that comes from space to help us down on Earth. And that's where the really large TAMs are. So if you have your own rocket and you have your own spacecraft, then your ability to move into those verticals and be very effective in there is very powerful.
Well, it is fascinating to see the growth and innovation in this space. Peter Beck, founder and CEO of Rocket Lab. It's great to have you on today. Coming up, a setback for the U.S. effort to return to the Iran nuclear deal while violence escalates in Myanmar. We've got our world view on the other side of the break. In today's worldview, Iran has rejected an offer to hold direct talks with the U.S. to revive the 2015 nuclear deal. Iran's foreign ministry saying the time was not right to hold informal discussions, considering, quote, recent actions and statements by the U.S. and 3 European powers. This comes days after President Biden ordered airstrikes against Iranian-backed militias in eastern Syria in retaliation for recent attacks against American allied personnel. Now, Iran has insisted the U.S. lift sanctions before resuming discussions, while Washington maintains Iran needs to be in compliance with the deal first. 18 people killed in Myanmar on Sunday, marking the deadliest day of protest since the military staged a coup last month, ousting former leader Aung San Suu Kyi. The deaths occurred in 3 different cities, and images shared on social media showed streets filled with tear gas and protesters bloodied, signaling police taking an increasingly heavy hand 3 weeks into the demonstrations. Authorities have also imposed nightly internet blackouts and arrested more than 1,000 demonstrators this weekend alone. Protesters are demanding the military coup be reversed and civilian lawmakers return to power. And former French President Nicolas Sarkozy has been convicted of corruption charges, becoming the first French leader to face prison time in post-war history. A Paris court convicted the former leader on charges of influence peddling and corruption. He's accused of attempting to illegally obtain information about an investigation into his campaign finances. Sarkozy was sentenced to 3 years in prison, but the court suspended 2 years of that sentence. He has denied all charges.
All right, well, let's get a check-in on this market rally here as all 3 major indices are seeing substantial gains. The S&P 500 tracking for its best day in about 4 months' time. All 11 sectors in the green being led by energy. For more on that, I want to get to Yahoo Finance's chartmaster, Jared Blickry, with the latest. Jared?
Well, let's get straight to the charts after that intro here. We see all the majors up over 2%, and the Russell 2000 is a big outperformer, up almost 3%. And guess what? The bond market is settling down, and that's a welcome sign because that caused some consternation late last week. Let's take a look at the NASDAQ 100, and here we see Apple up 3.8%. And by the way, all the Apple stores are now open in the U.S. for the first time since the pandemic. Tesla also notably up over 5%, PayPal up 5%. So if you're noticing a pattern here, some of those names that were getting really hammered last week are up today. Moderna, notably the biggest underperformer, that's down about 4%. Let's take a look at the sector action. We got energy just flying high. That's up over 3.5%. That's followed by materials, utilities, industrials, tech, financials, and discretionary. All of those are outperforming. So we have a very broad-based rally at hand. And despite the fact that the yield curve contracting a little bit, check out these bank stocks here. Citi going through a reorganization. You can see that stock is up 4%. And in the upper left, JP Morgan up 1.8%. Also check out Goldman Sachs, very close to another record high if it's not there already, up 3% today and 63% over the last year, although they did just suffer a loss of one of their key asset managers, but not affecting the stock today. Also looking at the cannabis space, there's a lot of green here. We see Canopy Growth, that's up about 6%, Afria up 7%, Tilray is up over 8%. And let's just take a look at the year-to-date action in this stock because it had that incredible run. It was one of those Reddit stocks recently, but still up 220% year-to-date, guys.
Yeah, we saw GameStop catch that second breath. We were wondering if that was going to happen to those cannabis stocks as well, but a positive day pretty much across the board in the market. Jared, appreciate that. We're going to take another quick break here on Yahoo Finance Live, but when we return, breaking down the big boom that one materials company is seeing here, not just from N95 masks, but increasingly manufacturing behind filtration systems. We'll spotlight that. Lidol's president and CEO joins us on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. We're spotlighting a company that is increasingly getting quite the attention here. Today, shares are up more than 10% on the day, and we're not even at noon yet. Lidl has seen sales boom in the pandemic. The materials company initially seeing quite the boost in terms of the materials that were sold in N95 masks, but that's now evolving as sales are booming on the filtration system side of the business as well. Shares in the company are up more than 270% over the last year. And the company recently reported earnings that showed net sales past $210 million, up 9% compared to the year prior. For more on this, I want to bring on the CEO and president of Lidl, Sarah Greenstein, joins us right now. And Sarah, congrats on, I guess, all the work you guys have been doing. Obviously, there's been a lot of effort put into getting PPE equipment out. You guys have played your part in that. But talking about what this looks like now as we approach kind of the 1-year anniversary of this pandemic, and filtration obviously playing a much larger role now too.
Absolutely, Zach. Well, thank you very much for having me on today. And I think, as we were able to announce a strong end to 2020, Lidl was really one of the few companies that was able to emerge from 2020 stronger than we went in. And it was in large part because we were able to rely on the decades of experience that we have in material science expertise and our application engineering capability for very high-end, high-performing specialty filtration that allowed us to very quickly pivot and meet the demand, surging demand for high-quality PPE the world over. But as you mentioned, the ongoing demand for PPE to meet the current needs, as well as replenish the stockpiles around the world that are in desperate need of replenishment, we fully expect to last through 2022. But that demand is really dwarfed by the surging demand for specialty, high-efficiency filtration to meet the needs of stricter, ever-increasing regulations and requirements around the globe for improved indoor and outdoor air quality. And whether here in the United States, all governments across Europe, as well as throughout Asia, governments are working to set higher standards for what indoor and outdoor air quality need to be to protect from whatever comes in a post-COVID world. And Lidl has 150 years of experience that we bring to the table in helping them set those standards and make the material that is needed in order to achieve those standards.
So how big of a demand do you anticipate given the renewed focus on air quality, particularly in offices? What does that picture look like right now for you?
Sure, Kika. So as I talk to CEOs of large global companies that are working to get the buildings around the world to where they need to go, the estimates that they tell me is it's about a $3 billion market just to get people back to work, but it's probably another $15 billion to get all of the buildings to where they need to be to meet these new requirements. And if you just look here in the US, I mean, the CDC has already said that for any government building, they want to require a minimum what's called MERV 13, which is a higher performing filtration efficiency than what exists today. And so we're already seeing that those trends start now. And just as an example, for the schools to reopen in the area where I happen to live, one of the requirements was that they upgrade all their filtration media to a minimum MERV 13. So even before these mandates and policy come into play, you're starting to see the expectations being set for building owners and its inhabitants.
Yeah, it seems like it would be terribly difficult to kind of project what that looks like, right? Because maybe people could say, oh, if we get more vaccines out there, maybe there'd be less of an importance placed on filtration. But I don't know if COVID's the only issue we have to worry about in terms of health out there. When you look at it, though, even if it were to be the case that we maybe see a slower return to the office, what does that maybe look like as you guys have increasingly invested in the production side of the business? Even New Hampshire is now running at capacity, right? I mean, talk to me about maybe the money that you've put into building out more efficient systems to get these products made, regardless of what demand looks like.
Sure. So you talked about, our Q4 results, and I couldn't be prouder of the team, right? I mean, when you look at it over a prior period, our specialty filtration sales was up over 50%, and our enterprise adjusted EBITDA expanded by 42%. And most importantly, we doubled our ending cash balance from 19 to 20, all while investing $40 million across the United States and Europe to triple our capacity for fine fiber melt-blown media, which goes into not only PPE, but also these higher efficiency filtration solutions. Now, the first of 3 new lines is up and running as of mid-January. The other 2 lines will be up and running as of the beginning of third quarter in full production. There's second line going into Rochester, New Hampshire, and the third line into Saint-Rivillon, France. Lidl is a very global company. What's happening as a result of COVID is that countries around the world are purposely ensuring that they have reliable, high quality domestic supply chains of PPE. And so that capacity is fully spoken for as of right now, Zach. But the expectation is that we will transition post 2022 from PPE to these specialty filtration products that we're talking about, which, by the way, are part of our portfolio, right? Pre-COVID, that's what Lidl did and still does. So,
Sarah, I want to go back to what you said earlier about how you think these new building codes are likely to spur the growth in the space already. What do you think those codes are going to look like? It feels like there is a fundamental shift that's happened over the last year about how we look at the space we work in, how we look at the space that students get educated in, the renewed focus on wellness and indoor air quality.
Absolutely. So Lidl, because of our decades of technical expertise, are either at the table as those standards are being set or leading those standards being set from a very deep technical engineering perspective. And so to your point, we know that the higher efficiency filtration solution in a building can help ensure that the air we breathe is safe and healthy. And the higher the efficiency, the healthier that we are. And today we're talking about COVID, but think about what's happened out west just in the United States with wildfires and smoke. I mean, it is not just about the virus, although the virus, to your point, is what's brought it to top of mind for us. And so we're human. We want to gather. We want to be with each other, but we want to be able to be safe as we're doing it. And if you think about masks are the armor against COVID, but eventually we want to be able to go into open spaces and be able to be together and ensure that that space is healthy. And that's what specialty filtration within a building envelope can do for us.
Yeah, I think I second that. A lot of us want to get back into the office. Not sure that's something that we would have said a year ago, but it's certainly been a long road since the pandemic began. Sarah Greenstein, Lidl President and CEO, it's good to talk to you today. Coming up, we're checking in on the meme stocks. AMC Entertainment getting a big pop in the session. Inez Ferre will walk us through the moves on the other side of the break. Welcome back to Yahoo Finance Live. The Dow coming off of its session highs, but still in rally mode. Right now, it is up about 650 points. The Nasdaq up more than 300. Let's bring in Inez Ferre, who is tracking all of the market moves for us. And Inez, I know you've got your eye also on those meme stocks. Not surprising, they're also up when we're seeing sectors across the board firmly in the green.
That's right. They are in the green. I'll get to that in just a second, but I want to show you what's happening right now with the sector action. All 11 sectors of the S&P 500 being in green territory. We've got energy, technology that are leading the gains right now. And every Dow component, you just mentioned the Dow, right now being in green territory, with Apple up more than 4%. You've got Boeing up more than 5%. The banks are doing well as well. And then just taking a look at the NASDAQ 100, where we saw quite a bit of a sell-off last week, the NASDAQ being up around 2.5%. And you can see some of the big cap names, which are in green territory. You've got Tesla up more than 5%. And also just taking a look at Zoom up more than 7% ahead of its earnings. And Mercado Libre, which will also be reporting earnings, up about 4.5%. Those heavily shorted stocks back in action today. You can see the heat map here. GameStop up more than 12%. Remember that GameStop just last Wednesday was trading at around $50 a share before seeing that huge spike. Right now, we're also checking out AMC, which is up about 15%. If we look at a 7-day chart, you can see the big volatility that we've seen in these shorted names. BlackBerry up more than 8%. And then I also want to mention the travel sector, which is in green territory today as well. You've got Royal Caribbean that's slightly off. That's because of a stock offering. But otherwise, you're seeing the reopening stocks also, like the airlines, seeing gains. And of course, those had been seeing gains over the last week, even as the broader markets had been selling off. Akiko, Zach.
All right, thanks so much for that, Inez. We're going to take a quick break here, but coming up in the next hour, much more here on Yahoo Finance Live, including a conversation about central bank digital currencies. Talk of that digital dollar gaining momentum. We'll explain shortly after the break. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. It is risk on in the markets on this Monday as investors move past inflation fears. At least for now, we are seeing the Dow up more than 650 points right now, the Nasdaq up about 350, and the S&P 500 up 88. Energy and the biggest mover of the day by sector, utilities and financials following closely behind. And we have seen the bond yield softening in this session right now after hitting a one-year high last week. Berkshire Hathaway buys back a record amount of company shares as Warren Buffett sees its value dip. We'll break down that move and many more outlined in his annual shareholder letter a little later in the show. And the momentum building for central banks to issue their own digital currency. We'll discuss what this means for the dollar's dominance in just a few minutes. Let's talk about the market moves first, though, with our first guest for the hour. We've got Vanessa Martinez, Managing Director at the Lerner Group. And Vanessa, this seems like a real reversal. If you look at the market moves today, given the jitters we saw last week around rising rates, what do you think is driving the gains today?
I think there's multiple things that are driving it. We've seen J&J come out on Friday saying that they're ready, and the immediate response of 4 million doses, as well as 16 million by the end of March. So I feel that positiveness, the decrease in cases. So I feel overall the market feels that positive reaction, as well as on Saturday we had the 1.9 trillion, the House passed. So now I know we go to the Senate, but I think all of this positive energy, and as you mentioned today, the yields, the rates have gone down from the U.S. Treasury. So I feel those three aspects kind of tied together are what rallying the market now.
Yeah, we were talking about inflation fears earlier in the show, and I wonder how much might be changing when we look at some of the incoming data, the data we got this morning in terms of the ISM numbers running the hottest that they've been in 3 years, and really factory activity picking up quite a bit. Talk to me about maybe how strong the data that you're watching is right now, and maybe how that could be fueling inflation fears, or just maybe fears that the Fed will have to move quicker to maybe tamp. I know they don't want to tamp the growth down, but maybe make sure things are rising the right way.
I think sometimes the fear of the tapering of the Fed, as you mentioned, but there's other options, right? There's the extending of duration, so they could still keep that 120 billion, and expand the balance sheet. So that's a positive thing for us, as well as consumer confidence. So if we look at the retail sales numbers that have come out, we've seen that they're at 5.9 if we exclude auto sales. That's a great number. And we can say it's due to the stimulus of $600 that was given early January, and that seems great. But why is it so much more if we think back towards when the $1,200 check was given in mid-April? It's the consumer confidence. We now see that there's more positive things happening. Back in 2020, we were in the middle of the pandemic, whereas now we kind of see the light. I feel that consumer confidence is what's driving the rallies and what will drive our GDP number up to the expectation of 6 to 6.5%.
You mentioned earlier about some of the factors that have all converged over the weekend, the $1.9 trillion stimulus at least passing the House, the Senate still in question, also the J&J vaccine getting the approval. I mean, the expectations seem to be that a lot of this had already been priced in. What does the rally to you suggest how much more runway there is, especially on this expectation that the U.S. could reach some kind of herd immunity by later in the summer or early in the fall?
That just drives more positive into the market. I know that the stock market is a leading indicator, but I don't feel it's fully priced in. There are some sides of the market that we can see, like big tech, and that's where now it's time for rotation. I definitely believe that investors should look to stay in the market, and it's just about being selective as to what you're choosing to buy. We hear about value names. We're specifically bullish on financials as well as the healthcare sector. There's many healthcare sectors that right now, stocks that are at single-digit PEs. Those are the buys right now.
Vanessa Martinez, Managing Director at the Lerner Group. Good to talk to you on this Monday. Well, proponents of a central bank digital currency got a big boost last week from the Treasury Secretary herself, Janet Yellen, endorsing the idea of a digital dollar when asked about the benefits she sees. Take a listen.
We do have a problem with financial inclusion. Too many Americans really don't have access to easy payment systems and to banking accounts. And I think, this is something that a digital dollar, a central bank digital currency could help with. I think it could result in faster, safer, and cheaper payments.
Treasury Secretary there speaking at the New York Times Deal Book event. Now, Fed Chair Jay Powell weighed in on those comments in his testimony before the Senate, saying we are looking very carefully at the issue of whether we should issue a digital dollar. Let's bring in somebody who's very familiar with this. Josh Lipsky is the director of the Atlantic Council's Geoeconomic Center. Josh, I know you got really excited when you heard these comments. You said it was the firing of a starting gun. Help us understand why this was so significant in the context of a broader conversation that's happening globally among central banks.
Well, thanks, Akiko. Thanks for having this conversation because, I really feel like last week's comments were the firing of a starting gun and the race for the future of money is now on. And that's what the conversation has really been around Washington and Frankfurt and so many places around the world over the past week. The reason is because everyone had been looking for a high-level signal from the Treasury, from the Fed, that they were serious, not just about studying a digital dollar, but actually developing one, deploying one in a pilot, and then expanding it. And China's moving fast ahead on this. They just expanded it to Chengdu, their 5th largest city. They're thinking about the Beijing Olympics coming in a year from now and the rolling out of the digital yuan. So when Secretary Yellen said that, and she was responding to our Atlantic Council report, which also made us excited, we felt finally recognition is coming that this is not just something in the future, this is something for right now.
Josh, there have been more than 70 central banks, I think at last count, that have already started this discussion on central bank digital currency. Why do you think the U.S. has lagged?
Well, it's a great question. As the world's reserve currency, there's a natural hesitancy to do any wholesale changes in how you operate both your monetary and fiscal policy. And that's natural. And to be honest, when I started looking at this issue and others at the Atlantic Council started, there are about 30 countries making some development on CBDCs. And I think the US didn't really see the advantage. But as COVID happened and we saw the need for faster monetary policy and faster fiscal policy, imagine the benefit of delivering something straight to people's phones, a stimulus check, unemployment benefits. The US started realizing how this could be a game changer. So I think it actually took the crisis for the realization to hit that we need another way to think about monetary transfers, and central bank digital currencies could be a way to do this.
Yeah, and it's obviously something that we've seen, as you're pointing out, across the globe. And you're focusing on China, but there's plenty of other spots we could point to. So I'm not sure if firing a starting gun when so many other countries out there fired theirs years ago would be something maybe necessarily to celebrate, but it's a step in the right direction. So talk to me about the timeline then to go from maybe these positive updates we have now to how quickly it would take for some things to actually start in the process of rolling something out.
So you're completely right, Zach. And I think the starting gun is, fired for the West and for the large central banks, for the US, for the Bank of England, for the ECB, those countries that have been moving a little slower. Innovation here has come from Asia, it's come from Africa, and it's the West that's moved slowly. So that's where the firing gun was started. But this is still a multi-year project. The Fed studies this at the Boston Federal Reserve in collaboration with MIT. There has to be a pilot developed, then it has to be tested, then it has to be expanded. So I think the earliest we would see widespread use of a central bank digital currency in the US is probably in a 3-year time frame. And that's the best case scenario. But the key for the US is to not just do it alone. Work with the Europeans, work with the Brits, work with the Canadians, because you want these things to be interoperable. And if all those currencies work together, that's actually a very potent kind of currency game changer. And I think that's some of the promise of what the Secretary was saying last week.
Josh, can you speak to the politics in all of this? I mean, you've talked about how aggressive China has moved. Certainly, there's a lot of concerns about what this means for the dollar's dominance as China continues to try to chip away at that. How should we be looking at that dynamic at play in the context of these CBDCs?
No, this is a great question, because CBDCs are a financial and monetary question. They're also a geopolitical question. And so the way to think about it is, in the near term, a digital yuan is not going to threaten the dominance of the dollar as the world's reserve currency. It's just not. But over the longer term, China is the largest bilateral creditor in the world. Most of their debt for Belt and Road and other reasons is denominated in dollars. So imagine a situation where the Chinese government says, we'd like to denominate our debt in yuan. You can understand why they might want to do that. And by the way, we have a digital yuan that is instantaneous, secure. So now they're changing a lot of the financial flows and the means of international settlement in the global financial system. So is that a near-term threat to the dollar? No. But is that a medium and longer-term challenge about how the dollar works in global financial flows? Yes. And I think that's what people need to start thinking about. And once it starts happening, it's hard to roll it back. So best for the US to get in the game now.
Yeah, that's for sure. And I mean, when you think about it, it might not change things necessarily, as you're pointing out in the short term, but when you look farther out, I mean, you can look at the growth of stablecoins writ large and how much adoption there has been in those here in the US. I mean, a lot of investors out there enjoy kind of having the ease of use on that front. So how much of this do you think is just maybe less looking globally, but even just here in the US, the Fed watching all this play out, the Treasury watching all this play out and saying, well, maybe it would be better for us to maybe start to track some of this stuff and have better insights. I mean, we talk so much about the IRS and crypto. Maybe how much of that could be here as well?
Yeah, no, this is a great question. You know, the Bank of Canada has said this is what people want. And you have to be honest, when a central bank sees a lot of people using private cryptocurrencies, Bitcoin, Ethereum, whatever it is, that makes them a little nervous because now they don't have oversight into all the monetary policy, the money supply in the system. So you can understand the need for central banks to try to develop their own digital currency. But the difference between the US and Canada and England and the ECB is that they have to deal with privacy concerns. Consumers do not want to know how every single transaction they make is spent, and they don't want the federal government watching them. There's a different issue in China. You can understand the advantage to them of having the surveillance state. And so this is why it's so much harder to implement a digital currency in the democratic countries than in other countries. And that's the challenge for the years ahead, not just the technical aspects, but the political, the privacy, and the illicit financial flow aspects as well.
So Josh, outside of China, who are we seeing really move aggressively in this space, and what kind of timeline are we looking at?
Yeah, so Thailand, Singapore, Sweden in the West has done a good job. And Canada actually does a nice job of doing their sort of international testing with other, both wholesale and retail operations. But it's actually Asia where we see the most innovation right now in the digital currency space. And there's now an East Asian digital currency network where countries are working together to see how they would transfer digital currencies between one or the other. So here's what I think is going to happen. I think next year, as I said, the Beijing Olympics is going to be the coming out party for the digital yuan. And all these athletes are going to come over from all over the world. And the Chinese are going to say, oh, you need to download our digital yuan if you want food, if you want to buy any souvenirs. And this is going to be a real challenge for the West in particular. You know, you may not see a physical boycott at those Olympics, but you could see a digital boycott at those Olympics. And that's when I think the digital dollar pilots are going to start coming out here. So I would expect in about 18 months, I hope, I'm optimistic that you might see the first pilots coming out in the US, in Europe, and in England.
Very interesting stuff. Appreciate it. Josh Lipsky, Atlantic Council Geoeconomics Center Director. Thanks again for joining us on that. We're going to take a quick break here on Yahoo Finance Live, but when we return, breaking down the big moves at Warren Buffett's Berkshire about their share buybacks and what he's warning bond investors about. We'll break that all down right after this. Stay with us. Welcome back to Yahoo Finance Live. Of course, over the weekend, we got that annual update from the Oracle of Omaha, Warren Buffett, in his shareholders letter, his annual letter, talking about what he sees ahead in this recovery, why he doesn't think bonds are the spot to be, and if those aren't the spots to be, where he was putting money to work. And increasingly, we have seen share buybacks be part of the strategy at Berkshire. The company bought back around $9 billion worth of shares in Q4. That brought the total in 2020 up to a record $24.7 billion. That number dwarfs just the $5 billion the total spent on buybacks in 2019. So join us now to break down that move and more from Warren Buffett is Larry Cunningham, professor at George Washington University, as well as an author of several books on not just Warren Buffett, but also Berkshire Hathaway. And Professor, appreciate you coming on here. What do you make of maybe why Warren might be putting that money to work in share buybacks? Because we know he generally doesn't really like it when other companies do it, but for him, he sees value in terms of where Berkshire is at now.
Well, thanks. Berkshire is now the elephant in the room, or the elephant at Berkshire. $24 billion is a lot of capital to deploy in any Berkshire investment. So it's particularly notable when he decides to buy Berkshire himself. His criticism is only against those CEOs or boards who repurchase their own stock at prices that are higher than value, because doing that destroys shareholder wealth. He's doing it at a price that he considers below value, considers Berkshire to be a good investment for the continuing stockholder. So it's a wise deployment of capital from that analytical perspective. I think it has the incidental advantage of providing liquidity for those Berkshire shareholders who aren't long-term, who would rather take cash today and leave. And it has a corresponding benefit for the shareholders who want to continue.
Yeah, let me follow up on that. I mean, what is the message that this sends then to those who are in fact shareholders? I mean, Warren Buffett certainly not going against his criticism in the past. To your point, he sort of justified it in a different way for these buybacks. But what's the message that signals to shareholders right now?
Berkshire is a good buy. It's a good investment. And indeed, to that same point, later in the letter, he talks about the different kinds of shareholders at Berkshire, and he distinguishes between the short-term owners who are happy to try to find better uses of their capital, and the long-term permanent holders who are happy just to ride it out. And I think part of the message is that for those who would like to leave, here's a payday. Those who would like to stay, this is a good investment for you.
And Larry, I mean, when we look at it, as a guy who's tracked Warren over the years and really gotten to study kind of his thinking here, what do you make of maybe some of the criticisms of him stepping down in terms of chasing some of those bigger deals? We saw him kind of look back on one of those deals and talk about, maybe in his own words, how he may have overpaid, specifically when it comes to precision cast parts. But when you think about maybe why he might not be wanting to make some of those bigger bets now, how much of that maybe in your eyes stems from just where he's at in his life stage and career?
Well, I don't think it's so much about where he is in his career. He always jokes that he's going to live as long as Methuselah, the biblical character who lived some 800 years. I don't really think he thinks that way. He thinks of Berkshire as being a permanent investment vehicle. So even after he leaves the scene, they'll be hunting for elephants if they can find them. I think the big problem is elevated valuations, which are due to many reasons. There's just oceans of capital out there bidding prices up. Private equity has platoons of people out scouring the marketplace. So those opportunities are just exceedingly scarce. That said, if they find one, you can expect them to pull the trigger.
Yeah, Larry, considering how amazing Warren Buffett looks at his age, I don't think it's a stretch to think he's going to live much longer than we anticipate. What do you make of his comments on bonds specifically? Because you mentioned that valuations are stretched so far when we're talking about the equity space, but that doesn't necessarily come with the argument of now you run to bond yields, even if they have pushed higher over the last week. He says, look, risky loans are not the answer to inadequate interest rates.
That was an insurance man's perspective, if I've ever seen one. It's common for insurance companies to have a portfolio that's meaningfully diversified into bonds. And what he's saying is, at least at the Berkshire insurance companies, that's not a prudent allocation of capital these days. And he put the numbers on there to back it up. And I think it's not a surprise that that's something people in general, investments, no. But I think it was a message to his insurance community that's not how Berkshire is likely to allocate its capital.
And lastly, I mean, for me, we've seen him kind of increasingly move into tech. If you look at Apple being the largest holding there in common stock, and people were kind of maybe surprised when that first happened. But you look at that, it's $31 billion, and he turned that into 120 by the end of the year. So talk to me about maybe the broadening out of what he looks at, and maybe how he's changed as an investor over the years.
I think his circle of competence, that he defines what he knows well, has stayed the same. But what is in it has changed. Apple used to be a novel tech company whose economic future was hard to predict. That's just no longer true. There's an ample track record. There's clear moats or competitive advantages that can be measured. You can come up with a meaningful valuation and then make a prudent investment decision. So I think it's not so much that Warren has changed his approach, but that the characteristics of a company like Apple are much easier to analyze.
Larry Cunningham, Professor, George Washington University. It's good to talk to you today. Appreciate you stopping by.
Thank you.
Coming up, one of the leaders in the cross-border payment space, Wise, undergoing a big rebranding. Could this signal a potential public listing? We'll be speaking to the co-founder and CEO after this short break. From a money transfer service to a leader in cross-border payments, the company previously known as TransferWise has undergone a huge transformation over the last 10 years. Now it's rebranding under a new name, Wise. Let's bring in the co-founder and CEO of Wise, Christo Carmen. And Christo, I don't expect you to come out and say, yes, you are going public, but there's been a lot of speculation about the rebranding and what this means for your future. What prompted all of this?
What prompted our rebranding was really kind of led by our product and the customers. As 10 years ago, we started solving a very simple problem of how do you move money from one country to another without costing it an arm and a leg with your bank and being an unpleasant exercise. Now, 10 years later, we've realized that our customers have asked to be able to receive money internationally, to hold and spend on those clever debit cards. So we ended up building something that's much broader than purely money transfers. It was about the time for our name to catch up with already serving the customers.
Yeah, Christo, it's interesting because Citi was out with a report maybe looking at Bitcoin and how that might serve as an international and global currency here. We know that there are obviously solutions in the crypto space. So for a company like yours, maybe focused on that piece of global commerce, talk to me about what crypto means to Wise as a threat or perhaps, you know, a benefit here, how you play that space and what you're doing on that front.
As a tech company, so we're now moving about $6 billion of different currency, about 80 currencies across international borders every month. So 6 billion going through the Wise network. And we've of course followed the developments on Bitcoin and other cryptocurrencies and tried to figure out if we can make money flows ever faster or cheaper using those technologies. But we haven't. So there is no use case yet for crypto to be a kind of a way to move money cross border or to make it faster or cheaper. I think we're still waiting for these use cases to be.
Christo, to Zach's point, though, do you see this as a disruption? If you think about the base case or the use case for Wise, whether it is transferring money internationally, cross-border payments, it has been about lower cost and efficiency. If you can do that through a cryptocurrency or, to our earlier conversation, a digital dollar, doesn't that disrupt the case for Wise?
I mean, if there was a way how to do it faster and cheaper, we would be the first ones jumping on it. We calculate that our customers save about $1 billion a year just by switching from their bank to using our network. And if there are better ways how to move money, we'd love to take advantage of it. I think what we're seeing so far is, cryptocurrencies have been very interesting asset class for investment and perhaps speculation, but not so much yet a use case for cross-border movements, at least not where countries would like to have Bitcoin or currencies used for that.
Yeah, we're hearing increasingly, even from the New York Attorney General, her stance pretty firmly against crypto writ large and what could go on there, and in terms of some of the fears around crimes and things like that, though I don't know how based those are. When you look at your businesses, though, and what they're seeing on Wise and what they're increasingly turning to you for, what piece of that has maybe seen the largest growth? Because I know you guys are in a few different spots there to help them out. So what are you seeing maybe take off now?
For sure. So especially through the last year as the lockdowns went around the world, we saw that a lot of businesses kind of worked out that it makes no difference anymore if they're selling to a customer on the next street or they're selling to a customer that's in a different country. So we've seen a huge surge in, I guess, businesses going international and kind of realizing that there's an international market for their products. There's an international market for where they can hire people, so running payrolls internationally, and banking really has to kind of catch up with that, and that's where we're helping them, giving them the Wise account where they get local account numbers in 10 countries now, so they can invoice as a local business and do payroll in 80 countries. So that has definitely kind of seen a shift as we've seen in other, I think, payment verticals, is that businesses are just getting more international now.
And Christo, what are you thinking about in terms of the next step for your company? We started the conversation by talking about a lot of speculation around a potential listing within the year. There are so many different ways we have seen companies come to market, especially over the last year, with so many opting for a SPAC. How are you looking at all of the avenues to going public?
You're right in saying there's so much speculation now in the last, I guess, 6 to 9 months that I think there's speculation about every company on the planet going public or going through a SPAC or something like this. To be honest, we're kind of staying clear on the speculations, and I've personally even I think looking less at the markets now in the last year than I was previously, as in it's just enormously distracting to follow what's going on.
Well, Christo, we hope to have you back on if you do, in fact, decide to go for that public listing. Christo Carmen, Wise co-founder and CEO, joining us from London today. Well, let's get back to one of our top stories today. The CDC signing off on J&J's single-shot COVID vaccine, clearing the way for distribution with potential deliveries as soon as tomorrow. Let's bring in Yahoo Finance's Anjali Kamlani, who spoke with the CEO of Johnson & Johnson. In what kind of, we talked about potentially the vaccines being rolled out as soon as tomorrow. What are you hearing from the CEO himself?
That's correct, Akiko. We know that the vaccines are being shipped and rolled out, delivered really as we speak. The CEO told me that they are looking to distribute all 3.9 million doses of the vaccine that they've had in storage on hand, and that from now on they will already be starting production, but that the distribution is likely to be uneven. Health officials saying today from the White House that it really is going to take some time for them to reach that full 20 million due by the end of this month, and likely we're going to see that in the back half of the month as this rolls out. But they got all the regulatory approval they needed over the weekend, starting with Friday, that vote from the FDA advisory panel to recommend for emergency use, followed by the FDA authorizing on Saturday, and then on Sunday, CDC taking care of that. So the checklist is complete and they are ready to do the vaccinations. Of course, health experts are very excited about this because it's one of those, it's the only single dose vaccine out right now, and will provide protection over time for all adults, and also is easy to store. So that means that a larger variety of vaccination sites will be able to use this vaccine.
And Anjali, too, I mean, when we think about the sizes of the orders to get out there, we are approaching kind of the numbers that a lot of Americans would want to see, where you have more than enough. On Johnson & Johnson's front there, though, it seems like they might be coming in below what they initially had contracted out to do. So when you spoke with the CEO here, what was kind of his general takeaway and how we should be looking at that?
It's more of a long-term view. Over time is how, and not just he, but all these other CEOs are looking, where it's not just the week-to-week or month-to-month, but more the long-term commitment that they have committed to and that they will be able to meet. So right now, as it stands, Johnson & Johnson committing 20 million doses by March and 100 million by June. And so that's really around the time where we'll see more vaccinations anyway. We know that the general public isn't really going to get access for a couple of months, and so it falls along the same lines and in time for that to happen. So it looks like all things considered, we'll be getting that. We also know that we have eyes on another vaccine or another couple of vaccines still in the pipeline that could also meet the same timeline. So we're looking at, by the time you and I can get the vaccine, there are going to be many more options, or at least a couple more options out there.
Yeah, and important when we think about this, not just in the U.S., but across the globe, how many other countries out there are also in need as well. Anjali Kamlani, appreciate that. And a reminder, you can catch her full interview with Johnson & Johnson Chairman and CEO Alex Gorsky. That will be airing in just a few moments here, 1 p.m. Eastern time, right here on Yahoo Finance Live. Stay tuned for that full interview coming your way in just about 30 minutes time. We're going to take a quick break here on Yahoo Finance Live, but when we return, breaking down the expectations around Zoom as they step up to report their latest results, as well as a look at another virtual event out there, the Golden Globes. Will break down which streaming service saw the biggest wins in the night. All that right after this. Welcome back to Yahoo Finance Live. Despite the reflation and reopening trade now taking over, Zoom is still rising in today's session as the video conferencing company prepares to report earnings after the bell. I want to break down what investors should be focusing in on and what expectations are out there for Zoom. Let's bring in Yahoo Finance's Emily McCormick with the latest look at that. Emily?
That's right, Zach. We are seeing a rebound rally in shares of Zoom during today's session. They had been one of these stocks badly beaten down last week during the tech sell-off, but again, seeing quite a bit of a boost intraday today. Now, the big question heading into Zoom's earnings results is going to be whether the astronomical growth that the company saw in 2020 can be sustained. Now, already analysts are expecting to see fourth quarter sales and new customers slow down slightly after big surges in early 2020. But the magnitude of deceleration heading into later this year is really the cause for concern and the big question around these results. Now, for context, Zoom grew revenue by well over 300% in each of the last two quarters. And for the fourth quarter ending in January, Zoom sales are expected to grow by another 331% to just over $811 billion. Now, again, that would still be a bit of a deceleration compared to the 367% growth posted for the third quarter. And then taking a look at another closely watched metric, customers with more than 10 employees are expected to rise by 440% to just under 443,000. That's also a bit of a slowdown compared to each of the last two quarters. Now, again, this was a stock that was the company of the year for Yahoo Finance in 2020. Not a stock pick, but again, speaking to the fact that Zoom really had been one of those companies in that work from home trade, had risen by nearly 400% over the course of last year. But already, as we are seeing this rotation into more of these cyclical reopening plays, this is a stock that did underperform for the month of February. And I think a lot because of that hinges on what the company gives, especially for the outlook in tonight's report. Zach and Akiko.
Yeah, we'll see what that guidance comes in at or what they're able to say about what the future looks like for Zoom, but appreciate that update. Emily will be watching after the bell. Meantime, of course, we've all been dealing with some of the awkwardness that could come from some of those Zoom calls or Skypes out there. And that was no different for this year's Golden Globes, as a lot of people were watching the awards being handed out there, suffering with their own issues around some video conferences as well. But some big winners in the streaming space. And for more on who had the best night, I want to bring on Yahoo Finance's Alexandra Canal to break down those details of the Golden Globes. Hey, Ali.
Hi, Zach. And yes, you're right. A very big night for streamers, especially Netflix. Netflix walked away with 10 total wins. They saw a lot of success with both The Queen's Gambit and The Crown. The Queen's Gambit walked home with Best Limited Series. That's usually a category dominated by HBO, Netflix's biggest competitor. But last night, we saw the streamer take home the win. And then The Crown also won for Best TV Series Drama. Other poignant wins for Netflix included the late Chadwick Boseman winning Best Actor for his role in the film Ma Rainey's Black Bottom. His wife accepted the award on his behalf. We also had Aaron Sorkin winning for Best Screenplay for the critically acclaimed The Trial of the Chicago 7. But it wasn't just all about Netflix. We had some other streamers perform very well. You're seeing on your screen there, we had Amazon Prime Video with 3 wins, Hulu with 1 win, and even Apple TV Plus with 1 win. Apple TV Plus is certainly one of those streamers that struggled to keep up, but last night they did see Jason Sudeikis win Best Actor for his role in the Apple TV Plus series Ted Lasso. But going back to Amazon Prime Video, they did very well with the new Borat sequel. That film won Best Motion Picture Comedy, and it's actually the first time a streamer has ever won that category. So a really big deal for Amazon Prime Video, with Sacha Baron Cohen also winning the Best Actor award. But when it came to that final award of the night, Best Motion Picture Drama, that did not go to any streamer. That actually went to Searchlight Pictures' Nomadland. So a very more traditional film distributor. You can stream it on Hulu, but at the end of the day, that's who won that award. So overall, a big time for the streamers. I think it's going to be a good indication for what's to come on the Oscars, which will air on April 25th. I think we're going to see a lot more streamers be nominated, potentially even win. Certainly the Academy has been a little hesitant to embrace these streaming giants, but I think because of the coronavirus pandemic, they really have no choice. And I think that they're going to show up really big at the Oscar ceremony.
Yeah, Ali, I should point out Nomadland, one of my favorites, making history as well in the process with Chloe Zhao winning as female director, first Asian female director to win that award. Handicap the race for us then with the Oscars. We know the streaming giants are going to be big. We saw them pick up a lot of the awards yesterday. How do you handicap the race?
Handicap the race. I mean, there were certainly some snubs and surprises. Mank, which was a Netflix film that had 6 nominations. However, it walked away with absolutely nothing. So I think, I'm not really sure how it's going to go come the Oscars, but I think if this is any indication, it's that these streamers are here to play. They can compete with the big guys. Even in their opening monologue with Tina Fey and Amy Poehler, they were saying how there's not much difference between movies and TV shows anymore, right? At the end of the day, you're not going to a theater right now. You're watching everything from the comfort of your own homes. And I think that's really going to play into the process, the Academy, when they're choosing who wins these awards, because it's a very different year this year. And I think that's going to be reflected in the types of movies that you see on your screen. I also think there's going to be a greater push for diversity. Obviously, the Golden Globes had a lot of scandal heading into this year's award show after the LA Times published a scathing expose against the Hollywood Foreign Press Association. Out of the 87 foreign journalists that ultimately pick who wins the Golden Globes, not one of them is Black. They did address that last night. They had 3 HFPA members actually come on stage and basically say, look, we know this is an issue. We are working to address this. But this is not just a Golden Globes issue. It really affects all of Hollywood. Last year, the Oscars came out and tweaked those eligibility requirements to promote diversity. On Friday, we had Netflix release a first of its kind diversity report, and they even pledged $100 million over the next 5 years to help bridge that diversity gap. So I think you are going to see that be emphasized at the Oscars as well. So there's a lot to look forward to here, and that, again, is airing on April 25th.
Okay, and potentially more awkward Zoom moments to come, right? Which comes with a virtual ceremony every time. Thanks so much for that. Ali Canal there with a breakdown of the Golden Globe Awards from last night. Much more coming up here on Yahoo Finance Live, including a look into Robinhood's future. We're talking about the IPO. That's on the other side of the break. Welcome back to Yahoo Finance Live. We are seeing a rally in the markets right now. The Dow up more than 600 points and the Nasdaq up more than 330. The S&P 500 up about 88. Energy, a big mover today, overall sector by sector. Let's bring in Jared Blickery for the very latest on the market moves. Jared.
Let's check out the charts here because we got the Russell 2000 up almost, actually it just ticked to 3% as I was speaking here. NASDAQ is up 2.5%, S&P 500 and Dow just a little bit less, but everything up over 2% today. And if you want to know what's moving big, that is Apple. This is the best day for Apple, up 4% since December. And you can see, been kind of having a rough go at it lately, but clawing back some of those losses. Hopefully that will continue. Apple still one of the most important stocks. And guess what another important stock is? Tesla. That is up over 5%. So a lot of these names that got beat up a bit last week, seeing some love today. Let's check out the sector action. And as you said, Akiko, energy is up over 3%. Utilities almost up 3%. Financials, materials, industrials, tech, all outperforming. So we have a broad-based rally here. And just looking at the travel section here, a bit of a mixed picture. We started out the day mostly in the green, but we see Royal Caribbean is now sunk into the red for 3%, but the airlines still doing pretty well. United and American each up over 2%. And then just checking in on the banking sector, lots of green there. We see JP Morgan and Bank of America and Wells Fargo each up more than 2%. Citigroup, the leader though, that's up more than 4%. And I was just reading a note that crossed my desk here. Goldman Sachs is restarting its cryptocurrency desk. So Goldman Sachs up 3% here. And we might as well take a look at Bitcoin because Bitcoin flying off of its lows hit about 43,000 over the weekend. But you can see here up 11%, guys.
Yeah, interesting to see that move from Goldman. You think about maybe signals of tops. I wouldn't call that a signal at the top, but I would call it a signal of crypto's resurgence here, finally becoming as firm as we were expecting when we saw prices top, 58,000 a few weeks ago. Jared, when you look at some of these beaten down names that you were talking about, though, that was also a highlight of a note from Goldman, looking at some of those non-profitable tech stocks getting beat down pretty tough here, 15% sell-off when you look at 2020, despite that 230% increase in, the start of 2020 and 2021 versus the 230% increase back in 2020. And that's largely been the theme here. Those non-profitable tech stocks, you can look at Uber in that basket as well as some of the other ones out there. I mean, what do we make of kind of how fast we saw the yield on the 10-year rise and how that coming back down doesn't necessarily mean that fear is over just because we see it back down to 1.42. It could go back up. So what do you make of maybe the jitters we're seeing play out?
Yeah, I think, and let's take a look at the 10-year T-note yield since that's what we're talking about. I think the big spike that we saw last Thursday really disrupted a lot of trading desks, but I think that's pretty much done. 1.5% is a big level. It's kind of being respected right now. If you take a 2-year look at the 10-year, you can see we are still at or near the highest levels in about 13 months, but this is a level about 1.5% again that has been in play for a long time. So I think we'll pull back a bit, and I don't think we have to worry about yields until we get up until 2%, say in the 10-year. But you're absolutely right about all these unprofitable companies. I mean, you can take a look at the Russell 2000 or the Russell 3000, where a shockingly high percentage are zombie companies. That's their earnings don't even cover their ability to repay their debt, the interest payments. So not the best, not the most tenable situation for the future when yields eventually do rise, assuming that happens again. But for the time being, probably in the clear. And it's worth mentioning too that these first 2 weeks of March here are the best, or actually the second best 2 weeks of the year, according to seasonality. So might be setting up for a nice run in early March.
And Jared, we can't do a market segment, right, without talking about some of these meme stocks. And we are seeing a pop there. GameStop up 9%, AMC up more than 10%. Pretty relative when you consider the swings that we have seen. But is this just part of the broader market rally we're seeing, or are we seeing some headlines around these moves?
I was seeing some headlines around GameStop, and it's hard to know what exactly is moving these stocks. You got to imagine hedge funds are gaming these things too, no pun intended. It's just a very volatile stock. There's not a huge float on it, and it's just ripe for big price movements. And I think that's what we're seeing here. But you take a look at all of the stocks in our basket. This was a pretty red board last week. So it could be that the market in general is kind of it's a rising tide that lifts all boats. But notably, when we mentioned this before in the last hour, cannabis is doing pretty well. And let's take a look at that heat map. So basically, the money flows are going back to where they have been traditionally throughout the rally since November. But we'll have to see if this continues, especially given that new spate of volatility that we've seen in the bond market.
And Jared, a story that we saw break late Friday, Bloomberg reporting that Robinhood is planning to file for an IPO as soon as March. Bloomberg saying the firm has held talks in the past weeks with underwriters. Of course, there was that Reuters report last year that Robinhood had picked Goldman Sachs as they look to a public listing. That was all before the retail trading frenzy. I'm curious what you make of the announcement here. On the one hand, you could argue this is a name that retail traders are very familiar with. But of course, they're under investigation from the SEC. We had the most recent hearing among lawmakers. What do you make of Robinhood's prospects if they do, in fact, move forward on this?
Yeah, Kiko, I got to tell you, I was really surprised. I thought this IPO was DOA for 2021. They face huge regulatory hurdles here. As you said, they're being investigated by the SEC, maybe the DOJ. They got investor lawsuits, and you got to imagine their risk factors. It's not going to look pretty. But nevertheless, the SEC's attitude is if you can disclose it, that's usually good enough for them and could be coming to market. I think it really tells you that these guys are pretty tied into Wall Street here, and there's a lot of excitement over this. It's going to be a big company. It is a big company. It's going to come to market. If it does in March, and as I said, a little bit surprised that they're doing it this soon, but maybe they see the all clear here. And don't forget, we still got another Senate hearing, and Vlad's probably going to be front and center in that one too.
Yeah, I would add to that too, Kiko. When we look at it, a lot of times you see companies maybe rethink IPO plans when they see their businesses disrupted, and the underlying metrics that we keep looking at, or that Robinhood keeps stressing, is that they continue to gain users despite all of this and all the frustrations we've heard from clients out there who were blocked from buying some of these stocks. Didn't necessarily abandon the platform in large amounts. So, I mean, if you think about the business case to something like a Robinhood, there is the old adage, any press is good press. And it's all we were talking about. It's all anybody was talking about for quite some time, right? Robinhood and Robinhood traders. And so I think there is a case to be made here that there is now, a lot of recognition that what they've been able to do and bring in these retail investors, and particularly younger first-time investors, there is some, long-term gains to be made there if you're able to show that you're still doing that as a company despite that controversy. And when you look at some of the data there, that does seem to be the case. So no need to maybe hit pause on those IPO plans.
Yeah, Zach, when you look at the growth for the platform, that certainly hasn't changed. And to your point, they have been able to attract new users. There's got to be a lot of questions about the financials, though, right? If you think about what happened at the height of the GameStop trade, Vlad Tenev has now said in that testimony before congressional lawmakers that the company didn't have the money and need to put aside for collateral, and that's why they drew down their credit lines. They raised $3.5 billion overnight. Jared, I wonder how potential investors look at something like that to say, sure, they have a huge runway in terms of growth, but can this company handle some of the volatility that comes with it? And what does that say about the way the company is run if they had a liquidity crisis at the height of these retail swings that we saw in recent months?
Yeah. Well, we typically see these cataclysmic events that coincide with these unfortunate moments. They go hand in hand. I think it really speaks to the fact that they were able to meet their own margin calls. The Depository Trust Clearing Corporation said you got to come up with more cash. $3 billion, not easy to do on a moment's notice, but they were able to do it. And it was very telling at the hearing in front of the House that they were very close to being on the brink of insolvency, and it would have been a disaster. They admitted that. So I think Wall Street has confidence in this, and it's probably why this is going forward. Maybe the worst of the regulatory and legal hurdles are kind of, if not past them, at least we have a clear picture of where they are. But good for them. We'll have to see if it comes to market, and maybe they'll be selling it on their own app.
And we can talk a lot more about it in the weeks ahead. Thanks so much for that, Jared. Before we go, let's do a quick check of the markets because we have seen the risk on sentiment return, at least for this session, after some of the jitters in the market last week. The Dow is up 600 points, coming off of the session highs, but still well above where they traded last week. The Nasdaq up 335 points. The S&P 500 up 85. Let's take a look at some of the biggest movers right now. We are seeing Boeing, Dow Inc., and Apple, the biggest movers in the Dow. Much more coming up here on Yahoo Finance Live, including a conversation with the CEO of Johnson & Johnson on the back of that approval from the FDA for their COVID vaccine. That does it for Zach and I here in the 2 hours. Much more on the other side of the break coming up here on Yahoo Finance Live.
Welcome into the 1 p.m. hour here at Yahoo Finance Live. Let's go to the stories we are watching today. Up first, stocks right now are rallying after a late February sell-off caused by rising rates. The 10-year yield had soared to a 12-month high. You could see there down about 0.5 percentage point. Second up, all eyes are now on the Senate to pass their version of Biden's $1.9 trillion stimulus package. Their bill, however, will be different. Namely, it won't include a minimum wage hike to $15. And more good news in the coronavirus pandemic. Johnson & Johnson's single dose of their coronavirus vaccine received federal approval. We'll be hearing from the CEO later in today's show. Johnson & Johnson right now up about 0.6 percentage point. But let's start with today's market action. We have Gareth Soloway, President and CFO of InTheMoneyStocks.com, here with us now. Gareth, always great chatting with you. So Let's talk with what we're seeing today as the markets right now are rallying. The Dow up roughly 600 points right now. Now, we saw tech getting hit pretty hard in that sell-off. The Nasdaq, of course, is recovering up about 2.5 percentage points right now. Wondering if you think we're going to see some of those investors, come roaring back into tech, or do you think we're going to see tech continue to be held under pressure throughout the year?
I think in the beginning here of the month, you're going to see some money flow come back in. Yields probably continue to fade a little bit before their next leg up. You had such a mega spike last week. So again, just coming back off of that is giving tech investors a little bit of calm. In addition, the first of the month, it's important to remember that the first of the month, you see new money flow, whether it's into 401ks or investors that got paid at the end of the month, putting money into the market. We know that last week, 80 billion went into ETFs from average investors. So I continue to think that the first few days of this month, likely a little bit stronger for the tech side of things.
So Lynn, let's talk about some of those yields. You were hinting at it just a second ago. I'm wondering how much you think that they're going to continue to present a headwind or a risk to equities this year.
I think it's going to be the main risk to equities, that coupled with inflation, which is obviously part of it. So you're going to look for yields to just in the short term pull back after such a meteoric rise. But if you look at where we were on yields pre-COVID, you have to get towards that 2% marker to get back to where everything else is in alignment. So whether it's a week from now or a couple weeks from now, I do expect yields to push back above 5%. And that's going to continue to put pressure on technology. There's no doubt about it that valuations for technology stocks will have to come in if yields continue to go higher.
So then to that point, as I had mentioned, we saw this rotation out of tech. I'm wondering what other kind of rotations you think that we might be seeing throughout this year. And if tech continues to remain under pressure, where can investors, if they are looking at that tech space, find some gains?
Yeah, so it's definitely hard right now to find some good return assets. But I do think that gold is presenting itself as an interesting opportunity down here. 1750 on spot, generally in that vicinity right now, a little bit below. So I think gold is an interesting level where I think once inflation really shows itself in the next few months to the next 6 months, you're going to see gold outperform. In addition, value stocks, stocks that present a good PE ratio with also a high dividend, those are the ones where investors will kind of head to, which has been the common theme for what most people have been saying lately.
And of course, gold right now, as you mentioned, a little bit below 1750. It's about 1725 right now. Of course, we had seen gold surging higher than 2000 not too long ago. So if you are an investor, Gareth, that's really concerned about these higher rates, how should you be positioning your portfolio to really mitigate against some of those risks? We did see in a note from Goldman Sachs that investors, they say, should be boosting exposure to short-term stocks.
Yeah, so I think that if you're looking at investing in the tech sector, look for the best of breed, the Apples, the Googles, stocks that are going to continually accumulate good profits and have generally low PE ratios. And then I think you want to look at stocks like Kraft Heinz. That's been really starting to perform well recently, but has way down from its multi-year highs. AT&T is an interesting one, although their debt is a little concerning. But I think, again, that they can probably right that ship if they sell portions of their assets off. Stuff like that would be really interesting, along with, like I said, gold and even Bitcoin. If it pulled back enough, I would start to get interested in because of my worries about inflation in the future.
Well, then what is your overview of the markets in 2021? I think most folks continue to hold this bullish view of equities. What are you anticipating this year?
So I'm not as bullish as most of the average investors. In fact, the fact that the average investor money flow has been so strong, I liken that to previous major tops in the market. I don't mean to be a Debbie Downer here and kind of talk about the negatives here, but the SPACs, you could just name so many issues, the crazy runs in EV stocks and GameStop and those type of names. Those are concerning things because of how they mimic major tops in previous markets. So for me, again, it's more on the short side of the market right now, looking to accumulate more shorts and also pick up quality value stocks, gold, things like that. I do worry that in the second half of the year, inflation is not going to come down as much as the Fed thinks. And I worry that once this initial reopening surge abates, you're going to see something more along the lines of stagflation in 2022. In fact, I think that term will start to be used even as early as late 2021. And that's the boogeyman for the stock market. That is not a good thing for the stock market.
Okay, so then you were mentioning some of those Reddit trades, right? And we have seen a fair bit of volatility in the markets lately around those Reddit trades. We've seen it around cryptocurrency just over the last, couple of weeks. How much volatility then do you think that the markets are going to be going through this year?
I think over the next few months, it's going to be a lot of wild chops. So you're going to have these surges in yields where the stock market is going to take big pops and big drops, and then it's going to bounce back as yields pull back and investors will gain confidence over the reopening trade. My worry is in the second half of the year, once we kind of get to this, reopening and we see these great economic numbers coming out, what comes next? And that's where I worry that things will start to slow down just a little bit. And then you have to relook and say, okay, well, where are yields? Where's inflation? Are yields going to continue to go up because of inflation? Is that going to put pressure on the Fed to actually kind of curb their easy money policy? And if they don't do that, do we see, inflation getting to the point where it really does hurt valuations on stocks in the short term?
Okay, so that actually makes me think about this next question, which is stimulus. It's something that we kind of have been talking about, obviously quite a bit, but there's been a lot of will they, won't they when it comes to Congress. How much of a catalyst do you think stimulus is going to present to the upside if the Senate does pass this bill in the coming days? And then just looking out even to the second half of the year, as you were a little bit mentioning, what do you think is going to present some of the biggest catalysts to the upside for the markets there once they start searching for something to send them higher?
Yeah, and that's the great point, is that the market has really built in this reopening trade in terms of valuations where they're already anticipating this robust reopening, which I do think will happen. I mean, people, even myself, I want to get out there. I want to do fun things. I want to travel. But it's what comes next because that valuation is already mostly in the markets. And with this stimulus, this is the crazy thing about stimulus. Prior to yields going up, stimulus was a net 100% positive for the market. Now it's kind of a positive and negative because the more stimulus we get, yes, it puts money in people's pockets that they'll spend. But then on the other side of the coin, it's going to push rates higher as well, which then takes away from stock market valuation, especially in technology. So there's a double-edged sword here. And I do worry that, again, that late second half of the year could present an issue for what's the catalyst to continue to push us up? What pushes the valuations on stocks even higher than they are where they currently sit?
Do you think that we could see markets going to some kind of correction territory in the second half of the year?
I do. I even think it could happen sooner if yields get to 2%. I do think that the question of whether the Fed has ultimately done this market a service versus hurting it in the long term is going to be raised. I do worry that what they have done has created systemic and long-term issues that are not as easy to fix as we all hope they are. And everyone just believes in the Federal Reserve that they can cure every ill of this market. That's almost a negative because it makes the market think that nothing can ever take it down, which puts small investors in the position of putting all their money in, using record levels of margin. All these things, again, are issues that if they unwind could be very rough for the markets.
And that could be a whole separate topic of conversation. Gareth Soloway, President and CFO in themoneystocks.com. As always, a pleasure to chat with you today. And coming up, we'll be hearing from Johnson & Johnson CEO Alex Gorsky. That's next. Welcome back to Yahoo Finance Live. Johnson & Johnson's single-dose coronavirus vaccine received emergency use authorization, and our very own Yahoo Finance's Anjali Khemlani chatted with Johnson & Johnson CEO Alex Gorsky, and she's here now to tell us about that conversation. Hi, Anjali.
Hey, Kristen. Yeah, so of course, really exciting news for the company, but a lot more in that for really the rest of the country. We know that that single dose vaccine, normal refrigeration temperatures is something that, everyone's been waiting for. Health experts have their hopes pinned on this being a lot easier to get to some of those hard hit areas and hard to reach areas that other vaccines that require really, specific holding temperatures to get through. So listen to what CEO Alex Gorsky had to say about the rollout as well as the future of this new vaccine platform.
This started more than 13 months ago when we got the initial genetic information. Of course, we spent last year and this year doing the clinical trials, getting all of the data that was going to be necessary. And when we heard the FDA's the independent advisory committee on Friday give a thumbs up and unanimous vote for our vaccine, we couldn't be more thrilled and humbled. And then, of course, just yesterday, the CDC and their advisory committee also gave us a thumbs up. And so literally trucks are rolling as we speak. We hope to have 4 million doses, actually 3.9 million doses out over the next 24 to 48 hours here in the United States. We expect to have 20 million doses by the end of March, and we expect to have up to 100 million doses by June of this year on a goal towards having almost 1 billion by the end of 2021. So we're excited, we're committed, and we're doing everything we can to make sure we deliver on those things.
And I know that the company has really stuck to the idea of this is the time of pandemic and you really need to roll these out at a low cost. So moving forward, do you see the market growing for COVID vaccines as an annual thing?
Well, look, it depends. It's going to depend a lot on what happens with the underlying biology, with the virus, and how it continues to evolve. But I can tell you one thing: at J&J, we're definitely vested in vaccines for the long term. We're really encouraged by the data that we've been able to produce with this particular vaccine. And I mentioned to you the kind of volumes that we're talking about this year, well into next year. We're already working on other potential applications with additional variants. And we're also looking at vaccines not only for COVID-19, but also for other areas in our portfolio, potentially one day in cancer, potentially one day in Alzheimer's disease. So we think there'll be a lot of application for this, and it's important to do for patients and healthcare systems, but we think it'll also represent a very important business opportunity long-term as well.
I'd love to take a moment to reflect from, going back to the start of it to now. The vaccine race globally has been so well covered. And I think the way that the company moved forward was a little bit unexpected. Some other companies had setbacks and you moved ahead in the race a little bit, so to speak. Did you imagine the market to be as it is right now with sort of more demand for the product when you're ready to roll out?
Well, look, having been in this industry for more than 30 years, we know that there are always challenges when you're talking about new science and new technology, and there's never a linear shot necessarily. But we try to be very methodical. And from the very beginning, as we considered what kind of a vaccine we ultimately wanted to produce, we said, look, how do we prioritize safety? Hence, we used a platform that had already been used in more than 100,000 patients for things like Ebola, things like HIV in Africa and other places. So we knew we had a safe platform. We knew we had to prove effectiveness. And our early preclinical data was very encouraging. When we did our initial trials with 1,000 patients, it actually corroborated those results. And of course, when we saw the results recently out of our phase 3 trial in over 40,000 patients, it really told us that we have an effective as well as a safe platform. Finally, we knew that it was going to be important to try to do it in one dose because the logistics, the administrative challenges of having 2 doses or having significant refrigeration could also get in the way of access. And last but not least, and went to one of your earlier points, to do it on a not-for-profit basis because we didn't want cost, we didn't want price to get into the way. We felt that that was the way to be the most comprehensive, holistic approach, not only here in the United States, but let alone around the world.
But on that point, you are studying the shot in 2 doses. What do you expect to come from that? And how do you plan to communicate if we do end up needing 2 doses?
Well, from the very beginning, we've been absolutely committed to developing a very robust data set and then to be very transparent with it. In fact, I work with many of our other CEO colleagues in making an explicit statement committing to transparency in the data and the review process. Now, in our case, we're very pleased to see the results that we did on this trial. I mean, to see 85% effectiveness in severe disease, knowing that our trials were conducted around the world, where 15% of the patients in the trial were in South Africa, 90% of who developed the disease had the South African variant. Another 40% of the patients in our trial were in Latin America with another variant, the P2 variant. So to see 85% response in severe disease, to keep 100% thus far patients out of the hospital and from dying, even with these most virulent, most difficult strains, is really important to understand in terms of the overall efficacy profile. Because ultimately, what does a patient or a family look for? They don't want to go to the hospital. We have to keep our hospital systems free. Number 2, they certainly don't want to die. And so it's up to us to continue to educate. At the same time, we're saying, look, as things develop, there could be things that we learn. So we're also looking at a 2-dose to say, is it more effective? Would it have a similar effectiveness? And then how do we weigh those against all these other issues? And we'll have an extensive education and distribution program around that as well.
And looking at, the idea of having to respond to even more need, and if we do end up needing this on an annual basis, what are you thinking about internally about processes to develop and manufacture them? Because I know you're working with some partners, and you're a relatively large company compared to some of the other players that have had to really expand. What has been the investment so far, and what do you plan to do to keep this on a regular basis?
Well, look, we're doing this for the long run. Because we realize that this virus isn't going to go away overnight. And so with that in mind, how do we ensure that not only the scientific capabilities that we've been able to demonstrate in getting to this point with approval, but also the manufacturing processes? So we built an extensive network of internal, external partners, some in the United States, some in Europe, as well as other parts of the world. We want to make sure that we've got a resilient, durable network that allows us to get vaccines out in broad numbers. So in addition to the 100 million that we talked about here in the United States in the first half, we have contracts for several hundred million in Europe and many of the surrounding countries. We are committed to getting doses available to the developing markets around the world as well, because we all know that we as a globe are not safe until everyone is safe with the vaccine. And so we're committed to this. And again, as part of our long-term strategic plan of how do we ensure that we're applying the same vaccine technology, not only here, but even more robustly in other areas of our portfolio.
Moving forward, we know that we're dealing with the variants at the same time, and you also have the vector that you're using, the adenovirus vector. There have been some questions about whether or not a follow-up shot would reduce efficacy because of the protection that's built up. Do you see any conflict there? I'm sure that's something that you're looking at in this second dose study.
No, we don't thus far. And based upon the extensive experience we've had previously, again, in things like Ebola, HIV, and other areas, the confidence that we have in the safety of the platform, the durability of the platform is significant. We haven't seen the kind of immune responses that you can sometimes see in these kind of approaches. And again, it gives us great confidence going forward as well. So, and on top of that, we're also seeing very robust responses at the antibody level, but also at what we know as the T and the B cell. So think of that as like the second and third phase response that really leads to a longer lasting and a more permanent kind of effect from these vaccines. So we still have to gather more data before we can draw firm conclusions. But thus far, we're very encouraged about the data that we're seeing directly related to the AdVac 26 platform.
So as you can hear, a lot going on. Of course, the company, being a large global company, is also focusing on delivering doses elsewhere, but definitely a lot more promising news hopefully to come, and experts really excited about this specific platform. Kristen.
And Johnson & Johnson up about 0.75 percentage point right now. Yahoo Finance's Anjali Khemlani, thanks so much for bringing us that interview. And for everyone at home, that full interview can be watched at yahoofinance.com. And coming up, we will be continuing our conversation on the coronavirus pandemic. That's next. Welcome back to Yahoo Finance Live. Let's continue with more on the coronavirus pandemic. We're joined now by Dr. Dana Hawkinson. He's an infectious disease doctor and medical director of infection prevention and control for the University of Kansas Health System. That is a mouthful, doctor. So let's start with this news on Johnson & Johnson. We were, of course, just hearing from the CEO, Alex Gorsky. How much is Johnson & Johnson's single-dose vaccine receiving this emergency use authorization from the FDA really a game changer as you see it in this pandemic?
Yeah, I think it's going to help, a lot. We've talked about supply issues. We know there's supply with the first two vaccines that were EUA, emergency use authorized. We know there were supply issues. This is going to add one more piece to our armamentarium for prevention, and that's the vaccine. And we heard him speak about how many they're expecting right now and in the future. This is going to help because we need the vaccines, but more importantly, we need the vaccines to get into arms. And we know that there are some storage issues with the mRNA vaccines in the cold storage and whatnot. This will help because it will also give us the ability to get these vaccines to other places that don't have the ability to store those. So I think it will be a game changer. Also, the fact that it's one dose. We know that some people are already not maybe going back for their second dose and don't understand that with Moderna and Pfizer, you need to get the second doses. This is going to help a great deal. People can go, once it's available at their clinics, at other pharmacies, go get a single dose. And, within 12 days to 14 days, they're going to have full protection.
Okay, but how much should folks be concerned? About the differing, efficacy rates of some of these vaccines. This Johnson & Johnson vaccine, a little bit over 70%. When you have the Pfizer and Moderna vaccines, over 90%. If you are in the doctor's office and the doctor says, hey, we have this J&J vaccine for you, should folks, or do you anticipate a lot of folks out there will say, no, I really want to take the Pfizer vaccine, or I want to take the Moderna vaccine?
Yeah, I think there is some, even between Moderna and Pfizer, we have seen that with people. Should I wait and get one of those vaccines over the other? And now if we're going to have two different platforms, but I think the main thing that we need to continue to message is that if you look at the data, again, the studies for these vaccines were different. So you really can't compare apples to apples. There is a different platform as well, so you can't compare those. The studies for Moderna and Pfizer were meant to look at 2 doses. So we really don't want to draw a lot of conclusions for a single dose. The study for Johnson & Johnson was for 1 dose, so we use that data. But I think it's important to understand what is the main point of all of these vaccines, and we heard him talk about it on the earlier segment. It protects you against severe and critical disease. It protects you from going to the hospital, and most importantly, it protects you from death. And that's what all of these vaccines do so far in all of the data. And so that's the important thing to remember. If you have a chance to get any one of those vaccines, do not throw away that chance and go ahead and get the vaccine, because the most important thing we're looking at is really trying to stop severe critical disease and death. And all of these do that with high efficiency.
I'm wondering about the mutations and some of the variations. We've heard a lot of the pharmaceutical companies say that, they're potentially tweaking some of their vaccines to really adjust for that. We're starting to really pay a lot more attention, at least when it comes to testing for some of these variants. How much do these mutations, these new strains of the virus, remain a concern, in this fight against the coronavirus?
Yeah, understanding RNA viruses like HIV, like this coronavirus, we understand that there are going to be variations, variants, mutations. We know those are going to happen. Those just happen in the real world. As you continue to have more and more infections and thereby have more and more viral replications, those variants can come up at a larger or quicker pace. But we don't know the full extent of those variants, and we don't know the full extent of the variants we haven't even identified yet. What we do know is that with these vaccines, they really do target the spike protein. And on that spike protein, there are about 20 different areas to which we make an immune response. The most important being probably the receptor that actually are the end of the spike that binds with the receptor on our bodies. But we can still elicit immune responses by other pieces on that spike. And we know, and we heard before too, that we are able to see real world experience even in South Africa, for which 90+% of the people in those trials had the South African variant, the B1.351. But we still were able to see a significant reduction in severe critical disease as well as death. So right now, it doesn't appear to be too important, but it's something that many people are always keeping an eye on, and we will continue to evaluate that. And the vaccine makers and the drug makers will continue to evaluate those.
As you see it, Doctor, what really is the biggest threat to us coming out of the other side of this pandemic right now?
I don't think it's one thing. I think we have, come over a hill. I think it's looking good from what we can see based on the recent data showing a decrease in the number of cases, although recently it has kind of turned around and started to plateau and maybe have increased. But also now we have more vaccine. And if we can continue to get those vaccines out into the arms of the people, especially the most vulnerable in our population, we can then reduce viral replication. We know that in real world studies, as you've seen with the Pfizer vaccine and the Israeli publication, but also some of the early or addendum data from the Johnson & Johnson vaccine showing that it actually does seem to reduce asymptomatic disease. So thereby, we hope that it reduces spread. And that's the ultimate goal, is to really reduce the spread of this virus. And so far, these vaccines look like they do actually help reduce the spread as well.
Dr. Dana Hawkinson, Medical Director of Infection Prevention and Control for the University of Kansas Health System. Thanks so much for bringing us all of those updates. And coming up, Warren Buffett's annual letter to shareholders is out. We will be breaking it down next. Welcome back to Yahoo Finance Live. Well, the Oracle of Omaha has issued his annual letter to shareholders, and the letter disclosed some of Berkshire's top holdings, which includes the electric car maker BYD and also Yahoo Finance's parent company, Verizon. The letter also reminded everyone to never bet against America. We have Jonathan Boyar here with us to break it down. Jonathan is principal and portfolio manager at Boyar Asset Management. So, Jonathan, we have the letter. I'm wondering what some of your biggest takeaways were from it.
First, thank you for having me on the show. It was an interesting letter, but I mean, I think a lot of people probably expected too much out of the letter for him to express societal, view on what's happened over the past year in terms of politics, et cetera. I mean, I think that's not his style, but I thought it was, I was happy to see that he's committed to buying back shares at the right prices. Clearly, I don't think there was any major revelations. It would have been nice to hear his thoughts on a potential dividend at some point in time, but I think under his regime, that's not necessarily realistic.
Now, I was surprised, kind of coming back to this point about folks expecting perhaps a little bit too much out of him this year. I think that's kind of the theme in general after 2020. A lot of folks are expecting a lot out of a lot of people and out of a lot of companies after the year we had. And I was surprised to see that there wasn't too much reminiscing really over the year of 2020 and of the difficulties or perhaps even some business decisions that could have been made in the face of 2020. Were you surprised to see that as well?
In terms of the business decisions, absolutely. I mean, Warren Buffett, there's no second guessing Warren Buffett. He's the greatest investor of all time. Everyone makes mistakes. And with the benefit of hindsight, obviously, he should have been more aggressive buying common stocks in March, April, May, June this year. Obviously,
Right.
that's with the benefit of hindsight. I would have loved to have kind of just heard his thoughts on why he wasn't, because he has such a big cash hoard. Why wasn't he more aggressive? There were plenty of big cap stocks for him to have bought that could have moved the needle, and I just would have loved to hear his reasoning behind it.
Was there anything that surprised you out of this letter? The letter wasn't, full of too many surprises, but I'm wondering if there was anything that really leapt out at you.
I think that was probably it. It wasn't a surprise that he didn't talk about the dividend. I think he's way too tax sensitive to, initiate one. Although I think it probably would have been the right thing to do. So no, there was no major surprises. I mean, except for the annual meeting being held virtually in Los Angeles, but that doesn't really affect very many people. So it was pretty much status quo. But I would have liked to hear kind of his thoughts on where we go from here, especially with a potential rising interest rate environment. How do investors react to that? I mean, there's a lot. I mean, he's always been very generous with his investment wisdom, and is an educator and a teacher. And it would have been nice to have a little bit more of that. But he's given us a lot through the years, so it's really hard to complain.
I want to drill down into some of those holdings in the letter. BYD kind of stuck out at me, the electric car maker. We were talking a little bit earlier with Gareth Soloway, and he kind of raised a little bit of an alarm, or at least a little bit of a flag, because the EV space in general is one that has seen huge run-ups and then also taken some pretty big legs lower. I was wondering what you made of that holding.
Well, I don't know the size of the holding relative, the exact size, but it's, my guess, pretty small relative to the entire, market value or the equity portfolio at Berkshire. So I wouldn't read into any individual holdings too much per se. But he's certainly gotten out of his comfort zone with Snowflake, Amazon, Apple in the past couple of years. So it's not terribly surprising that electric vehicles are on his on his mind, and it's certainly a theme to invest in. I don't know that much about that individual company to speak intelligently about it.
Just for everyone at home, I just pulled up the letter now. Berkshire does own 8.2% of the company. And of course, I think a lot of folks are going to be looking at it since there's a huge battle going on in the electric vehicle space, of course, with companies like Tesla and NIO as well. I wanted to ask you as well about one other thing, which is the lack of details around succession. We do have Warren Buffett, Charlie Munger getting on in years, and I think a lot of folks are looking to see what is going to be coming in the next couple of years, and yet a lot of we got no details on that point there.
Well, you had a little bit of a hint of a detail. He said that the lady from Nebraska Furniture Mart retired early at 103, so maybe that's a hint on how long he intends to stay. And, it's a board decision about succession. He doesn't need to telegraph his hand. And I'm not so worried. I mean, I think what Warren Buffett has done, and as well as Charlie Munger, is create a company that is so strong and so good that it can run without him. And that's not that they don't need capable management going forward, but I don't think it's it should be a central theme. There'll never be another Warren Buffett. What he did is absolutely extraordinary. But what he's done is create a company that might not have one CEO running everything. It might be in different divisions, et cetera. But I don't think investors really should be as focused on that as what capital allocation will be like going forward.
Yeah, to that point, Mrs. B retired at 103, and in the letter, He said, as judged by him and Charlie, that was a, quote, ridiculously premature age, 103 years old. Jonathan Boyer, principal and portfolio manager at Boyer Asset Management, thanks so much for joining us. And coming up, the Senate is under pressure after the House passed Biden's stimulus bill. We'll be talking about it next. Welcome back to Yahoo Finance Live. Checking market action right now. All three major indices are in the green as markets are rallying after that sell-off we had seen to end the month of February. The Dow right now, as you can see, up over 650 points. The Nasdaq also making a nice recovery there, up over 2.5% after we had seen a sell-off in some of the tech stocks. Now, equities had been held under pressure by that 10-year bond yield, well, rising yields across the board. So let's take a look over at that 10-year yield. Down right now in the red, down over 0.5 percentage point. It's reached a level of 1.5%. It had reached a high that we hadn't seen in 12 months of over 1.5%. Want to take a look over on a sector basis. We have financials right now leading up 3.25 percentage point. We have real estate right now, the laggard, also in the green, however, up about 0.9 percentage point. Now, over the weekend, the House passed Biden's stimulus package totaling nearly $2 trillion. Now it's up to the Senate to pass their version of the bill. So let's talk about what might be expected. We have Yahoo Finance's Rick Newman here with us now. Hey, Rick.
Hey.
So, okay, we know that the Senate bill is not going to be including the minimum wage hikes that the House has decided to keep in the bill. And that, of course, would boost minimum wage to $15 an hour. What are you anticipating, however, from this Senate package?
I guess the big question is at this point is the minimum wage was the one thing where the Democrats really did have some major internal disagreements. So that's off the table simply because of the Senate rules and the finding that they cannot put a minimum wage in this type of bill. So are there other things they're going to argue about? I guess we'll find out in the next couple of days. There does not seem to be a lot of disagreement about the other things, which include a lot of aid to states and cities. That could be as much as $350 billion. The two headline items we've been talking about a lot. It looks like most Americans are going to get another check for $1,400, and the Congress is going to extend those unemployment benefits. The House bill does that through the end of August. I think there's a chance the Senate could extend that by 1 month. With the minimum wage legislation or language out of there, they actually have a little bit more money to play with. So it looks like the Senate is probably going to more or less approve what the House voted on. Then it has to go back to the House because it's a different set of legislation without the minimum wage. But the goal among Democrats is to have this signed into law by President Biden within 2 weeks. And I think the odds are pretty good that's going to happen.
I don't think it's, too often you and I have chatted about things that are happening, out of Washington, D.C. And we've heard sounds like the Senate is pretty much going to pass the bill that they had been given by the House, especially lately. I'm wondering, however, what you think the appetite is going to be once this stimulus package is passed for another stimulus package, because we have continued to hear that the economy still struggles. There are still economic scars, and that folks are still going to need some more assistance in 2021. Once this package is passed, do you think that there's going to be an appetite to do it again?
There certainly is an appetite. Whether they're going to be able to pull it off, I think, is the big question. So the Biden administration has been saying, look, we consider this a relief bill. That's the word they use, relief rather than stimulus, because they want to save that word stimulus for the next bill, which is going to be a lot of infrastructure spending, including a lot of green energy spending that Biden wants to be a hallmark of his administration. So we hear all the time there is, in general, bipartisan support for infrastructure spending, but that doesn't mean it's going to be easy to do. And Democrats continue to say we want to go big on the next bill as well. So it could be another $2 trillion or more than $2 trillion. They're not going to be able to borrow all of that money, however, as they are going to be able to do for the current bill, because it won't technically count as an emergency measure. So they're going to have to come up with some way to pay for at least some of that. And that means tax increases. And now you're talking a very complicated process. There are even some Democrats probably in the Senate who won't be comfortable with the tax increases President Biden wants for that huge infrastructure bill. So right now is about as easy as it's going to be for Joe Biden to pass legislation with this narrow one vote majority in the Senate. The next bill is going to be a lot harder.
Really quickly, Rick, I have like 30 seconds. I'm wondering how much this is a test really for the Biden presidency, because coronavirus was one huge thing that he had to contend with, and then stimulus was the other one.
Look at the expectations they're setting. Let's say Joe Biden, he looks like he is going to get 1.9 trillion or close to that, at least 1.5. That's a huge amount of spending. So even that, he would have to be able to declare victory. The next bill, let's say that he can't get 2 trillion. Let's say he can only get 600 billion. It's more than Donald Trump was able to get for infrastructure. So if I were Joe Biden around the time the 2022 midterms come around, I guess I'd be saying, look, at least I did a lot more than the prior guy.
And that's saying something. Yahoo Finance's Rick Newman, as always, thanks for breaking everything down for us. All right, coming up, we'll be talking about the lack of data on how COVID has economically impacted Black Americans. That's next. Welcome back to Yahoo Finance Live. I want to bring on Yahoo Finance's Brian Chung now for a story he's been working on about the lack of data on the economic impact of the coronavirus on Black Americans. Hey, Brian.
Hey, Kristen. Well, we know about the lack of data and health outcomes. For example, we don't have data from every state about how vaccines are being distributed, but a similar issue is playing out with economic data. Consider, for example, the Paycheck Protection Program, which had line items for small business to fill out their race or ethnicity. But take a look at the statistics. 75% did not do so because it wasn't compulsory. You're seeing a similar story play out in a number of other related stimulus measures. For example, the stimulus checks dispersed by the IRS, they did not detail those disbursements by race and ethnicity. And we know that many of the unbanked that simply didn't have a way to get those checks were oftentimes Black households who needed them the most. And this is a big deal because the Philadelphia Fed has a survey detailing the importance of the second round of stimulus and how maybe it didn't do as good of a job targeting those people in need. You look at the statistics, 30% of Black respondents, combining the 24% and the 6%, said that the second relief package would help, but not for long, or not help at all because their situation was too dire. Compare that with 23% of overall respondents. So it does show that there could be a better effort to collect the data and a better effort to target the stimulus as that $1.9 trillion package continues to get negotiated down on Capitol Hill, Kristen.
So what is the Biden-Harris administration planning to do to tackle that problem? And once we get that data, what can be done with it?
Yeah, well, on that first point, the Biden administration signed something hours after inauguration detailing the creation of an equitable data working group. And it's going to include stakeholders from the OMB, the Secretary of Commerce, the Council of Economic Advisors that are going to be driving more granular disaggregated data. Now, of course, the question is always, is more data better? There are obviously concerns about data privacy. I spoke with someone at the Urban Institute that said, actually, this could be bad for private sector credit outcomes. When you consider maybe malicious types of use of that data, it can actually further discriminate against Black communities. So things like data ethics and proper use of this data will definitely be in view as the Biden administration ramps up their priority on disaggregating this type of information.
And of course, this very important story can be read on yahoofinance.com, where Brian is able to break down all of that information. Yahoo Finance's Brian Chung, thanks so much for bringing us that. All right, the 2 p.m. hour is kicking off next with Alexis Christoforous.
Welcome to the 2 p.m. hour on Yahoo Finance Live, everybody. I'm Alexis Christoforous, and here's what's happening. Stocks rocket higher as bond yields fall back down to earth. Have investors' fears about rising rates been put to bed? And the space startup Rocket Lab is set to go public. The CEO tells us why he chose a SPAC to take the company to market. And Oatly goes mainstream. Starbucks will begin selling the non-dairy milk this week at its stores nationwide. We have got tech stocks snapping back from last week's bruising sell-off, and that is helping to send the overall market higher this Monday. We have got the Dow Jones Industrial Average now higher by about 650 points. In the broader market, same story there. Nice big gains to kick off a fresh month. The S&P 500 up 89. The NASDAQ composite now up more than 330 points, being led higher by those big tech names, including Apple and Tesla. Do want to mention this is a broad-based rally, though, all 11 sectors of the S&P 500 rising at least 1% today. Now, the gains we're seeing in stocks comes as yields in the Treasury market pull back. We've got the yield on the 10-year Treasury note, which is a benchmark for borrowing costs, down now about 1%. But down about 1% to 1.45%. The recent rise in bond yields spooked investors, and it got Wall Street wondering if the Federal Reserve might put an end to easy money policies to combat inflation. President Biden now urging the Senate to take quick action after the House passed his $1.9 trillion COVID-19 relief package over the weekend. Democrats are racing to finish this package before March 15th. That's when certain types of federal unemployment assistance are set to expire. All right, let's get a look now at some of the specific stocks that are making some big moves today. Let's check in with Jared Blickery for that. And Jared, we're going to start with the bank stocks. What have you got for us?
Well, as you mentioned off the top here, bank yield, not bank yields, the 10-year Treasury note yield down a little bit today, but still elevated. And we're looking at the banking sector heat map here, and Morgan Stanley is upgrading most of the names here. So they're saying the bull case is more likely than our bear case, and they are flagging expectations for the 10-year to be at 1.7% by the end of the year. It's about, 10, 12 basis points higher than right now. Also citing the resumption of buybacks as a tailwind, along with better credit. Now, their top picks are State Street, Synchrony, and Citigroup. And just looking at Citigroup today, that is up 5%. And by the way, it's the new CEO's first day on the job. That would be Jane Fraser. And already she's avowing that the firm will achieve net zero greenhouse gas emissions in its financing activities by 2050. So eventful first day for Ms. Fraser. Also, I want to note Goldman Sachs, we're going to talk about this in a couple minutes, restarting their crypto desk, Alexis.
Yes, we definitely want to get to that. But I actually want to shine a light on the airline sector. In particular, United Airlines is going to be buying up some of Boeing's troubled 737 MAX jets. And I know also there's at least one analyst out there pretty bullish on Boeing right now.
That's right. Well, we'll get to Boeing in a second, but let's take a look at the airline sector. The red on your screen is mainly focused in the cruise lines, but just check out American Airlines. That's up 1.5%. United's up 1%. And United is accelerating about 40 of their MAX orders to 2022. They're also expanding their orders. They're going to be taking in 25 more. And they're going to have 94 in their fleet by the end of 2023. So nice to see these stocks snapping back, and also the demand for airlines, which we know has been incredibly depressed, and especially for Boeing with its 737 MAX program. This is a real vote of confidence, and Morgan Stanley just raised their price target for this company, Boeing, to $250 per share from $230. $230 is right here. Just as a reminder, Boeing was once a $450 stock, still very well off of those highs, Alexis.
That it is. All right. Well, we've also got the Chinese electric vehicle maker NIO going to be out with earnings after the closing bell. They are trying to catch up to Tesla in any way that they can. What's the preview?
Yeah, so Deutsche Bank is saying, and this is a quote, investor focus will be on demand for NIO's existing vehicles in the face of aggressive competition from, as you mentioned, Tesla and their made-in-China Model Y, also saying that the company will need to provide details on its plan for the next plant in China. Bloomberg Intelligence, now this is their take, they're saying that NIO's losses may have narrowed during the December quarter, and with its record electric vehicle deliveries poised to drive revenue growth and scale benefits. Revenue may have more than doubled versus a year ago as shipments soared 111%. Goes on to say, basically, this is a growth stock. So it's up about 8% today. And, focus is going to be on just how much they've been able to grow and what the projection is over the coming quarter and year.
All right, you mentioned Goldman Sachs restarting its cryptocurrency trading desk. That's exciting news. And I also know Goldman is toying with the idea of a Bitcoin ETF.
Yeah, it's finally probably here almost. We just got the first North American Bitcoin ETF that listed in Canada a couple of weeks ago, and there's a lot of speculation about which will be the next one in the U.S. In fact, it would be the first one. For anybody out there who's wondering, well, can't you buy that Grayscale investment trust? That's GBTC. Well, that's only for accredited investors. So this would be a Bitcoin ETF for the masses, perhaps. But this is all according to Reuters. We don't know it for sure just yet, but it would mean a lot. And it just kind of adds to the consideration that Wall Street is having for Bitcoin and cryptocurrency. So their trading desk is going to be trading in Bitcoin futures, non-deliverable forwards, and it's going to be part of their global markets division, Alexis.
All right, thanks a lot, Jared. Let's stick with the markets now and bring in Paul Schatz. He is president at Heritage Capital. Paul, good to see you here as we both kick off a new trading month on Wall Street. Why do you think stocks are rallying with such gusto today? Is it really all about bond yields falling back a little bit?
No, it's definitely not. I mean, Friday, if you look just the last 15 minutes on Friday, that was one of those kind of head-scratching, curious periods where whether stocks soar or they collapse, it was in a very narrow breadth of stock. So I think that what set part of this up is that computer programs kicked in on Friday, stocks dropped 1% to 2% in 15 minutes. Part of this rally is just returning to equilibrium. Additionally, look, we had some volatility last week. This pullback, if you want to call it that, saw the indices down 4 to the NASDAQ intraday. I'll stretch it out, maybe 10%. So this is really just fun. Again, you're kind of back to a month or two ago where, okay, bond yields rallied. Can we survive? Yes. The markets don't like anything that goes straight up or straight down. If the bond yield rise was more moderate, stocks would not have skipped a beat. So I think it's really just people taking the weekend, taking a step back and saying, okay, the last 15 minutes we fell 1 or 2%. That was kind of fake. Let's put some money to work. It's a new month. We know we're going to get inflows. But I think it's more of the same. They're expecting more money in the market. You're getting more money in the market.
But when do you think we might actually see stocks move higher and bond yields move higher too? What's it going to take to make that scenario happen, Paul?
Well, you're starting to see it today. I wrote about it over the weekend. I didn't think it was going to come the first day I wrote about it. But it's a good sign that stocks can rally and bond yields are rallying. So that's a positive. Is it going to happen over a period of time? Probably. Again, bond yields can go up. That's okay. They can go from 0.5% to 1% to 1.5%. But the market does a lot better. It can adapt and adjust when bond yields do it in a more measured pace. The market is not like the Marines. They don't quickly adapt and adjust to battle. So I think it's happening. I think bond yields reached a point. The rally in yields is going to peter out, if you will. Maybe we go from going straight up to a more measured 2 steps up, 1 step back. And I actually think the time to buy bonds, short term, it's kind of in this zone, but I think there'll be an intermediate term buy on bonds for the second half of the year. It's one of our themes of the year, that you're going to have 2 halves in the bond market. This is the tougher half if you're a bond investor.
Yeah, I want to talk more about your themes here for 2021. You say it's risk on for the first 6 to 8 months, and then you say flip that. Walk me through that.
Sure. So coming into the year, there's no secrets. We had a new president. We knew that in November. We do know that when parties change hands and we have a new president, at least early on, the stock market is generally pleased. Things are going to change a little bit. We know this was a bit unusual with this election in that Biden ran on, I'm going to pump more stimulus, more relief into the markets. And the Fed said, we all know, the Fed's not changing course. I heard it last week stock pundits became bond market mavens. It's all nonsense. The Fed's not going to change course. No shot this year. So to me, it seems like everything is being pulled forward. The market's trading on what's going to happen 2, 3, perhaps even 4 quarters down the road. And the market's expecting all this stimulus, expecting more spending. So I think as we get along into the year, we're going to have great economic news. The comps are going to become amazing. Think about that as we look at comps from last February, last March, last April, last May. And I think that's why we're rallying so much. Look what's rallying. Again, one of my themes, first half of the year, cyclicals, meaning banks and semiconductors and energy, and transports are our biggest position. What's kind of lagging? Some of the growth, clearly the old stodgy utilities, staples, REITs. That's a second half of the year story. Why is it a second half of the year story? Because it's going to be a play on the growth in the economy slowing come 2022. That's why we'll go back to bonds second half of the year. And that may be July or August, but I think owning bonds, owning staples, owning utilities and REITs, second half of the year. Let's enjoy small caps and value and all these cyclical stocks that are really just taking off.
Paul, real quick, are you factoring in a rise in inflation anytime soon? And are you hedging with, let's say, commodities, or dare we say Bitcoin?
So the short answer is, yeah, we started putting on inflation positions almost, I was about to say almost a year ago. It's March, but it was about 10 months ago. We started getting involved in commodities. We already have a large commodity position in the ETF GSG. I anticipate we're going to hold that. We own DBA, which is it's an agricultural commodity. We're going to continue with that. I don't think inflation didn't just pop out of the bottle in 2021. It started percolating in the middle of 2020. That genie is out of the bottle, and that's why you own cyclicals and value. Value and cyclicals will do better as inflation is ticking up, not down. So the long answer is yes, we're sticking with our inflation place. Your Bitcoin question is no, I have not yet been able to model Bitcoin. I'm sure there are smarter folks out there who are doing it very successfully. In order for us to engage in any security, I have to be able to model it and put some kind of downside parameters in. You got to be able to play defense, at least we do. I've not been able to do that with Bitcoin. So for now, I'm watching it and applauding others who have done it well.
Right, we are all watching it for sure. All right, Paul Schatz of Heritage Capital, thank you. Coming up here on Yahoo Finance Live, how the software company Genpact plans to improve the COVID-19 vaccine supply chain. Welcome back. We have got shares of Johnson & Johnson on the rise today after the company's COVID-19 vaccine received the green light from the Centers for Disease Control and Prevention, clearing the way for distribution. But the pandemic has shown a light on the cracks in our healthcare supply chain. The software company Genpact is trying to help mend those cracks. Joining me now is the company's CEO, Tiger Tyagarajan. Tiger, always good to see you. I want to begin with how you're helping with the vaccine. I know you recently entered a contract with the UK government to develop AI to process people's adverse reactions to vaccines. Tell us a little bit more about that.
Yeah, Alexis, thank you for having me on the show. Yes, we did. We signed a contract with the MHRA, which is the regulatory body in the UK, for tracking adverse reactions to the vaccine. It's part of our AI platform that does pharmacovigilance with an AI foundation. And that software is what the MHRA is plugged into their software platform in order to be able to process adverse events and then track it. And we're talking about volumes of data. We're talking about tracking it in real time. So it's very important. We are very pleased with that contract.
How else are you leveraging technology there at Genpact to bring speed and accuracy to clinical trials for some of the big pharma companies?
Oh, that's another big one, Alexis. You can imagine that the world has really come together across a range of innovative pharma companies supported by various governments and academia to actually get as many vaccines out, some of them different technologies, as possible. But in order to do that, they actually had to go through regulatory approval, and some of them are still going through that. And as you started the program with J&J just got approved, helping the pharma companies go through that application of the clinical trial so that the regulator has all the data so that they could approve it is something that, you know, AI and machines and data and analytics can help a lot. And that's what we've been doing with a number of pharma companies to accelerate the speed at which all that is done.
I know that Genpact has actually been busy buying up some companies. You've made some acquisitions. You bought a company called Something Digital. It's an interactive agency specializing in e-commerce website design. Tell us how that fits into the overall strategy at Genpact.
So one of the things that the world has been going through is a significant digital transformation that most companies in every industry have been going through. However, the pandemic really accelerated that. Think about, you know, companies that thought they'll take 5 years to embrace online, to embrace cloud, are now saying, I want to get it done in 18 months. I want to get it done in 12 months. And the shift to online is one of the big trends that we realized was happening. And Something Digital focuses all their energies in helping clients open up new channels to go to market online. And that's what we love about the company Something Digital, because we then integrate it to our supply chain offerings, to our finance and accounting, order to cash, and really help our clients transition from offline to online at speed.
You know, you were out with earnings recently, and they were quite strong there for Genpact. Total revenue of $3.7 billion. That represented a 5% increase year over year. And this caught my eye, Tiger. Your quarterly cash dividend increased by 10%. I mean, during a year when there were so many challenges with the pandemic, that's pretty incredible that you can raise your dividend and by that much. How were you able to make that happen?
No, Alexis, I'm glad you pointed that out. We do feel very pleased that we were able to increase dividend to our investors and shareholders by 10%. And that's a reflection of the way we've been partnering with clients through this last 1 year, which obviously has been very challenging for the world, for society, and for our customers, but helping them transform, helping them change and deal with these changes, whether it is helping them with analytics to figure out what's the right drug and medicine that should be available given all the changes that are happening in demand, or what's the supply chain for consumer goods so that the right product is available at the right time, or how do you identify fraud in credit card so that the right transaction gets stopped, but most other transactions go through. And being able to do that has allowed us to grow even through these very challenging times. And we really think about serving our clients, serving investors, serving our employees, and serving society. And really bringing that together has been our focus.
All right, Genpact CEO Tiger Tyagarajan, always good to see you. Coming up, we're going to hear from the CEO of the space startup Rocket Lab as his company gets ready to make its Wall Street debut. Welcome back. It looks like the space startup Rocket Lab is coming to market with a SPAC merger. It is a deal that's going to value the company at more than $4 billion when all is said and done. Yahoo Finance's Emily McCormick joins us now with all of the details. Emily?
Well, Alexis, we are going to be seeing yet another SPAC merger in the space industry. We have that space launch company, Rocket Lab, set to merge with the SPAC Vector acquisition. And taking a look at that company's stock, it is up about 40% in intraday trading. So clearly a lot of optimism around this merger, which is expected to close in the second quarter of this year. Now, as you mentioned, this deal would value Rocket Lab at about $4.1 billion and give the combined company $750 million in cash on hand. Now, Rocket Lab would begin trading on the NASDAQ under the ticker symbol RKLB. Now, to date, as a private company, Rocket Lab has been focused on delivering small satellites to low space orbit. It's so far launched 97 satellites and has commercial customers as well as U.S. government customers in intelligence and defense agencies. Now, Yahoo Finance's Zach Guzman and Akiko Fujita spoke with Rocket Lab CEO Peter Beck in an interview earlier today. He discussed the company's focus on small launches and how that's allowed Rocket Lab to carve out a niche for itself in the space industry. Let's take a listen.
You know, we've always been good at picking the market niches, and you know, we picked it with small launch and kind of owned that category. And you know, one of the wonderful things about launching such a variety, and you know, we've delivered 97 satellites to orbit for such a variety of customers, is we know their businesses and we know where everybody's going. And if you look at what's actually happening within the industry, you know, over 80% of all the satellites that are going to be launched here in the next decade or so are these mega constellations. But the one thing that's missing in the industry is a launch vehicle to successfully deliver all of those constellations to orbit. Hence the reason why there's a real need in the marketplace for a medium lift launch vehicle to service that.
Now, with the funding through the SPAC merger, Rocket Lab is set to develop a launch vehicle called Neutron that can deploy those mega satellite constellations that Beck was talking about, as well as conducts deep space and human space missions. Now, in terms of the financial opportunity here for this company, Rocket Lab has projected reaching positive cash flow by next year, along with adjusted EBITDA profitability in 2023 and $1 billion in revenue in 2026. So, Alexis, this is a company that, at least on paper, is mapping out a path to profitability in the burgeoning space industry. Alexis.
Yeah, one to look out for. All right, thanks a lot, Emily. All right, switching gears here. Today, Starbucks announced its plans to add Oatly oat milk to its menu nationwide. This is going to be the fourth dairy alternative on the coffee giant's permanent menu. And our Brooke DePalma has all those details for us. Brooke?
Alexis, beginning tomorrow, consumers can head to Starbucks and get Oatly oat milk in their coffee, in their espressos, in any drink that they'd like. Now, of course, this is alongside Starbucks' debut of their 2021 spring menu items. So with that oat milk launch, there will also be the iced brown sugar oat milk shaken espresso and a honey oat milk latte. Now, year over year, oat milk category has risen more than 170%, and consumers look for more healthy alternatives. Now, this was first announced by Starbucks back in December at their biennial investor day. Not that they'd partner with Oatly, but that oat milk would be on their menus beginning in the spring. Roz Brewer, COO of Starbucks at the time, said that customers are really redefining health and wellness. Of course, the competition in oat milk among Starbucks giants is beginning to brew, as you can sort of say. Dunkin' earlier last year in August debuted oat milk on their menu with Planet Oat. Now, that is a competitor to Oatly, but Oatly being the winner here, Starbucks will debut it here in the US. Over 15,000 stores, that is, of Starbucks, according to Q1 results.
And I know that Starbucks has really made a commitment to adding some other plant-based items to the menu, and they're not all beverages, right?
That's right, Alexis. They're not all beverages. CEO Kevin Johnson saying in Q1 results that consumers are really shifting to more healthier alternatives in both food and beverage. So over the course of these past few spring, winter menus, we're beginning to see more food options. Now, for the spring in particular, they're going to do chickpea bites and avocado protein box. You could see it right there, alongside a new role, or you could say among its iced teas. There will no longer be sweetener in the iced teas among immediate order. You'll have to ask for sweetener. So really sort of identifying and changing up their menu based upon consumers' needs and wants.
That chickpea thing looks pretty good. I'm going to have to try that. All right. Thanks. Thanks a lot, Brooke. Coming up here on Yahoo Finance Live, former hedge fund investor Whitney Tilson weighs in on Warren Buffett's annual shareholder letter. welcome back. In the oil pits, all eyes are on this week's OPEC Plus meeting, which is happening on Thursday. The expectation is the cartel is going to agree to boost production in April. Jared Blickery is here now with a preview. I was going to say a recap. Hasn't happened yet. With a preview. Jared?
Exactly. Back to the future here. Let's take a look at the chart because some pretty interesting price action. Now, we've been talking about crude oil strength for such a long time, but you can see since the open last night, it's down about 1.5%. Take a look at what's happened over the trailing 1 month, and you can see we're just slightly off of our highs here. We got up to about $64 per barrel or so. And as you said, the big focus this week is on what's going to happen with OPEC Plus. And there's expected to be a rise in production, as you said. Saudi Arabia probably not going to continue its 1 million barrel per day production cuts because that was completely voluntary. They're under no obligation to do that. So what's getting priced into the market right now is actually pretty healthy from my perspective. We'll have to see how these ministerial meetings go over the next few days, but that's what investors, at least in the commodity space and the energy space, are going to be focused on this week. And I just got the closing quote here for the settlement of crude oil, $60.64 a barrel, Alexis.
All right, thanks a lot, Jared. Billionaire investor Warren Buffett remains a firm believer in the American dream. In his annual shareholder letter this weekend, the 90-year-old Oracle of Omaha said he would, quote, never bet against America. Yahoo Finance spoke earlier today with Whitney Tilson, founder and CEO of Empire Financial Research, to discuss Buffett's letter and some of his big takeaways.
From 2019, Buffett bought back less than $5 billion worth of stock, and this past year ramped it up fivefold, up to almost $25 billion, retiring 5% of Berkshire shares outstanding. And this is, keep in mind, this is the 5th or 6th largest market cap company in the U.S. stock market. So buying back 5% of your stock in a year is substantial. And Buffett dedicated an entire page of his annual letter singing the praises of buybacks, something that I've been calling for the better part of a decade, in fact. So I'm delighted as a longtime Berkshire follower to see him finally taking advantage of Berkshire's depressed share price, enormous cash hoard, and tremendous cash flows. So as that chart you just showed pointed out, it's been ramping up even during the year. It was $9 billion per quarter the last 2 quarters, and he indicated in his letter that he continues to buy aggressively already this year. So I expect this to continue at the level of the last 2 quarters, and it should be a major driver of Berkshire's increasing intrinsic value per share over time.
Hey, Whitney, it's Julia LaRoche. I do want to talk about your own price target for Berkshire Hathaway shares, for the A share specifically, and a bit more on how we get to that price target, a price target of 439,000.
Yeah, correct. We've been valuing Berkshire the same way for 20 years. We think it's the way Buffett and Munger value Berkshire. And it's really, there's no mystery to it. It's the way you would value any company, which is Berkshire has enormous piles of cash, bonds, and liquid publicly traded stocks, which are easily able to value. And that comes out to about $290,000 per A share. And then you have Berkshire's wholly owned operating companies, nearly 100 different businesses, the largest being Burlington Northern Railroad, and the utilities businesses. We actually keep the insurance businesses separate because they have so much float. That's sort of picked up in the investments per share. So long story short, you get about $13,500 per A share of pre-tax earnings. That's actually down about $1,000 from $14,500 year over year because of the pandemic. Berkshire does own a number of economically sensitive businesses. They took a big write down on Precision Cast Parts, for example. You can imagine what the earnings of that company were last year. That makes components for aircraft engines and aircraft during the pandemic. So we put an 11 multiple on the 13.5, add it to the 290,000 per A share of cash and investments per share, and you get to 439,000. And this methodology that we've been using for 20 years has actually been quite a good predictor of Berkshire share price over time.
Whitney, should Berkshire investors, should they be hearing more from Warren Buffett on some of the really
important issues of our time right now. He mentioned COVID, I believe, once in reference because his furniture stores had to close down for some period of time because of COVID. Didn't mention any of the trading activity frenzy. Didn't mention anything about stimulus plans or the frenzied just activity in the markets overall. Should Berkshire be hearing more from him on these topics?
Yeah, I mean, look, I think if there were one fair critique about an absence of commentary in his letter, it would have been that, it was only, I think 2 years ago, maybe 3 in his annual letters, Buffett said, we're not finding a lot to do, but someday it will rain gold and we will be out there not with thimbles, but with buckets to scoop up that gold. And a year ago, almost 11 months ago, when the market dropped 35% in a matter of weeks, and Berkshire Hathaway stock dropped to a intraday low of $240,000 per A share, I was pounding the table myself to anyone who would listen that it was the best time to buy stocks since the global financial crisis. And I was certainly hoping that, Warren Buffett would be taking advantage of that, picking up all sorts of depressed stocks or Berkshire Hathaway stock itself. And he really didn't. And it's sort of okay. He's a very conservative person. And particularly any company, a financial company like Berkshire, when markets were on the verge of freezing up. So he played it conservatively. I think he left a lot of money on the table. I think maybe a 10 years younger Warren Buffett would have been able to put a few tens of billions of dollars of capital to work. But it's okay. Berkshire Hathaway is not a get-rich stock. It's a stay-rich stock. And so it's shareholders should know, this is not a stock to make you rich, but it's a great retirement stock for the foundation for your retirement portfolio. But, I would have expected Buffett in his annual letter to have a little bit of a mea culpa and say, what, in hindsight, I should have been more aggressive when the markets gave us, it was really only a month or so where there was an incredible window of opportunity.
Hey, Whitney, I was going to ask you about deal activity, but I'll do a different topic here about the future of Berkshire Hathaway and the leadership. We just saw Charlie Munger speak at the Daily Journal, clearly sharp as a tack at age 97. And now we're hearing from Buffett in the annual letter. What are your kind of thought process for this kind of long-term play and the future management of the company?
Yeah. By the way, a very nice interview you did with Charlie. He's a treat, isn't he? And I encourage viewers to just go to YouTube, where the 2-hour session there is posted from last week at the Daily Journal annual meeting. Look, we're clearly coming to an end of a half-century run of 2 of the greatest investment minds in the world. I do think Buffett has another few years at Berkshire. Munger is 7 years older. And Buffett is still sharp as a tack. And while Munger is really aging physically at age 97, Buffett's still, spry. He seems to be in good shape, and he's trying to eat more healthily and is exercising more because he just loves what he does. They've already identified the 2 people who will run the investment portfolio, and they seem to be doing a good job over the last few years. What the CEO's job, managing the operating businesses, they haven't yet revealed that person. It may be, 2 people. It could be a Greg Abel on the operating side, and then Ajit Jain running the insurance operations. But Berkshire will be in very good hands. And there's certainly no Buffett Munger premium built into the stock right now. With the stock at 364, I'm pegging intrinsic value at 439. That means it's trading at a 17% discount to its intrinsic value. Over the past 20 years, at points in the global financial crisis, for example, is trading at a 50% discount to its intrinsic value. But look, we're in a very fully valued market. And as you guys commented earlier in the show, with the rotation away from the nosebleed valuation stocks and tech into the banks have been doing very well. And I think Berkshire will be a beneficiary of that rotation combined with substantial share repurchases. Berkshire should be, I think, is quite likely to outperform a passive index fund, the S&P 500, for example, over the next 5 years. But you need to have realistic expectations.
And that was our conversation with Whitney Tilson of Empire Financial Research. Coming up, what will the office look like post the pandemic? We're going to talk about it with the CEO of the design firm Knoll after this. Welcome back. The pandemic has certainly changed the way we all think about the workplace. The design firm Knoll is out with a new survey that finds the traditional office is on the brink of transformative change. Joining me now to discuss those findings is Knoll's CEO, Andrew Kogan. Andrew, good to see you here. So are the days of those open floor plans in the office long gone?
Well, I think we are, as we said, on the brink of transformative change, and we sense a very strong desire on our clients' behalf and on their employees to get back into the office. But I think the office we're going to go back to will not be the office that we left a little over a year ago. And I think that office, we believe, will have a lot more focused on collaboration and communication and less on the individual areas. And when you think about it, we've now gotten into this habit of working from home. And so the office is really going to have to work harder to bring people back in and to attract employees back into the workplace. And we think that, long term is great for our business, which is all about creating inspiring offices where people want to come to and be in.
I know you have some large blue chip clients. You've got Microsoft, I believe Apple, Chase among them. What are they telling you? How are they planning the return to the office? And I mean, I would imagine a portion of their workforce is going to be hybrid or some perhaps all remote. So what are they telling you?
Yeah, well, I mean, we think the workplace ecosystem, and it is going to be an ecosystem that will consist of both a portion of work that will happen at home, and maybe that's 10 to 20% of work now stays at home or 1 to 2 days a week a portion of your workforce is at home. But we think the bulk of the work will happen in office and really in office collaboration. And that's what we're focused on. That's what we're hearing our clients want to do. There's no way to replicate the communication, collaboration, acculturation that happens in an office remotely. It's just not possible. And while, Zoom and everything has been wonderful to kind of get us through the pandemic, I think it's really, people are getting tired of working in this mode and are craving the collaboration that comes from being together. The challenge of onboarding employees in a virtual environment is meaningful and significant. And so those headwinds are going to drive people back. And our sense is, as the vaccine, is more broadly distributed and over the course of the year, particularly as we kind of move from the summer into the fall of 2021, we'll see people come back. And then it will be one of those things where more people being in than being out will also drive, I think, further acceleration of the return to work curve. And what we're focusing on with our clients is how do they design their workplaces now? And change is always good for our business, such that they're ready for that return to work. And it started initially with screens and partitions and plexiglass, but now they're really getting into the meat of the problem, which is how do we design a space that facilitates collaboration, that allows people that are virtual and physical to work together, that gives maybe less individual space and more group space, all the things we really miss in an office. It's not the individual work. We can do that at home. We've proven that. It's the work we do together. And so that's what we're increasingly working with some of these large tech and financial services and really a broad swath of clients solving that problem.
I want to talk more about the idea of shared space, because there was a time when I really wondered if we were going to have those areas in the office where you would congregate naturally for lunch around sort of I don't know how many offices have water coolers anymore, but the idea that there are places where people can come together within the office away from their workspace and their desk. What are your clients telling you about those spaces in their offices, and how are they going to build those out going forward?
Well, I think those are going to be actually more important, not less important going forward. And that, again, the reason you come to the office is to be together. It's not to sit in your pod or your cubicle and do your own thing. And so I think what we're seeing in those areas is they may be a little more spacious. We went through this period when office design was densifying and you were just trying to jam more and more people in. Now, if you have 1 in 5 workers working from home, and by the way, we have a wonderful digital online e-commerce work from home business. So we've been able to meet that need as part of the ecosystem. But you'll have more space inside because you won't be jamming so many people in, and you'll create more spacious meeting rooms. One of the things we're seeing is, as opposed to being in a glass box that's all covered or a fixed conference room, we're seeing the desire for rooms that have more open airflow. We have a product called Rockwell Workspaces, which is an architectural framework with an open ceiling and open sides that allows really for healthy airflow. We've got a series of partitions and screens that users can control to shape their space, create a kind of a background for virtual and in-person collaboration. And so I think those areas, and we think those areas are going to be more important. We're doing more in terms of outdoor furniture. So areas outdoor for people to hold meetings. Think about restaurants. Think about how restaurants have created areas like kind of pods inside a restaurant or outside on the street. That's very much the mentality. And actually, David Rockwell, who we work with, is a restaurant designer. So we're bringing some of that thinking into the workplace.
So I guess that's great news for companies that can do the outdoor space. In a dense city like New York, though, I'd imagine that they have to get a little more creative when it comes to making sure that air quality is good, that there's enough space for everybody who wants to come back physically to work.
Well, I think it's a little bit like 9/11. After 9/11, we went through a whole series of protocols of what it was to come into an office building and the security and all that. And I think it will be the same measure with health checks and temperature checks and all that, with higher quality air circulating systems and things of that nature, more cleaning and sterilizing. But at the end of the day, when people are vaccinated, it will be safe to collaborate. And I think you're just not going to want to sit in an enclosed box or meeting room. And that's why this idea of taking these open plans, not filling them with individual cubicles per se, but filling them with free flowing, open air areas for collaboration, You have some acoustic protection. We've got wonderful felt acoustic products you can drop into these areas. And so that allows you to be together and collaborate without, the stuffy air that many people associate with an office. So we think it's going to be, again, this mixture of areas. There will be individual areas that people will be able to come in and plop down at. But at the same time, I think it's going to be much more about what we crave in the office, which is our colleagues and our collaboration and our being together and not being isolated at home like we've been for the past year.
Yeah, I think we can all relate to that, as we here at Yahoo Finance have been doing this remotely. Quite a feat, but we've been doing it remotely now for just about a year. All like to get back to it. Andrew Kogan, we're all anxious to see what the workspace of the future holds. CEO of Knoll, thanks for being with us. Some major retailers are letting you buy now and pay later. We've got the details for you up next. Welcome back. Major retailers, including Macy's, Gap, and Nordstrom, are adding new pay options to attract younger shoppers. Yahoo Finance's Sabile Marcellus is here to fill us in on this one. Hi, Sabile.
Hi, Alexis. So what we're seeing here is that retailers have been really impacted by the pandemic. We saw that throughout 2020. It's continuing on into 2021 as we await a national rollout of the vaccine, herd immunity. So what retailers have been doing over the past couple of months is that they've been offering the option to shoppers to be able to buy items now and pay for it later. Now, traditionally, these are layover plans, people layaway plans, and usually people would have to wait to get the item. But the difference now is that you can get the item right now. And people used to do this for items that are extremely expensive, like a couple $1,000s. What we're seeing is that many shoppers are navigating towards these buy now, pay later plans for items that are costing about $500 or less to help them be able to pay for it. And these retailers are meeting some success with this strategy. Some of the retailers you mentioned, Alexis, are Macy's, Gap, and Neiman Marcus. Now, this does come with some risk for these department stores because a lot of their revenue, their income they rely on is from the use of store-branded credit cards. They really like customers to use that. A lot of their income comes from that. But what they're finding is that they want to bring in even more shoppers, and shoppers who are under 40 years old tend to like this buy now, pay later plan. So they're willing to take the risk because they do also face fees when they offer this option. The types of financial institutions that offer this, Klarna Bank, Affirm Holdings, Afterpay. So this is the new option that retailers are doing right now as they try to bring in more customers. But Macy's, for example, has a new partnership with Klarna, which is one of the financial tech institutions that are offering this buy now, pay later plan. So we're seeing retailers try to gravitate and shift to meet consumers' demands.
Yeah, definitely makes sense. All right, thanks a lot, Sabine Marcellus. Let's get another check of the markets for you because we're just moving higher here on the first of the month. The Dow Jones Industrial Average now at its best level of the day, up more than 700 points. NASDAQ up nearly 400, and we have got the S&P 500 up better than 100 points. So lots of buyers out today. Coming up, we're going to take a look at the retail industry with the CEO of the American Apparel and Footwear Association. So stay with us.
The CDC signing off on Johnson & Johnson's single-dose COVID-19 vaccine, and now the pharma giant is starting to ship millions of doses nationwide. Now, this comes as the CDC releases new numbers on vaccinations. Nearly 77 million doses have already been administered across the U.S. President Biden's pick for trade, Katherine Tai, signals a tough stance when it comes to China, saying that she will not hesitate to ensure compliance. American Apparel and Footwear Association CEO Stephen Lamar, he's going to join us with his reaction to her comments and also to discuss the letter that he recently sent President Biden. And Zoom fatigue, maybe some of you have been feeling this over the last several months. A new Stanford study out finds that Zoom meetings are causing more stress than in-person meetings. We're going to talk to the researcher behind the study about the underlying causes of this and also what can be done going forward. We've got an hour to go until the closing bell. I'm Shauna Smith.
And I'm Adam Shapiro. Taking a look at the markets right now, Shauna, we are in the driver's seat. It's like being in a 63 Avani with a Paxton supercharger. The S&P 500 is up more than 2.5%, up 100 points. The Dow is up more than 700 points, 2.3%. And the Nasdaq is approaching 400 points to the positive, up 3%. Sectors that are leading right now, energy, financials, information technology, and industrials, all around 3% to the upside. Some of the stocks that we're watching that you should pay attention to, of course, there's Johnson & Johnson. Shares have been trading up about 1% today. At this moment, J&J is still trading higher, but not as strong as it had been. We got the news about the single-dose vaccine. It's already on its way to go into people's arms starting this week. CEO Alex Gorsky told Yahoo Finance Live that the company remains committed to providing the vaccine at no profit and remains on track to deliver 20 million doses. Don't take it from me. You're going to hear from Mr. Gorsky. Angelique Kamlani spoke with him a little bit later on in the program. Then there is Boeing. Shares up about 5% during the trading session. Right now, Boeing is up almost 6%. United Airlines buying 25 additional 737 MAX jets. That'll bring their total order to 180 of the aircraft. And they're pushing delivery dates, Shauna, faster. They want 45 of them as soon as they can get. Morgan Stanley analyst Christine Lueg is raising her price target on the stock to $250 from $230. Shauna?
More upside to go there. All right, Adam, I'm taking a look at Citi. It's another gainer in today's market here. Shares jumping just around 5%. Now CEO Jane Fraser. It's her first day at the helm. You can see the shares up just around 6% right now. Mike Mayo, he was out with a note to clients earlier today. He was also on our air this morning talking about what we should expect under Fraser. He talked about possible restructuring. Of course, this is on the heels of the Wall Street Journal report over the weekend saying that this is exactly what the bank needs to do. Mayo has been making the case that restructuring will unlock value for shareholders. The stock moving to the upside today, trading just shy of $70 a share. Flipping over to DraftKings, another big winner in today's market. Loop Ventures out with a very bullish call on the stock. The stock trading just around $68 a share. Now, they are very bullish after DraftKings' recent earnings report that they just released on Friday, saying that they delivered strong results across all key metrics. Now, Loop Capital's Daniel Adam, that's the analyst there, saying that he raised his price target all the way to $105 a share, up from 100. That's a new street high, and as you can see, significantly higher from where the stock is trading today. Let's take a step back and talk about that broader market rally that Adam was just speaking about. Again, all three of the major indices posting significant gains today. We want to bring in our markets reporter, Jared Blickery, for a closer look at some of the buying action that's underway. Jared?
Oh, what a rally to start the month of March. And let's go straight to the charts because we got the NASDAQ up over 3%. And I just did some looking to see if this was perhaps the best start to March in some time. Well, guess what? Last year, the NASDAQ was up 4.5%. That was in the midst of all that COVID volatility. So kind of chalk that one up there. But look at the Russell 2000. That's up 3.5%. S&P 500 and the Dow each up over 2%. And then Apple's a real standout today. That stock is up 5%, having the best day in months. Facebook's up over 3%, Tesla's up over 5%, PayPal another 5%. So kind of feels like things are getting back to normal. Just looking at some of the big winners on top here, Zoom up 11%, haven't said that in a long time. And then you got some chip stocks doing well. Lam Research and Western Digital each up more than 5%. Now here's a look at the sector action. With the elevated yield curve that we're talking about, even though the 10-year is backing off a little bit today, financials in the driver's seat, as you were talking about, 3.5% for the XLF ETF, followed by industrials and tech. Both of those are up over 3%. Industrials, that's a real Boeing story there that Adam was just talking about. And just looking at some of the other sectors that have been hot and cold recently, actually, we can see cannabis really lighting up here. Tilray's up over 6%, Afria 5%, Kronos Group up over 6%. Guys.
Certainly a lot of names, as you can see, in the green today. Jared Blickery, we'll talk to you a little bit later in the program. We want to continue talking about today's massive rally. And for that, we want to bring in Mark Hackett. He's the Chief of Investment Research at Nationwide. And Mark, first, just your thoughts on some of the buying action. Jared was just rolling through the sector action that we're seeing today, financials, industrials, technology, among the big winners leading today's action.
Yeah, this is certainly an encouraging rally if you're bullish. You know, the pro-cyclical nature of it, but also the broad participation really is nice to see. But let's keep it in perspective. This is really kind of a mirror image of what we saw last Thursday. I think we're in this environment where there's a tug of war between the bulls and the bears. The bulls are certainly winning today.
So if I'm looking where I should be placing my money, because we had record, 80% of companies in the quarter reporting earnings that, grew by about 4% when we were expecting losses close to 11% coming into the season. If I'm taking money out of bonds, should I just be keeping it in cash, or should I be looking to jump back into this market, especially on a day when things are expensive?
Well, we think over time the equity markets are fairly well positioned, so we would definitely be allocating there. The earnings season that we just got through, as you mentioned, was very encouraging. That you team that with the broadly improving economy, not just domestically but globally, but also the very accommodative backbone from the Fed and the fiscal policy. So there's really kind of a three-legged stool that's driving equity markets higher. Obviously, in the early stages of a market rebound, you expect things like emerging markets, small caps, other more pro-cyclical areas to win. They have been winning. We expect in the near term that will be the case. But as you kind of mature through the bull cycle, we expect that some of the more quality growth names with good balance sheets and a lot of levers to pull for investor return will probably take over leadership, probably at the later part of this year or into next year.
Mark, how about the last couple of weeks? Of course, we've been talking so much here about the higher rates that we've seen, the massive spike that we saw last Thursday, I believe it was, in the 10-year yield. How are you looking at that? And I guess, are you changing your investment strategy? I know you're just going through some of the sectors and some of the areas where you do see opportunity, but are you changing your strategy as a result of what we've seen play out in yields over the past couple of weeks?
Yeah, we have seen a pretty sharp move in yield. Some of that's justifiable with obviously the Treasury issuance that we see, but also the broadly better economy globally. But there's also some of the move has been dictated by some worries about inflation that really aren't showing signs yet. So a lot of the move that we've seen is probably fair, but a lot of it is probably exaggerated too. So when we put it in perspective, in the 140s for the 10-year by a historical basis is still incredibly low. So we're not going to see some of the damage that you would expect if interest rates really got more in the 2s and 3% for the market. Really, in reality, we've seen a sharp move in the 10-year over the past month, but historically, sharp moves in the 10-year upward really haven't been negative for equities over the long term. If you compare this period to the previous 8 periods since 2003 with similar types of moves, over those periods, the S&P 500 returned about 17% over the following 12 months. So just because we have seen rates spike higher here does not necessarily mean that equities are going to be in for a tough time.
Mark, I think a lot of us as investors are, at least some of us are passive investors. And so this swing in the yield on the bonds isn't as worrisome because we're in the equity markets for the long haul. But with all the money that is on the side, I'm seeing estimates 1.6 to 1.8 trillion. And then the money that was coming out of the bond market just sitting there. It gets to my question earlier. There's going to be a ton of cash that's got to do something. And it worries me if I'm an individual investor in stock that things are going to get even pricier as that money just chases the equity market.
Yeah, for sure the equity market already prices in fairly strong expectations, but so does the bond market when you're still sitting with about a 1.5%, 10-year and really effectively a 0% short term. So I don't see a huge wave of money coming into the bond market in the near term, particularly because we're starting to see what happens when rates rise. Some of the long-dated ETFs are starting to lose capital. The NAVs are starting to go down. That's something we really haven't seen for much of the past decade or really beyond the past decade. So I think bond investors are probably going to sit tight here. But equity investors, there's still a lot to like. We're sitting with a pretty good fundamental backbone here. Yields for the S&P 500 are still a little bit larger than that you can get in a 10-year Treasury bond. So we still think that new money allocated is probably going to find its way to equities, at least over the intermediate term here.
Mark, are you seeing any opportunity in some of those travel names? I mean, some of these beaten down stocks that have been under significant amount of pressure over the last year. Is now the time to buy, or still a bit too soon?
I think in general, there's probably easier ways, especially as you were talking earlier with some of the more long-term investors. That is an emotion-driven trading space right now, both to the upside and the downside. Market timing is incredibly hard because you have to be right get in and be right getting out. That has not proven to be easy, particularly over the past 12 months. So I think that while there's probably money to be made as we emerge from this lockdown, the overall broad market should participate pretty well under that. So I wouldn't lock yourself necessarily into some of these meme stocks or story stocks that will show periods of strength, but also periods of weakness.
All right, Mark, great to have you on the program. Mark Hackett, Nationwide's Chief of Investment Research. We'll talk to you again soon. Coming up next here on Yahoo Finance Live, President Biden now says that he is backing a drive by Amazon warehouse workers to unionize. The CEO of the American Apparel and Footwear Association joins us on the potential impact to his industry next.
$45 minutes to the closing bell. All of the indexes are trading higher right now. We're going to keep an eye on that as we head to the closing bell. But we're also keeping an eye on the demand that many Americans have to just get out of the house and go somewhere. We invite into the stream Alicia Kapoor. She is SimilarWeb's lead travel industry consultant. We appreciate you joining us because you crunch the numbers on where people are searching online to go, to get out. I'm going to share some of it here. In January, or at least at the end of February, the top search destination, this blew me away, Yellowstone, the national park, followed by Disney World, Disneyland, and then Universal Studios. I get Disney and Universal. What do you think drove people for Yellowstone? It was number one.
Yeah, that's a great question, Adam. So we've been seeing a ton of traction for Yellowstone, not just over the past 28 days, but really over the past year. Yellowstone has exploded in a way that it really hadn't before. And you can kind of see that in the top trending destinations. Wyoming, Montana, and Idaho all had growth year over year. And that's where Yellowstone is in those three states. So the reason for that is that or our hypothesis is that people really are looking for safe, outdoor, open spaces, and Yellowstone and other national parks offer that. So you can see from consumer search trends that national parks are kind of top of mind for most consumers, especially as they look for safe, comfortable, remote ways to get around.
Alicia, we had Airbnb's CEO Brian Chesky on the program last week. He was talking about how people still prefer Airbnbs to hotels because they simply feel safer during the pandemic. Is that what you're seeing as well? And I guess what kind of trends do you expect then to see moving forward?
Yeah, it's a great question, Shauna. So we have definitely seen that the pickup for alternative accommodations, especially with regards to Airbnb and Vrbo, has been really, really strong. So you can see that Airbnb.com and Vrbo.com are the top US websites, top US travel websites right now, ahead of Booking.com, Marry.com, and Hotels.com. So Hilton is actually not on this list, but it is next in the line. And from my perspective, I do believe that alternative accommodations will kind of maintain that strong pickup that they've had over the next few months. But suppliers are doing a lot to regain consumers' trust. They are offering a lot of deals. They are really, really kind of trying to put out calls to action to their loyal consumer bases. So I think suppliers will come back more quickly than maybe is to be expected, especially as we start to see vaccinations spread across more age groups.
Now, some of us, to get anywhere, if you don't have a car because you live in New York City, you got to fly. And in January, we were booking vacations. I learned a new term, as did the rest of the country, VFR, visiting friends and relatives. That's big with the airlines. And look at this, Southwest was your #1 search in January. That's a big part of their business, VFR, followed by American and Delta. What do you think hurt United? Was it a lack of international destinations?
Yeah, I think that United and American and Delta, to a certain extent, are all just, they have higher international exposure than a domestic airline like Southwest. So Southwest has really been able to maintain relatively strong demand compared to more international airlines over the past year, just given the locations of kind of their inventory and where their routes are. So I know they're focusing pretty heavily on domestic, and I think that that's going to be the case for a while longer until we start seeing international borders open up.
Alicia, you mentioned Delta there being hurt a little bit by their international exposure, but I think one thing that separates Delta from some of the other airlines out there have been how they approached safety during this pandemic. They're still leaving the middle seat open. When I've talked to people that have flown Delta, they have felt very safe on their flights over the last several months. How much of that do you think is going to help the airline then moving forward once we get to the other side of this pandemic, just in terms of maybe being able to draw in customers that previously wouldn't have flown Delta?
I think that it is going to be, I think it's a great move on Delta's part. I think that throughout this pandemic, as you said, Shauna, we've seen that Delta has been extremely proactive about really taking consumers' safety and putting it first above all else. And the fact that they maintain their middle seat open and a lot of other just messaging on their site has really been focused on consumer safety. I think it's really going to help them as we come out of this pandemic because they've not only been able to maintain the same loyal consumers that they have, but consumers that are starting to travel again and maybe a little bit trepid, whether they're vaccinated or not, I think will go to Delta as the go-to provider just because they have emphasized safety so much more above everything else and so much more than any other airline.
So SimilarWeb, we know, provides this kind of detailed data and deeper dives for clients who are going to make investment decisions. I want to ask you about the cruises, because I went on a cruise 1 billion years ago. It was easy to be good looking and young because of the cruise line I chose. I took my dad, just want to make that clear. But here's the deal. Carnival 4 million searches. And this was in January at a time when you really still couldn't go on a cruise. What is that telling you?
So I think that we're starting to see a small pickup in demand for cruises. However, in Carnival's case, and with a lot of other cruise lines, we are still seeing continued traffic to information pages, cancellation pages, and really pages where consumers are not necessarily booking on site, but may actually just be trying to figure out their plans a little bit more, especially with the ever-changing landscape. So Carnival actually recently announced that they will be kind of halting service until June, I believe. So I think that we're going to still see continued volatility in the cruise sector just for the next few months, but hopefully a pickup by summer.
All right, we're heading to spring break, so we're going to get you back after spring break as we're heading into the earnings reports for the travel industry. Alicia Kapoor is SimilarWeb's lead travel industry consultant. Thank you for joining us. We'll be right back.
President Biden's pick for trade, Catherine Tai, she was testifying in her confirmation hearings last week, talking about how she's going to approach the relationship with some of our allies, also signaled a tough stance when it comes to China, saying in that confirmation hearing that she will not hesitate to ensure compliance when it comes to China. Here to talk a little bit more about this, we want to bring in Stephen Lamar. He's the CEO of American Apparel and Footwear Association. Stephen, it's great to speak with you again. I understand that you sent a letter to President Biden last week just talking about China and some of the impacts that tariffs could have on your industry. I'm curious first, though, just to get your take on the comments that we heard from Catherine Tai last week during those confirmation hearings.
Yeah, well, thank you for having me on, Shauna. Look, trade is really important for our industry, for the apparel and footwear industry. We need access to global customers. We need access to global suppliers. We think U.S. Trade Representative is one of the most important agencies, and are thrilled that somebody of Catherine Tai's temperament has been nominated and hopefully will very soon be confirmed She's thoughtful. She's smart. She knows her way around the trade policy community. She knows her way around trade enforcement, which is very, very important, especially when it comes to China. So we're very excited about seeing someone like Catherine Tai become USTR, and then really rolling up her sleeves and working with us and working with other stakeholders to get our trade agenda back on track.
Stephen, good to see you again. Where do we stand on the trade agenda? Because correct me, I don't think the Biden administration has reversed any of the tariffs, which have been really detrimental to your membership.
That's right. Those tariffs are very detrimental. And one of the things we're asking the Biden administration to do is to very quickly remove the tariffs. You know, incredibly as it seems, we still have tariffs on items of personal protective equipment that come into the United States. In fact, in 30 days, the tariffs that that were not being charged on things like masks and gowns, those actually will take effect again. They will increase on March 31st. So right in the height of the pandemic, we're still asking the Biden administration to make sure that those tariffs don't take effect and that they can quickly revisit the other tariffs that they've imposed on our industry and other industries to make sure that they can quickly be removed. Look, during a pandemic is the worst time to be charging tariffs. It's a cost. It means that we're paying these taxes to the U.S. government, that prices get inflated. It denies us the ability to hire more workers, to pass along those savings to consumers. This is the wrong time to be adding tariffs. So we're hoping they'll be able to turn their attention to that as quickly as they possibly can.
Stephen, what have you heard from some of your members when it does come to some of those things that you just raised, when it comes to hiring, when it comes to prices and maybe higher prices being passed along to consumers? Has that already started to take effect, at least when we take into effect some of the tariffs that have gone into effect over the last several months and a couple of years?
Yeah. So when you look at tariffs have a way of kind of building themselves into the prices. Of course, individual companies will do individual things. That's their own decision. But over time, that tariff becomes part of the base price, part of the base cost, and it does get passed along to consumers. Conversely, if you're able to remove the tariffs, and this is one of the reasons why we're always asking for this, then you will be able to lower those prices over time or build in other savings, either through innovation, investments in innovation, or able to hire more workers, which is something that we're all trying to do. At a time right now during the pandemic, companies are really trying to preserve as much cash as possible because, there's so much uncertainty that's still out there. I mean, we think there's a really good opportunity going forward to make sure that we can get out of the pandemic. But there's so many questions that have to be solved. How well will the vaccine be distributed? Are Americans going to be wearing masks and practicing social distancing more? Will we see the COVID relief packages come through Congress and continue until the economy can sustain itself? Once all those questions get answered, then we might have a lot more certainty so we can plan to go forward. But right now, cash is king. People are trying to save on to those revenues. And if you have to pay those tariffs, those are revenues that you can't afford to give up.
I want to turn the focus into the United States. I'm glad you brought up cash, $1.6 trillion in savings. So I'm imagining your members, when we get everyone vaccinated, hopefully there's a spending binge that comes that helps your members. But there's also the organization binge. I mean, the workers in Amazon in Alabama are trying to organize labor unions. Has AAFA commented on, this phenomenon and what it might mean going forward for Amazon or for retailers in general?
We haven't commented on that, but we are actively looking at what we're seeing is this possible spending binge to get people, back out into the stores. Look, there's been a lot of activity where people have been shopping online, they've been shopping in the stores. There's been an increasing effort to integrate the online and the brick and mortar experience. We think there's this incredible pent up demand that's going to begin to materialize again when the economy when people feel safer that they can get back out there. There's a closet fatigue. People want to freshen up their wardrobe right now, and once that can happen in a more safe way, again, when the vaccines are out there in larger age groups and there's more vaccines available, the Johnson & Johnson vaccine now, which is only a one-shot vaccine, that should relieve some of the pressure. As all that stuff begins to happen, we think more and more people will be going out and shopping, and that pent-up demand will begin to unleash some real economic forces across the economy.
Stephen, when you're talking with your members, you mentioned the fact that hopefully this $1.9 trillion stimulus bill, hopefully that will lead people to spend a little bit more, especially when we get those direct stimulus payments. But what do your members specifically need from Congress? Do they need additional help at this point, considering that we're a year into the pandemic? And like you were laying out, there's still so many uncertainties ahead.
You're right. Well, one of the ones we've been pushing for is credit insurance. There's when you have uncertainty, you have incomplete financial information, you can't extend credit the way you could under normal times. And we've been asking the federal government to stand up a backstop, like they've done in a lot of the European countries, to help make sure those credit markets can function properly. There's back to work credits and credits involved, tax credits involved for a safe reopening and to keep stores safely reopened. So, make sure you can keep people employed, make sure you can keep people employed in a safe environment, and make sure you can offer that safe environment for the consumers. These are all the kinds of things that we're asking to be included in COVID packages. Some of them are in this one. There were some in the last one. We imagine there'll probably be another COVID package that will come along. And to the extent that things aren't included now, we'll ask for them to be included in the next ones coming up.
Stephen Lamar, great to speak with you, CEO of American Apparel and Footwear Association. We look forward to having you back once again soon. Coming up next here on Yahoo Finance Live, Johnson & Johnson CEO speaks with Yahoo Finance on the pharma giant's COVID-19 vaccine debut and also how big of a game changer it may be in controlling the pandemic. We're back with that in just 2 minutes.
Shares of Johnson & Johnson have been trading higher all session. That, of course, on the news that the FDA has now approved and they are distributing under emergency use authorization J&J's one-shot COVID-19 vaccine. Alex Gorsky is the CEO of Johnson & Johnson. He spoke with Angelique Kamlani about the vaccine just about 2 hours ago.
We knew that it was going to be important to try to do it in one dose because the logistics, the administrative challenges of having 2 doses or having significant refrigeration could also get in the way of access. And last but not least, and went to one of your earlier points, to do it on a not-for-profit basis because we didn't want cost, we didn't want price to get into the way. we felt that that was the way to be the most comprehensive, holistic approach, not only here in the United States, but let alone around the world.
Let's talk about all of this with Dr. Sejal Hati, is the physician and clinical fellow at Massachusetts General Hospital and host of Civic RX, the podcast. Thank you for joining us. Doctor, help us understand, is this a game changer that Johnson & Johnson's vaccine is now available?
Oh, absolutely. I think it's incredible news for all of us. We should all be encouraged that we now have 3 excellent vaccines available to administer to Americans all across this country. You know, people focus really on these top line numbers, and more specifically that the Johnson & Johnson vaccine is 66% effective at preventing moderate to severe cases of COVID-19. And they compare that to the Pfizer and to the Moderna vaccines and say, well, is it an inferior choice? How thrilled should we be? And the reality is that the most crucial measure that we must consistently look at is hospitalizations and deaths. And on that front, the J&J vaccine approaches pretty significantly the Pfizer and the Moderna vaccine. So all 3 vaccines here are excellent. All 3 I would recommend to my family, my friends, my patients. And of course, there are many advantages to a single shot vaccine that can be stored in much warmer temperatures as the J&J vaccine is over the Pfizer and Moderna.
Yeah, doctor, I wanted to ask you about that, because when we talk about some of those advantages of just having a single dose vaccine, I guess how much faster do you expect us to be able to get the American public vaccinated when one of the 3 vaccines that have now been approved is just a single dose?
That's an excellent question. And, currently about 75 million Americans have been vaccinated. That's about 15% of the population. And what I mean by that is have received at least 1 dose of a vaccine. And at that rate, namely 1.7 million doses of vaccine a day, it would still take until approximately Thanksgiving for us to achieve herd immunity, which is the level of immunity that we need really to stop transmission and make this not a concerning pandemic. But with Johnson & Johnson in place, in which we only really need that 1 dose, things are looking up for all of us. I think that we can definitely look to hopefully accelerating the amount of doses and therefore the amount of full vaccinations that we're able to give Americans over the course of the next few weeks. The challenge, of course, is that right now, Johnson & Johnson really only has 4 million doses available that they're shipping this week. And it's probably going to take at least until April for that 100 million doses that the federal government has purchased to get out in distribution. But the news is still bright, and I expect that we'll be moving a lot faster now with them on board.
Should we be concerned because they were promising that we would have the 100 million doses much sooner than they're going to be able to deliver, that there might be mistakes they make at the facility in the Baltimore area?
I wouldn't necessarily think that there are mistakes that we should expect. I think inevitably vaccinating millions of Americans a day is a Herculean undertaking, and there will be hiccups along the way. But I think that we can expect these doses to be produced as fast as is possible. And I think the federal government and the Biden administration is pushing them to get moving. So it probably will take until April for those doses to be delivered. But thereafter, once we ramp up, I think things will be looking better.
Dr. Sejal Hati is the physician and clinical fellow at Massachusetts General Hospital, also the host of Civic RX, the podcast that you can listen to. We appreciate your being here on Yahoo Finance Live. And when we come back, a new study reveals just how big a toll Zoom fatigue is taking on American workers across the country. Its author is going to join us with the details right after this.
Let's talk Zoom fatigue and maybe a feeling that you have felt over the last several months. Well, there's a new Stanford study out that finds that Zoom meetings are actually causing more stress than in-person meetings. And we want to talk more about this with Jeremy Balanson. He's a Stanford University Thomas More Stork Professor of Communication and also founding director of Stanford University's Virtual Human Interaction Lab. Professor, it's great to have you on the program. A very interesting study that you just released and really bringing into focus this term that I think many of our viewers can probably relate to over the last several months when we talk with Zoom fatigue. I guess my first question is, what's causing it? What's behind all the stress when it comes to Zoom?
Look, first of all, thanks for having me on. It's great to be with you. Zoom, first of all, is an amazing tool. It's kept us productive. It's kept us having some social lives. The software works all the time, and it's free. So before we go on to fatigue, I do want to just say that thank you to Zoom for making such great software. The challenge is the interface has features about it that do things that we don't do in the real world. And what we've isolated is 4 main causes of Zoom fatigue. And I'll start with the first. The first one is about seeing yourself in the mirror all the time. So imagine in your physical place of work, somebody was following you around with a handheld mirror, and everyone you talked to, every decision you made, you were forced to look at a mirror image of yourself for the entire day. I mean, that's bonkers. Nobody would do this. Yet on Zoom and other video conference platforms, the default setting is having the self view on. And what psychological research as early on as the 1970s has shown is that when you're forced to see a mirror image of yourself or a real-time camera feed, that you actually scrutinize yourself and evaluate yourself, which leads to negative affect and stress. And so the first problem with the interface is that it's causing us to look at a mirror all day long, and this is not good for our minds and our well-being.
I got to remind you, I used to work at Fox, so that mirror analogy, that was there years before Zoom. But forgive my bad humor.
You know,
what do we
people like you and people that work in dance studios, you know, they've got mirrors all around them. And so some people have had.
What do we do with this information? Because we're not going to go back. I mean, I'm doing it right now. I can see myself, and I'm not picking my nose as much as I used to, perhaps, but I can see myself. It gets boring.
Yeah, so the best piece of advice I can give to our viewers is right-click your self-image on Zoom. There's a function called Hide Self-View. And what that does is others can still see you, but you're not forced to look at yourself. It's a really easy fix.
Professor, have you spoken to Zoom at all about these findings, or have you had any conversations just in terms of whether or not they are aware of this issue?
I've had some preliminary conversations, but we haven't sat down to really talk it over. But I'm looking forward to that. And because, again, I agree with you. We are not going back to this 9 to 5 commute every single day for knowledge workers. And just a few fixes on the interface is going to make this flow a lot better. And so the second cause of Zoom fatigue is the extreme closeness of faces and eyes. And so I want you to think about being in an elevator. And in an elevator, people are forced to get close by you. They have to violate your personal space. What do? You look down or you look at your phone. Same thing for a subway. Imagine you were riding a subway and every single person on the subway car turned their bodies and stared at you for the entire subway ride, how uncomfortable you'd feel. The default for Zoom is this grid. All the faces are staring at you. And if you really stop to think about that, if you're a listener in a meeting, no one's staring at you. What Zoom has done is effectively caused listeners to have the same anxiety of speech as speakers because you have faces staring at you for the entire day long, even if you're not the center of the meeting. And this causes arousal, it causes the fight or flight reflex to kick in, and it causes us to have stress.
How much of this is just the invasion of the office into our homes? I mean, many of us work from home, but this now requires us to live at work. And that in and of itself is fatigue producing.
That is fatigue producing, but there's nothing I can do about that. So if you read this piece, you'll learn that I'm trying to come up with solutions. And I like the fact that we're not burning fossil fuel and flying all over the world for meetings. We're going to be forced to live in our home, so to work in our homes. So I am focusing on solutions. So for the close-up faces with everybody staring at you, what viewers at home can do is if you go to the top right of your screen, there's a button with a square in it that'll cause the Zoom window, instead of being full screen, it'll shrink down. And I've actually started taking all of my Zoom meetings by making the window be about 1/8 the side of the screen instead of the whole screen. Now you don't have these huge faces staring at you.
Is it affecting men and women the same, or are you seeing maybe one sex affected more than the other?
So there's a lot of research especially on the viewing oneself image, that shows that this affects women more than it affects men. We are currently running 3 or 4 large studies. We're currently at about 10,000 users who have gone through our ZEF scale. So viewers, please go to your search engine and type in the Stanford ZEF scale, Z-E-F. It's free. It's free for you to do, and you can do the Zoom questionnaire and see about your own Zoom fatigue. And about the gender question, we are looking at the difference between men and women, and we're seeing some differences that I'm not prepared to talk about specifically yet, but there's a lot of reason to suspect that this is affecting women more than men.
Certainly have given us a lot to think about this afternoon. Professor Jeremy Valentin, thanks so much for giving us your time.
Oh,
we're going to take a quick break here on Yahoo Finance, but when we come back, Warren Buffett releasing his widely read shareholder letter over the weekend. We're going to talk to Yahoo Finance editor-in-chief Andy Serwer and get his reaction right after the break.
Markets trading higher as we head to the closing bell. Let's bring in our editor-in-chief. That's Andy Serwer, because when Warren Buffett speaks, we all pay attention. And his annual letter to shareholders, a lot of issues there, Andy. And one of the big ones was making the case for a stock buyback. In his case, buying back his own stock. Can you tell us more about how he's justifying it?
Yeah, well, basically, he bought back almost $25 billion worth of Berkshire Hathaway stock in 2020. And you know, buybacks have increasingly gotten a bad name at them. And in fact, even Joe Biden was saying that this is something companies should be very, very wary of doing. And the reason why is because it's actually twofold. Number one, first of all, it essentially means you're timing the purchase of stock. And executive CEOs have done a terrible job, often buying when the stock is high and then the stock goes down and they look like idiots. And the other thing, it gives an advantage to the shareholder class at the expense of, let's say, employees. So in other words, instead of spending billions of dollars giving employees raises, you use that money to buy back stock. And who benefits? The top executives benefit more than anyone else because their compensation is usually based to a large degree on the stock price performance.
And you've been covering Warren Buffett for years, and someone who is so closely watched here, not only by us journalists, but also by investors, by retail investors as well. When you take a look at, and you unpack this in your article here over the weekend, but I guess, what do you think it is when you drill down, when you look into this fascination with Warren Buffett? What did you conclude just why so many people follow him so closely year after year after year?
Yeah, it's sort of what makes Warren Buffett special, Shauna. And, I kind of came away with this one word, and that word is wisdom. And then I was thinking, well, what is wisdom really? And wisdom, of course, is being smart. But a lot of people are smart and make bad decisions. So it's being smart and making the right choices, being right. And then the third element, I guess, would be being smart, making the right decisions, and doing that over time. So that is wisdom. And wise people in this country, I would submit, Shauna, are not necessarily revered as they are, for instance, in other countries like China. We like our rogues and our renegades. So when someone becomes sort of a wise person, a lot of people follow them, but some people sort of poo-poo that. And you see some of that with Warren Buffett, but I guess still a lot of people do follow him.
Andy Serwer is our editor-in-chief. We have much more for you on Yahoo Finance Live as we head to the closing bell right after this. We're heading toward the closing bell on Yahoo Finance Live, and helping us get there, Jay Jacobs, Senior Vice President and Head of Research and Strategy at Global X ETFs. Also, Lamar Villere Balanced Fund Portfolio Manager. Lamar, there's that expression, I'll butcher it, forgive me, that nobody ever became poor taking profits too early. Is now the time to take some risk off the table?
Absolutely. I think, you've seen a massive run, particularly on the growth side, and then more recently in the small cap side. So, the NASDAQ is up almost 60% in the last 12 months. So that's before the pandemic really hit, or at least the shutdown and the market tanked. We're up almost 60% since then. So I think you want to stay invested, but maybe take a little bit of that risk off the table look for a little bit more of a value type posture.
All right, Lamar and Jay, just hang on tight. We want to head to our markets reporter, Jared Blickery, for a closer look at some of these movers into the close. And Jared, we were talking earlier, quite the rally underway with all 11 sectors, it looks like, trading in the green.
That's right. And we got the Russell 2000. That's a big outperformer of the day, up about 3.3% here. So nice start to the month of March. The best start for the NASDAQ since 2020. That would be 1 year ago. I checked, so I just had to say that twice. All right, Apple's up over 5%, Facebook, Alphabet each up over 2%, Tesla up 6%, PayPal 7%. So a lot of these names, and also Zoom, by the way. Zoom's up about 9-10% today. Announcing earnings after the bell today. We're going to be bringing that to you live. But Pinduoduo, that's a stock that saw some selling last week on the concerns over China tightening. Tesla's back in the game, Splunk. So the list goes on. And it looks like some of the software and chip names that were getting beat down last week are back in focus here and trading on the right side. So we got Microsoft, that's up 1.8%, Adobe up 2%. And just taking a look inside the chip sector, we're not going to spend too much time on this. See Broadcom and Intel and Applied Materials, Micron, those are all up over 3%. Lam Research up 5%. So nice to see this outperformance in a group that doesn't always get mentioned, but is definitely a big part of the tech story. And let's take a look at the pharmaceutical scene here. And we got J&J up 0.4%, providing a lot of optimism with that vaccine news today. We're also going to bring you Novavax earnings right after the bell. And guess what? Ahead of these earnings, up 4% today, although you can see over the trailing month, down about 10%. We're looking for an adjusted loss of something like $2.30 per share. Do not quote me. But let's also take a look at the commodity complex, because we have crude oil settling down today, but guess what? Energy has been on fire as of late, not the best performing sector today, but still up over 2%. Crude oil did close down, but there is optimism over OPEC Plus. What's being priced in right now is a 500,000 barrel per month increase by the complex. And also Saudi Arabia is expected to stop that 1 million barrel per day voluntary production cut that they've been doing. So if all that priced in and we got crude oil still holding around, $60 a barrel here, I'd say all is well in the oil market for the time being. Also taking a look at cryptocurrencies here. Now we got Bitcoin coming off of that 43,000 low that we saw over the weekend, up 8%. Ether's up 9%. Just got some news today that Goldman Sachs is restarting its crypto desk. Hopefully this isn't a sign of the top, because guess what? They closed it down right at the bottom. Here's the closing bell on Wall Street.
And that wraps up the trading day today. Again, a broad-based rally that we saw to start the month of March. You can see it on your screen. The Dow closing up just over 600 points, so off the highs of the day, but still a massive rally of nearly 2%. S&P closing about 2.4%. NASDAQ was by far the leader today, closing up just around 3%. Some of those big tech names that Jared was just rolling through really leading today's action. Apple was up over 5%. Google and Facebook both up just around 2%. Sector-wise, all 11 of the S&P sectors trading to the upside today. Financials and technology are the two leaders. We want to bring back in our markets panel. We have Lamar Villery. We're also joined by Jay Jacobs. And Jay, let me go to you. We just heard from Lamar just about taking some of that risk off the table. What do you make of the levels that we're currently trading at? Do you think some of this exuberance in the market is a bit overdone?
Well, we certainly have high valuations in the market right now, but there's positive things to look forward to. A lot of people are expecting growth in the United States at over 6%. We just saw the J&J vaccine get approved and basically a huge increase in distribution of vaccines. So I don't think we're far from I think we have a while to go until we reach the top, because there's a lot of good things that can happen over the next 6 months that are really going to get this economy roaring back to life.
But look, from a larger perspective, Global X China Disruption ETF, you've just launched that. And I'm curious, how are you identifying funds or the members of the ETF looking at what's happening in China?
Yeah, so we've been doing thematic investing for 10 years at Global X and looking at things like cloud computing and e-commerce. at a global scale, looking at what's happening in the United States and Europe and Asia. But what you see is that within China, it's such a unique market. It starts at the top with the government looking and making these 5-year plans, these even 30, 40-year plans sometimes, and identifying these key industries that they want to support and grow through an increasingly privatized market. And it behaves very differently than what we see in the United States, which is a more kind of organic form of innovation. So we're looking at from the top down, what are these powerful themes that largely the government is setting as the priorities for China? And then our active managers are picking the stocks that are really leading in the development of those innovations going forward.
Lamar, what do you make of the value versus growth trade right now? Where are you finding the most opportunity?
Right. So, traditionally we are growth investors, more growth at a reasonable price. We're not buying the super aggressive Tesla type names. But right now we have been finding a little more value in the value names. So some of these growth stocks, like I said earlier, the Nasdaq's had such an incredible run. The Russell 2000's had such an incredible run that really we're moving a little bit more towards slightly more defensive posture. Kind of, things like in the healthcare sector, financials, that type of thing where, again, we're staying invested. I do agree. I think the economy looks to be in very good shape. But given the valuations, we think it's prudent to take a little bit of that risk off.
Well, some of the stocks, Lamar, that you highlight when you talk to people, for instance, Steris, I think it is. What makes them attractive from a healthcare perspective? What is it that they do?
Sure. So Steris is basically focused on all things infection prevention. 1 in 20 people who check into a hospital wind up catching an infection from the hospital. It's a $10 billion a year problem here in the U.S. So Steris is focused on prevention of that. We think that's a very defensive way to play the healthcare space. And at the same time, you're getting almost a 1% dividend yield, which used to seem like an afterthought, but now in this interest rate environment, that's actually a pretty meaningful dividend. So some nice growth, defensive growth, while getting a dividend at the same time. That's the kind of place where we're finding a little bit more attractive valuations.
Jay, at what level will you start getting a little bit concerned about the 10-year yield? Because it sounds like at least at this point, you're still not worried about some of the levels that we saw last week when it reached that new high.
Yeah, we just have to go back and realize, we were in an extraordinary period where the 10-year yield was well below 1%. So this is really a normalization with not even, long-term normal trends. This is a normalization with just the last few years. If we were to really see a normalization with long-term trends, you could see a 10-year yield, back at 2.5%, 3.5%. So this is still pretty small potatoes. Of course, the market is going to get whipsawed around whenever you see bond moves move as fast as they did in the last few weeks. But at the end of the day, I think the market is saying, this may have been a little bit premature. We saw a lot of buying of tech stocks, which tend to be a little bit more sensitive to 10-year yields. But we saw a lot of buying of that today. So I think we're just trying to absorb a little bit of yield movement, but it's not changing the course of people's expectations for the growth of the economy or the attractiveness of these high-tech names.
We have some breaking news here. Novavax is out with its earnings report. Jared Blickery has that for us. Jared?
Speed on the top line number, but not the bottom. So let's get straight to those numbers. Revenue coming in at $279.7 million versus $8.82 million a year ago. That's much higher than the estimate of $202.6 million. But the bottom line number coming in with a loss per share of $2.70, and that is quite a bit wider than the estimated loss of $2.24. Also noting that cash and cash equivalents ended $553.4 million versus $78.8 million a year ago. Now, here's some commentary from the release. They're saying that significant increase in revenue was comprised of revenue for services performed under the Coalition for Epidemic Preparedness, Innovations, Agreement, and Participation in Operation Warp Speed. So my read of that is it's expensive to be in the vaccine business, but hopefully it pays off eventually. Now, fourth quarter research and development expenses, those increased to $401.2 million compared to $29.3 million in the same period last year. Now let's take a look at the charts here on the Wi-Fi Interactive. You can see the stock's up about 3% now after reporting those results. Investors don't seem to be too concerned about those increased expenses. And you take a look at a one-year chart here. You can see quite the wild ride for Novavax, up 1,400%. So just wrapping it up here, we got a beat on the top line, but a miss on that bottom line. Bigger loss than expected, guys.
Jared, thank you. We're going to hear more about Novavax from Angelique Hemlani in just a bit, but I want to go back to Jay on something. It is expensive, as Jared points out, to be in the vaccine business, but one of the ways you can protect yourself is to be in a healthcare style ETF. You guys got EDOC, which closed up about 2.5%. And part of the holdings in that has to do with mental health and the fact that people can now do that. You don't have to lie on the couch in the office. You can do it at home on the Zoom. How big is that?
That's an enormous market. I mean, the broader enormous market here is telemedicine, because as we see the expenses of medicine rise, whether it's pharmaceuticals, whether it's healthcare service providers, keep rising every single year, we have to find ways to make it less expensive. And part of that is, can you talk to your doctor at home? It's more efficient. They don't have to, wipe down the exam room. They don't have to host you in a park, driving into a parking lot or in a waiting room. It's these little areas where you can cut and make savings in healthcare where it's not going to impact the service at all. Still, in many ways, it's actually better for patients, but it's going to reduce the cost. And I think looking at areas like telemedicine that is improving the scale of healthcare, improving the reach across more people, no matter where they are, and improving efficiency is going to be key to kind of getting the healthcare system out of this pandemic, which has been, a nightmare for the healthcare system, aside from the tragedy of it.
Lamar, the one thing we haven't talked about yet is the negotiations going on down in D.C., whether or not we're going to get this $1.9 trillion coronavirus stimulus package. Looks like we are going to get it. What impact is that going to have on the markets, if any?
I don't think it's going to have any impact. I mean, the only somewhat question mark is whether somehow the Senate manages to get the $15 minimum wage in, but I don't think any investors are particularly focused on that right now. It's pushed off. It looks like it's not going to go through, and it's pushed off for a while anyway. I think absolutely the expectation is that it's going to go through, and that you saw that in a move like today. That's obviously a very optimistic move. I think investors are assuming that's going to happen.
Lamar, when you say that consumer behavior is coming back faster than expected, where are you seeing that? Is it in we had a guest on in the last hour, travel-related issues as people try to get out of their homes, out of lockdown?
Yeah, with travel, we have one of our core holdings is Caesars, and Caesars is seeing incredible demand. So, and all the companies or all the portfolio companies we have that have exposure to consumer, we're seeing consumer really pick up and a lot of confidence. So it appears that, maybe they're booking a few months out. Some are booking sooner, some are booking later, but people are booking things. People are getting out of the house and really looking for ways to spend their money right now.
The earnings keep rolling in. Zoom is now out with its results. Shares moving higher once again here after hours. Jared, what do you have?
Speed in a raise here. Zoom's up about 5% on the Wi-Fi Interactive. But let me go through the numbers here because we got the fourth quarter results. Adjusted EPS coming in at $1.22 per share. Estimate was for 79 cents. So that is quite the beat there. Remember, this company came to the market, listed on the exchange when they were already profitable. Also, revenue of $882.5 million versus the estimate of lower estimate of $811 million. Free cash flow also beating estimates, coming in at $378 million. Estimate was for about $202. And then the cash and cash equivalents on its balance sheet, $2.24 billion versus the estimates of $1.05 billion. So literally doubling that. And then the forecast is looking pretty good as well. They're seeing revenue of $3.76 billion to $378 billion. Estimate was for lower at $353. Also, adjusted EPS for the full year, they're expecting that to come in at $359 to $365. Estimate was for quite a bit lower, about $2.97. So hitting on all those key metrics all around here. Like I said, nice beat in a raise, stocks up about 5%. Also noting that this was our stock of the year, company of the year for 2020. It's still off about 30% from its highs, but you can see after consolidating after the last few months here, it'd be really nice. And maybe this is a catalyst that it has to create a new rally. Maybe you can search those old highs again.
Jared, thank you. And also thank you to Lamar Villere Balanced Fund Portfolio Manager, and Jay Jacobs, Senior Vice President and Head of Research and Strategy at Global X ETFs. All the best to all of you when we come back. The social networking app Clubhouse is one of the hottest startups of 2021, and one of its early VC investors will join us on where he's seeing the next big opportunities in tech. That's next.
Clubhouse is probably an app that many of you have heard about. Certainly its popularity has taken off over the last several months. It just launched last year. We want to talk a little bit more about this with a Clubhouse early investor, also talk about the broader VC landscape. And for that, we want to bring in Rahul Abora. He is the CEO of Superhuman. Rahul, great to talk to you once again. Let's just start with Clubhouse, because this is an app that we've talked about a number of times recently when we talk about the fact that it's just exploded in popularity. You were one of the early investors in this. I guess, why do you think this app is resonating so well with its users? And what does it more broadly tell us about what users want when it comes to social media these days?
Great question. Well, you're right. Clubhouse is the hottest consumer app we've seen in years. It is an app primarily for casual drop-in audio conversations, which I think is a new concept for many of us. Unlike Twitter, which is about broadcasting, Clubhouse creates a space for live interactive conversations. And unlike podcasts, which are polished and recorded, Clubhouse conversations are raw, authentic, and ephemeral. It's like the best of a podcast and a party together in one amazing app.
So explain very simply in just easy to understand language how it works, because there's someone who moderates, but if all of us go into the app, how do we keep from talking over each other?
Well, there are different rooms and users can freely travel between those rooms. There's usually a small number of speakers, perhaps 2, 3, 4, or 5, talking in any given room. Imagine a personal hero of yours is talking on Clubhouse. You happen to casually drop into the room to see what's happening. You have a thought, you hit the raise hand button and you're invited to speak. You are now talking to your personal hero, and chances are they'll talk right back. Now, Twitter can give you a little bit of this, but with Clubhouse, it feels authentic and intimate, which is why we are witnessing the birth of the next major social network.
How about just more broadly speaking, the VC landscape and some of the interest and some of the deal spike that we have seen, not only since the start of the year, but really going back to the end of 2020? What do you attribute this to? And I guess, are you confident that this type of momentum is going to carry out through the year?
Yeah, great question. So the VC landscape is super red hot. We are at peak activity. Deal velocity and valuations are at an all-time high. So to put that into perspective, looking back over 2020, US venture-backed companies raised $133 billion. That is despite COVID, and it's not only up 14% year over year, it is also a historical record. So the other part to your question is, what is driving that? I think it's because we're seeing very high public markets, primarily as a result of vaccine optimism and also the Fed's commitment to keep interest rates low for the time being. That said, the medium to long-term outlook is still a bit unclear, and so investors are looking to invest that wealth into private companies. So this influx of capital is creating a technology investment frenzy, and that's further accelerated by the fact that all deals happen over Zoom now. So it is no longer uncommon to hear a pitch, sign a deal, and wire money all in the same day.
Why will Clubhouse succeed where, and I'm going to go back in time a little bit. You remember Martin Shkreli, and I'm not equating you in any way with him, but the pharma bro who's in jail right now used to do these video chats with lots of people. You'd raise your hand, pick, and then he'd let you talk. How is Clubhouse different than those things? Because those video apps, I can't even remember the names.
Yeah, great question. There have been many goes at this problem. Many apps have tried to do it. You could argue that Clubhouse was exquisitely well-timed, having come out in a pandemic where we were all starved and craving for social interaction. And it was also exquisitely well-designed. All of these other competing apps, they were slightly more complicated and they didn't work quite as well. Now, as for why it will succeed, I think the question we should be asking is, well, what about Facebook? What about Twitter? It's generally known that they're building competing apps. What will happen? And I think Clubhouse will succeed despite all of that competition. Twitter generally doesn't do well when they launch new apps, and Facebook has mixed success. Instagram Stories, a copy of Snapchat Stories, incredibly successful. But Instagram Reels, which is a copy of TikTok, hasn't done anywhere near as well.
Well, and Rahul, just stepping back a little bit and looking at the social media landscape, there's lots of questions out there, not only when it comes to social media names, but some of these other big tech names about what the Biden administration, how they're going to approach some of these issues when we talk about potential regulation, what that could mean for growth here going forward. What's your current read on that? And then what do you think, I guess, is likely as to whether or not we will see more regulation during the Biden administration?
You know, I think it's anyone's guess as to whether or not we'll see more regulation. Chances are that we're likely to see some form of regulation, but it's unclear how that will play out. I think the one thing that we can all agree on is, as a country, we've seen firsthand just how dangerous social media can be. It has literally divided us as a society. And one of the things I'm excited for in backing founders like Paul and Rohan, they're the founders of Clubhouse, is they're not planning to lean into, for example, advertising as a primary model. They want to find a way to monetize the creators and the users on the system directly. And I think as an industry, if we move away from advertising as primary towards other forms of monetization, we can find a way for social media to exist, but also be a really healthy force for humanity.
Rahul Vora, great to have you on the program, CEO of Superhuman. We're going to take a quick break, but when we come back, the CEO of Novavax, a COVID-19 vaccine hopeful, joins us on the company's latest earnings results, and also he'll weigh in on where things stand on its highly anticipated late-stage trial results. That's all happening in just 2 minutes.
A French court found former President Nicolas Sarkozy guilty of corruption and influence peddling. He was sentenced to 1 year in prison and 2 years suspended. The 66-year-old disgraced politician can request home detention. The charges grew out of a campaign financing investigation. California's medical board is investigating plastic surgeon Dr. Scott Green. Check this out. He appeared Thursday in a traffic court via video conferencing while he was in the operating room operating on a patient. The judge told Green it was not appropriate to proceed. Green apologized and pointed out another surgeon had taken over. Lady Gaga's stolen dogs are home, safe and sound. That's after an unidentified woman brought both of them to the LA Police Department. Now, the dogs were stolen when somebody shot the celebrity singer's dog, Walker, last week. He is expected to fully recover from his injuries. Police say it appears the woman who delivered the dogs to the police department was not involved in the robbery. Turning our attention back to COVID-19 and the companies which are making vaccines, Novavax released their earnings this hour, and Anjali Kamlani has a recap for us as well as a bit of the discussion she had with their CEO. Anjali?
That's correct, Adam. We know that the company has been a clinical stage company for quite some time, and this could be the year that it turns a profit. We've seen similar stories with companies like Moderna and others that are in the therapeutic space that are hoping to sort of ride the COVID wave. I had a chance to speak with the CEO, Stanley Erck, about just that and when they plan to see that come to fruition. So here's what he had to say.
In the United States is we just ran a trial. We've just enrolled 30,000 people in a trial. We enrolled 30,000 people in something like 6 weeks. They're all enrolled. We're accruing cases now is what you have to do in a trial. And our expectation is that we'll have enough cases in that trial in the U.S. to have data maybe a month or two later than the UK. So the question on timing is, will the FDA feel comfortable using just the 15,000 person study in the UK and the South African data? Will that convince them to evaluate for EUA? And that decision will cost a month or two as to when they look at it. If they wait for all of the US data, then you've got a lag of a couple months. If they evaluate the UK data, they'll be within a few weeks of the UK approval. So.
Definitely waiting to hear to see if they'll accept that for sure. I know they've been asked about it. But looking at how the other companies have handled EUAs right now, if you do in fact have to wait until the full process is done, what learnings can you take from what has already happened to apply it to when you have to apply for the EUA?
Well, it's just. What lessons have we learned? I think what we will learn by waiting for all of the U.S. data is that we'll have a much bigger safety database on top of the one we already have, and plus we'll see what the impact of whatever strains are circulating in the U.S. are and compare it to the UK and the South African data. It just gives a bigger database to the FDA. It's all the same data. I mean, it's all the same manufacturing data and same safety database that we're building. So, yeah.
Fair enough. And talking about that, the manufacturing, I know that's been really a topic of conversation for the U.S., with different reasons why hurdles were met. I know that you've done a lot, and last time we spoke, you mentioned the significant expansion that Novavax has not just invested in, but also through partnerships been able to achieve. So looking through that lens, what do you anticipate, or what have you seen in terms of waiting for the buildup for the U.S. doses?
Yeah, so we're building up doses now. Now we've now started. There are three parts of the vaccine. There's the making of the spike protein, which is a biologic. It's one process. There's the making of the adjuvant, which is a chemical formulation process, and then there's putting it all together in what's called fill finish, where you fill it into a vial, put the vial into a box, and have a label and all that sort of thing. So all three of those are now on our radar screen, and we're actually filling. We just started filling recently so that we can build up inventory so that by the time we get EUA, we'll have lots of inventory that we can ship immediately.
Okay. So now looking forward, this is obviously going to be able to help boost the company really and put it on the stage. I've seen some projections that count Novavax among the larger vaccine companies in coming years. So talk to me about the pipeline right now. I know there's also a flu combination COVID vaccine in the works. What else do you have on tap?
Well, so it turns out over the last decade, we have three vaccines that have been in phase 3 pivotal trials. We have an RSV vaccine, respiratory syncytial virus. It's the biggest cause of hospitalization of kids under 1 year old, and it's also a big cause of hospitalization in older adults. And that's a very important vaccine. People have been working on it for 60 years, no success. So we're hoping to have that vaccine with us. But it's a seasonal respiratory vaccine, just like flu. And 10 months ago, we announced pivotal phase 3 flu data and showed that we have potentially the best flu vaccine in the world. And you combine that with a COVID vaccine, with the data we have for safety and efficacy there, and they all use the same platform. So in theory, long-term for the company, we can not only get through the pandemic, but presumably COVID is going to be a seasonal annual vaccine. And you can combine 2 or all 3 of those pathogens, viruses, in one vaccine. So you get one shot protected against the 3 most common causes of respiratory illness. It'd be huge.
Absolutely. And I know we're all waiting to see how that happens, but talk to me now about the way that this is affecting the company financially. You've been, in a clinical stage, as a clinical stage company for quite some time. The COVID vaccine could be the first vaccine to make it to the market. And you've already had so much investment, combination of funding from the government, plus the expense that you've had to put in, not just in research and development, but also, for regular expenses and for the expansion. So what does it look like right now? Are you now, fully revenue-making company?
Yeah, well, we've done something in the last year that probably in normal times would take 3 to 4 years to build. We've gone from, we had $100 million in the bank a year ago, which was about 6 months worth of money. We now have well over $1 billion in the bank, with more coming in from advanced purchase agreements and grants. We have, a market cap that was $100 million a year ago, and it's in the $15+ billion range right now. And so that allows us to have financial flexibility. We had 150 people total in the company in the US, and in Sweden, we now have 800 people in the company. And that's all built within the last 6 or 7 months. And so we've been able to attract just spectacular, experienced manufacturing engineers, scientists, clinicians that have all developed products in their pastime, and to come here is an easy shift because you're working on one of the most important problems in healthcare. And so we've got a lot of good people. It has changed the company dramatically. But it's fast. It's 24/7, literally 7 days a week here. And I just got asked how my weekend was, and I said, what? So anyway, but that's what we're doing. And we will become, this year, our expectations are that we will be a revenue-generating, profitable company based upon COVID this year, and then expanding that to our platform as well.
So as you can hear, really a lot of energy behind this company right now, knowing that it's been a clinical stage company for quite some time, but we don't have a clear date on the vaccine just yet. As you just heard, the idea still sort of on the table of aggregating the clinical trial data from different countries and then submitting it to the US. I did speak to him after the call and after the interview, and he did say that, the FDA hasn't responded to that idea yet, but it is something that they have done in the past. So it remains to be seen whether or not they'll do that as well during this pandemic. Back to you guys.
Angeli, thank you very much. Coming up, it may be one of the oddest booms of the COVID era, demand for home plants going through the roof. This CEO of one of the biggest companies in the game will join us next. Maybe he'll give us a few tips on ways to prune the perfect bonsai tree next.
Demand for home plans, they certainly have exploded since the start of the pandemic. Now, Bloomscape, it's one company that's benefited from this. They're expanding as a result of what we've seen over the past year. We want to bring in Justin Mast. He's the Bloomscape's founder and CEO. Justin, it's great to have you on the program. We've talked time and time again just how COVID has affected consumer behavior, what people are choosing to spend their money on. What kind of impact have you seen on your business over the past year?
Yeah, well, plants have been a real source of comfort and a really healthy activity for a lot of people this past year. And, we've been really thrilled and honored that we've been able to support this and meet the demand and deliver a lot of plants for people.
So how do you keep it going after we're all vaccinated and some of us go back to the office?
Yeah, it's a good question, Adam. I mean, these trends are trends that really existed before the pandemic started, but got accelerated this past year. So we're seeing that, our core customer base, millennials, have been getting into plants. It started with succulents, then, moved to indoor plants. And now people have really picked up gardening these last couple of years as we've moved into homes, moved out of the city or into bigger places. So this is something we really expect to continue as we start to move into this next phase of whatever normal is.
And speaking of expansion there, I know you're launching a new line of outdoor and patio plants, kind of goes with what you were just speaking about. What do you think the opportunity is there? And I guess, how are you competing against some of those much bigger names in this space?
Yeah, I mean, this program was really born out of two places. I mean, first, this past year, we've had an amazing amount of requests from our customers to start offering outdoor plants. And so, this line of porch and patio plants and flowers is something we're pretty happy to be able to offer. But this really has roots that go back a long way for me. I mean, I grew up in the greenhouse business and had a little plant stand selling porch and patio plants outside my parents' greenhouse growing up. So, even back as an 8-year-old, seeing how people really light up when they can buy really high quality product that's fresh from the greenhouse, talking to people who really understand the product and want to make sure that they're successful. It's something that we're doing now with this program, but goes back a long way too. And so, to answer your question, I mean, we are taking a different approach with this program. It's young plants, so they're kind of like really big seedlings that are going to come in a box in a kit that our customers will be able to plant themselves. And so we wanted to save a lot of the thrill of seeing, those first few weeks, the plants really take off in your yard. We wanted to make sure our customers could experience that.
I'm recalling, I think we spoke to you several months ago, and we should point out, you're still headquarters right outside of Detroit. So when you talk about
the city of Detroit.
Yeah, I mean, that's key. What are the hot sellers for those of us who have green thumbs outdoors, but not so well indoors?
I mean, anything that's pet friendly and low maintenance is always a hot seller for us. Right now we've got this fishtail palm on the site that is really beautiful, easy to care for, and safe for your furry friends.
How have you been able to keep up with the massive growth? I mean, you're obviously growing your company, but you're still relatively small. So what has that process been like?
I mean, with a lot of support. I mean, we have an amazing group of investors and advisors that have been behind us every step of the way. We had a really strong core team. And, since this time last year, we've more than doubled the team. So we've brought on a lot of new help as well. It's been tricky to scale a business this past year, but, we've done it, and we're pretty excited.
And where are you shipping most to? Is there any one particular part of the country?
All over the country. I mean, we have customers on both coasts, in the middle of the country, city, suburb. I mean, you name it, we're shipping there. We've seen a lot of our customers move from more concentrated, downtown areas out to townhomes or even to the suburbs. So, that's something we're tracking pretty closely. As our customer matures, so are we.
Justin Mast, Bloomscape's founder and CEO. Thanks for joining us today. Coming up next here on Yahoo Finance Live, the Golden Globes shake up the battle for award season dominance among the streaming giants and Hollywood studios. So who's now in the lead to reign supreme for this year's Oscars? Fame and Fortune with Ali Canal has the details next.
Welcome back to Yahoo Finance. It's time for some fame and fortune with Ali Canal, because last night, Ali, we had the Golden Globes, and it's such an honor just to be nominated. But tell me, the streaming giant's positioned as front running heading into the Oscars. What can you tell us?
Oh my God. First of all, Adam, that's amazing. I did not know that. What a fun fact. But yes, the Golden Globes were last night, and it was a really big night for streamers, especially for Netflix. Netflix walked away with 10 Golden Globe wins. They did really well when it came to The Queen's Gambit, as well as The Crown. The Queen's Gambit won Best Miniseries. This is a category that's typically been dominated by HBO, but last night we saw Netflix walk away with that win. And then for The Crown, that won Best TV Series, Drama. Other poignant wins for Netflix included the late Chadwick Boseman winning Best Actor for his role in the Netflix film Ma Rainey's Black Bottom. His wife accepted the award on his behalf, and it was a very emotional moment in the show. We also saw Aaron Sorkin win for Best Screenplay for the critically acclaimed The Trial of the Chicago 7. So overall, a really great night for Netflix, but it was not the only streamer to have their moment in the spotlight. We also had Hulu, Disney, Amazon Prime Video having very important wins. Amazon Prime actually did really well with the new Borat sequel. That won them Best Motion Picture Comedy, which makes it the first streamer to ever win that award. Sacha Baron Cohen went on to win the Best Actor title for his role in the film. So Borat, who knew? It's a cult classic, and it did really well for Amazon Prime. And then Apple TV Plus, that's usually one streamer that struggled amidst these big streaming giants. But last night we saw Jason Sudeikis go home with the Best Actor win for his role in Ted Lasso. I personally have not seen this one yet, but people rave about it. They say it's a really, really good show. So I'll have to check that out. So even Apple TV Plus walking away with their very first Golden Globe. But when it comes to that final award of the night, the big one, this is Best Motion Picture Drama. That went to a more traditional film distributor with Nomadland. That's from Searchlight Pictures. We also had Chloe Zhao winning Best Director. She's actually the first woman to win this award since 1984. So a very interesting night. It was a little bit of a, I don't want to say a boring award show, but there weren't a lot of great moments. I think it's really hard to do that in a virtual setting. There were some technical difficulties here and there. There was a little bit of awkwardness, especially when people were giving their speeches and they were playing music. It's like they can't walk off the stage. They're just going to end up sitting on their couch the entire time. So I think we could see a little bit of that awkwardness play out when the Oscars airs on April 25th. They haven't released too much information about what that's going to look like, but I think we can expect it to be pretty similar to the Golden Globes, a little mix of in person at certain locations, but the bulk of it being virtual. So we'll have to see what happens when the Oscars come on April 25th.
Well, Ali, in the meantime, you have to check out Ted Lasso, because I've seen a couple episodes and it is very, very good. It's a lighthearted, fun, short little show that you could tune into very quickly. But first, on a more serious note, though, we talked about this last week going into the awards night. There was that LA Times report talking about the lack of diversity in Hollywood. This is an issue, clearly not the first time. This was specifically talking about Hollywood's Foreign Press Association. It was addressed briefly on stage last night, but clearly more needs to be done on this issue.
A lot more needs to be done. And you're right, they did address it on stage. We had host Tina Fey and Amy Poehler mentioning it in their opening monologue. And then shortly thereafter, we did have 3 members of the Hollywood Foreign Press Association come out on stage and basically say, listen, we know we have a lot more work to do here. We are going to start changes immediately. But it was a very brief moment. And that was kind of it. We didn't really hear much after that. So hopefully this is the start of greater change in Hollywood. And this is not just something that's affecting the Golden Globes. This is a deeper issue in Hollywood and really goes deeper into the ecosystem of Hollywood. Last year, we had the Oscars come out tweaking those eligibility requirements to promote more inclusivity. On Friday, we had Netflix releasing a first of its kind diversity report. They said that they will be pledging $100 million over the next 5 years to help bridge that diversity gap. But the reality of the situation is that a lot of these very notable Black-centric programs were completely shut out of the Golden Globe nominations. That includes Insecure, I May Destroy You, whereas other flashy titles like Emily in Paris did receive that nomination. So, you know, even Tina Fey said award shows, they're stupid. They don't mean anything, right? But they do provide windows of opportunity. They do provide visibility. So right now they are still important, and there's certainly a lot of work that Hollywood has to do to correct that injustice that sort of permeates throughout the industry and just be more culturally diverse.
Okay, let's get to the gossip in the dirt. Who got snubbed and what surprises were there?
So in terms of the snubs, it was very interesting last night because Mank was the most nominated film for Netflix with 6 nominations, and it walked away completely empty-handed. So I always think that's funny. Like, why give this film so many nominations if you're not even going to give them one award? In a similar vein, we also had Promising Young Woman. Now that came as a bit of a surprise when they received all that love for their own Golden Globe nominations. But once again, they also walked away empty-handed. Many people thought Carey Mulligan could potentially win for Best Actress, but that did not happen. In terms of surprises, I think Andra Day for the United States versus Billie Holiday, that delivered Hulu's one and only win. And Andra Day actually became the first Black actress to win that award in 35 years. And she had some pretty stiff competition there with Oscar winner Viola Davis. So congrats to her. She was amazing in that film. She has an amazing voice. You should absolutely go check that out. And then another surprise was Rosamund Pike for winning Best Actress for the Netflix series I Care a Lot. You could tell on her face, she just did not expect to win this award, and you saw that reflected, I think, in her acceptance speech as well. So those, to me, were some of the biggest snubs and surprises. Disney's Hamilton, the musical, I think that had a lot of buzz and momentum entering this, but they also were completely shut out of the Golden Globes. But I think at the end of the day here, a lot of the critics were going for Borat over Disney Hamilton the musical. And I always think that category is interesting anyway, because are you going to go the musical route or are you going to go the comedy route? They're very different genres to me, but clearly last night they went the comedy route.
Ali Canal with Fame and Fortune, the other big surprise is these things make great door stops if you need them.
I'm still amazed by that, Adam. Still amazed.
Roku and Nielsen, both stocks getting a pop here after hours following a deal that was announced. Roku buying Nielsen's advanced advertising business. Jared Bilkery has a little bit more for us, Jared.
That's right. So this is a strategic partnership between Nielsen and Roku. And eventually Roku is going to be buying Nielsen's advanced video advertising business. That's AVA. And I looked this up, wasn't too familiar with it, but it looks like it delivers targeted advertising to stream content. So you manage to leverage the power of targeted ads, for instance, from Facebook to whatever. That's coming to Roku now. So there's no deal the deal is expected to close in the second quarter. We don't have terms, but you can see Roku, which was already up 6% today, up another 2.5% in extended trading here, was up as much as 4 or 5%. And let's also check out Nielsen, because that stock is up 6%. So maybe unlocking some value there. Also want to do a quick recap of Zoom earnings here. Now, their first quarter forecast was a nice raise here, really beat the street expectations. They're seeing revenue of $900 million to $905. Estimate was for much lower, $830 million about. They're also seeing full year adjusted EPS at 95 to 97 cents. Estimate was for much lower, 72 cents, coming away with a nice boat of free cash load for the quarter. And then some commentary here from Eric Yuan, the founder and CEO. He said, as we enter fiscal year 2022, we believe we are all well positioned for strong growth with our innovative video communications platform. Again, this was our 2020 company of the year at Yahoo Finance. And let's just take a look at where that stock has been one more time. Up 290%, but worth reiterating, still off about 30% from those record highs, guys.
Amazing gains that we've seen in that stock over the past, today and then also over the past year. Jared Bilkery, thanks so much. Well, let's turn our attention to tomorrow's Zoom. Clearly a name to watch with the stock up just around 10% after hours. But Adam, what else are you keeping an eye on?
Want to keep an eye on how, as the car manufacturers start reporting their February sales figures. We know that demand is at all-time, not necessarily all-time highs, but very strong because of the pandemic. People don't want to ride in public transportation. But then there's the issue of the chip shortage and how that's crimping production for General Motors, even Tesla, slowing down production, and that's, of course, slowing down delivery. So look at the numbers of cars that are being delivered, especially as we're going into spring, and people are going to be looking to get out more. So I want to look at where we've been, because it could indicate where we're headed. Shauna?
Adam, I'm going to be taking a look at a couple of retailers. So speaking of earnings season, it's going to continue tomorrow. Target's one of the biggest names set to report before the bell, actually. This includes the all-important holiday season, so investors will be closely looking at these numbers. Target has been an outperformer over the past year, has really benefited from some of those stay-at-home restrictions, people turning to them just to order some of their goods online. So we will be keeping a close eye on these numbers. E-commerce sales, that has been one of the strong points of its recent reports. It actually jumped 155% last quarter. So we'll see whether or not that momentum continues during the fourth quarter. I have a feeling it probably will. Target is not the only name that we're set to get tomorrow. We also have Abercrombie, Urban Outfitters, Nordstrom. So a couple of big reports when it comes to retail. And remember, we got that retail sales number out just last week showing a bit of a rebound in consumer spending. So we'll see whether or not that carries over to any of these big names. Let's do a recap of today's, speaking of big gains, of today's rally, because it was quite a day, I guess you can say, for the market, recouping some of last week's losses. Dow closing up just around 600 points. S&P up just over 2%. The NASDAQ up 3% today. Was the Dow, S&P, and NASDAQ's best day of the year. The S&P's best day since June. Taking a look at the sector action, all 11 of the S&P sectors closing in the green today, was led by financials and technology. Those two sectors leading the way. Well, that does it for us today on Yahoo Finance Live. Thanks so much for joining us. We'll see you right back here again tomorrow afternoon. Have a great night.